Good morning, ladies and gentlemen. On behalf of FSMOne.com, I extend a very warm welcome aboard to ETFestival 2021. This year's ETFestival theme is Explore and Take Flight. With the COVID-19 outbreaks and travel restrictions, I'm sure many of you miss traveling. Fret not, as FSMOne.com will bring you on a virtual flight around the world with ETFs. We have an exciting lineup of presentations today, categorized into pre-flight checklist, in-flight, and destination segments. We will be helping you through your ETF journey, from pre-departure preparations to landing at your destination safely. On our flight today, look out as we share with you about ETFs and how to invest in them. We'll also share about the ETF focus list and discuss pertinent topics such as whether fixed income ETFs should be your portfolio's life jackets and how you can invest in the ever-important sector that makes up your in-flight entertainment. Of course, flying is not the only thing we're doing. We'll explore some destinations with you by covering various specific ETF sectors of interest, including our very own China Hour. During our lucky draw today, 5 lucky participants will walk away with $100 worth of quiz shop vouchers, and 1 lucky winner will receive the grand prize of $880 worth of FSMOne multi-currency cash account credits. All you have to do is to attend the ETFestival and collect chances throughout your day. You can accumulate your chances by logging in. You can also accumulate chances by participating in the quiz sessions, or completing and submitting the survey today. Or you can also visit our partners pages and by sharing this event on your social media through the social media buttons on the footer. To receive the chances, do ensure you always use the same ID and email address when logging in. At the end of each segment, you can also take part in our quiz. There will be 3 quizzes held today, and the top 3 participants from each quiz will each receive 3 units of the Away ETF MG Travel Tech ETF. As we gear up for the start of the sessions today, we would like to kick things off with a poll. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for poll number 1. Then click on the Join Poll button. And the poll window will be displayed on your right. Poll question number 1, do you miss traveling? I think we all know what the answer to this is. "45% of us miss traveling a lot, and only 27% of us kind of miss traveling. And the rest of us are just happy to have more money to invest." Question 2, which markets or sectors are you most bullish on? The majority of us are most bullish on the US technology sector. Question 3, how much investing experience do you have with ETFs? Have you been investing with ETFs for a very long time, have some exposure to ETFs, or you recently started investing in ETFs? Or are you not very sure what ETFs are? Looks like the majority of us have some exposure to ETFs, but some of us, 7% of us, are still not quite sure. That's what today's festival will be helping you understand. Question 4, have you taken advantage of the 0% processing fee promotion on ETF regular savings plans? "58% of us have not started but are thinking of starting." Thank you so much for participating and sharing your thoughts with us. And with that, let's prepare for takeoff with Jean-Paul Wong, General Manager at FSMOne.com Singapore. Jean-Paul will guide you through on what you need to pack as an investor to get ready for your investing journey.
Good morning, ladies and gentlemen. Welcome to FSM ETFestival 2021. This is the third consecutive year we are organizing the ETF Festival, and we hope you'll enjoy today's session. Our team of analysts and investment advisors, together with the partners from the ETF industry, have prepared a number of presentations and panel discussions touching on the ETFs that should be on your radar. Today, I'll be running through some of the ETF trends we see among our investors and talk through some considerations you can adopt when building a simple global portfolio. The ETF universe is huge. We're talking about over 3,000 ETFs for us to choose from. So having a way to zoom in on those that matter is really important. This is why we have the ETF focus list, which narrows down the list of ETFs for you to just 50 plus. Our research team reviews it every year, and later on, our analysts will be sharing more with you on the new ETF focus list for this year. We also introduced the ETF Regular Savings Plan, or RSP, to make it easier for you to invest from just $50 every month. The usual commission rate is low, but what we have done since January this year is a 0% commission rate, and we're extending this to December 2021. The role of the ETF focus list and the ETF RSP list are like signposts along our investment journey. It gives us certain direction on what to do. Today, our investors can trade in ETFs on the US, Singapore, and Hong Kong exchanges. In the last 3 years, we have seen an increase of over 10 times when it comes to ETF buy trades from our investors. We are thankful for your support, and we will continue to work hard to provide useful tips and new services along your investment journey. So far this year in 2021, when we look at what our investors have been buying into, it's been a wide range of ETFs. The usual popular ones include our local S.E.A. ETF, our Singapore market, as well as the US S&P 500 index. But our investors are also investing into quite a variety of ETF destinations, including the likes of Hang Seng Tech, which is a more recent ETF newcomer in the marketplace, which is the Chinese tech companies listed on the Hang Seng Index. We also have investors buying into the global internet giants, which has become a very important theme since last year because of the pandemic. And we have also a number of investors looking into the various ARK ETFs, including innovation, but they also have the genomic revolution and fintech innovation that's been quite popular. Some of our investors have liked semiconductors. It's been a sector that our research team, we've been talking a lot about why we like it for quite a while. And the more gung-ho investors have even gone for the leverage ETFs in the semiconductors as well as other sectors. Among other sectors that have been popular this year so far are gold, silver, and clean energy. So I think with ETFs, it's really easy to travel the world because they offer really a niche exposure for us in a very easy manner. So I'd like to share 4 points today based on some of the trends we see. First, on the asset allocation. It's important for us as investors to see if our portfolio is into just one type of asset class or not. Very simply, we look at 2 main types of asset classes. So these are equities and bonds. And we talk about these two because historically they have a low correlation with one another, which is a good thing for diversification purposes. So it looks like a number of our investors, when they buy ETFs, they've been going quite a bit into equities ETFs. So I think not too much of a surprise because equities have done so well last year, especially after March. So it's good to review and see if there's room for more bonds because that's what provides extra cushion and lower volatility when global markets go through their ups and downs. So when we look at markets, I think it's we can look at it as some form of turbulences every now and then happening when markets go through wide gyrations. And I think that's where bonds are coming into place and can provide some cushion for our portfolios. So one easy reference point would be a simple balanced portfolio that has about 50% in equities and 50% in bonds. And from there, you can then adjust your asset allocations depending on your purpose of investing, the kind of risk you're comfortable with, and the time that you have on your side to be invested. But no matter how aggressive you are in terms of risk tolerance, we always advocate not 100% in equities, but to have at least 10% of your portfolio in bonds, because that can help to cushion the market volatility and the turbulences along your investment journey. So one very simple example for Singapore-centric investors, so for those of us that look at our investment portfolios in Sing dollar terms, our Sing dollar corporate bonds ETF would make sense. If we want a little bit more uplift in terms of the yield that we can be looking at, a Chinese government-centric bond can also be an interesting addition. And for investors with a bigger risk appetite, an Asian high-yield bond would also be an interesting addition because of the higher yields, but of course that comes with higher volatility as well. So the local home bias is my second point today. We are more familiar with the Singapore companies, obviously, because we grew up with a lot of the Singapore companies and the brand names, and we use them in some ways in our daily life. And this explains why many of us have exposure to the S.E.A. But if that's the only holding in your portfolio, it's not going to be enough to achieve our long-term goals. The reason why I say that is simply because we need to have exposure to a more diversified portfolio that is exposed to global trends and catalysts. So for instance, adding a global equities fund exposure would do the trick quite quickly if we want to build a more global portfolio. From our chart center, which I have on this slide, you can find that this example here, which is from Vanguard, which is called VT, it did about 42% in the last 1 year on a total return basis. Of course, the timing matters because that performance in the last 1 year took into account the start of the bull run after March 2020. So of course, do look into the performance numbers over the different time periods as well as the volatility. And from the ETF top 25 holdings information on our website, you'll be able to find also that this ETF is exposed to the major global companies from the US and China. I also want to talk about the core and supplementary portfolio here because I think a lot of us, when we look at some of the ETFs that our investors have been buying, a lot of them are into the more niche sectors. So these are what we call the tactical ideas that we like, and those have done generally pretty well if you're exposed to a lot of the sub-tech sectors last year, for example. And I gave a few examples just now of the Hang Seng Tech as well as even the other sectors like your disruptive innovation and so on. The point here is that your tactical ideas, and I have this slide here, is to keep it within to a smaller proportion of your portfolio. We call it the supplementary portion. And the simple reason for that is we don't want to have a portfolio that has 100% exposed to all the exciting tactical sectors. And that's really simply because it's really volatile. So having a little bit of your portfolio into tactical ideas under supplementary, let's cap it at about, let's say 20% would be a good idea. And the rest of the portfolio should be in the core ideas, which are invested in the dominant regional markets of the world, or even a team like disruptive innovation or China, which deserve a core position in a portfolio because of their growing importance, especially in the last few years for China, and also in a post-pandemic world for disruptive innovation. So I'll move into this last point here, which is to use our ETFs to give the takeoff that we want for our portfolio. I think when we invest, it's important to look at the life goals that we have. Are we investing for retirement in 10 to 15 years? Are we investing for our kids' education in the next 20 years, for example? That gives us an idea on the asset allocation and the risk we can take. So at FSMOne, what we try to do is to provide various ideas in terms of research ideas. Our research team writes articles on the various ETFs, on the ETF ideas. Our partners from the industry also talk about the various interesting markets and ETFs under the ETF Hub. So you can find all this on our website. So it's a good source of ideas on what to do with markets, changes in the global economy, and the turbulences that we're experiencing every now and then in the global markets. We also have tools such as the ETF Selector that can show us the performance and volatility of the different ETFs. I mentioned the ETF focus list, so that narrows down into the core tactical ideas and the different asset classes, which I have mentioned just now in terms of how you can build a portfolio. So one key strategy to keep ourselves very disciplined and not emotionally affected by the market turbulences is the regular savings plan. I continue for myself to keep a number of RSPs in my portfolio, and we'll continue to make it easy for our investors by extending the promotion of the 0% processing fee for all ETFs to the end of this year. So for investors who invest into ETFs and stocks on the SGX exchange, our local stock market, we have also a permanent commission rate, which is a flat rate of $8.80, which helps your investment portfolio to soar higher in terms of savings. So with that, I've come to the end of my presentation. Thank you so much for your time. Stay healthy and enjoy the rest of the FSM ETFestival.
Thank you, Jean-Paul. Our next speaker is Ong Zi Yang, Senior Analyst, Macro Research, iFAST Singapore. Cheung will be sharing and guiding you to 3 destinations where your investments can potentially have a fruitful return. Let's welcome Cheung.
Hi, morning ladies and gentlemen. Welcome to the FSM ETFestival. Thank you for taking your time to tune in today and joining us here. I'm Cheung from the macro research team, and today I would like to share with you the top 3 destinations that you should be looking at into investing heading into the second half of this year. Let me start by sharing on the current macro backdrop. The COVID pandemic continues to be the biggest headwind facing global equities. Chart on the left shows that the COVID cases continue to rise globally. Europe had a massive resurgence in the COVID cases in the first 3 months of this year, before passing the baton now to India and Southeast Asia, where the pandemic is still raging. This has delayed the anticipated reopening around the world, pushing back the timeline from first half, possibly to third and fourth quarter this year. Despite the delay, like many investors, we are hopeful for the global recovery ahead. The pace of vaccination is picking up rapidly across developed nations, even though it's more challenging for developing countries in terms of vaccine availability and distribution. However, I think it's worth noting that the global economic backdrop has been improving across the year. We believe we are now in the early phases of an expansion in the new economic cycle, and we could be looking at rosier days ahead. The chart on the left shows that economic reading across the world has been better than expected since July last year, not only showing signs of resilience, but also signaling that the economies have normalized a part of the negative effects of the COVID lockdown. While the chart on the right shows that global export growth of major exporters like China, Asia, US, and Europe has rebounded firmly into the expansionary territory. Part of this cyclical recovery was supported by the fast rebound in global trade activities, since they are less affected by the lockdowns compared to service sectors like tourism and travel. Here, I've prepared a chart of the Global Composite Purchasing Manager Index, which is in short PMI, where below 50 indicates a contraction and above 50 indicates an expansion. We can see over the course of the last year and this year, most economies have recovered from the deep contractionary phase of the low 20s, between March and May last year, towards the high 50 across this year. In fact, global PMI has recorded an expansion of 10 consecutive months, highlighting the acceleration of the global growth momentum. Sentiments in the developed markets has improved significantly as well, with US and UK now hitting over the 60 marks, thanks to their higher vaccination rate, while only a handful of EM, like the Brazil, has sunk back into a contractionary phase. As a result, we believe the global economies are now back on track for massive growth recovery in 2021. The record levels of fiscal and monetary stimulus, alongside a low base effect, is set to drive a sharp global GDP growth this year, before moderating in 2022. Special attention should be paid to Asia and China. Not only did they avoid a contraction like the rest of the other regions, Asian growth this year is set to match that of the global growth, while China is set to hit the highest growth rate among major economies this year. The rosier outlook, due to the shift in macro backdrop from a recessionary to expansionary environment, also encourage investors to rotate into cyclical value sectors like your financials and industrials that has been beaten out heavily last year. In fact, the value rotation was actually in full effect since November last year. Here I divide the timeline into 2. Before 6th of November on the left, and on the right after the 6th of November. And why the 6th of November, if you ask? It's actually the day whereby Pfizer and BioNTech announced a vaccine candidate that is 99% effective in fighting the coronavirus. And on the left, you can see that China has outperformed the global equity market due to this better COVID management. Then in the chart on the right, once the vaccine was announced, China was quickly abandoned by investors in exchange for the laggard US and European market. And this is more obvious after February, after US and Europe trended upwards on better than expected economic data and faster pace of vaccination, while the rest of the other markets traded flat on concerns of vaccine availability. The value rally was also supported by rising inflation and growth expectation, particularly within the US itself, where inflation expectation rose to more than 2.5% in the latest reading. That typical of a pre-pandemic level. The chart on the right also shows that the value outperformance over growth has widened to almost 20% since November, outlining aggressive value rotation among global investors. Yet, we see that global investors are quickly pricing in the rosier growth outlook as well. In a way, valuation is growing increasingly expensive on an absolute level. Almost every major market on the left, you can see, is trading now way above their 5 years average level, making it a little bit harder for investors to sieve out value picks amongst global equities. But the saving grace is that the chart on the right shows that global equity markets are expected to see a massive double-digit EPS growth rebound this year, which can help bring down the price multiples as earnings gradually be revised upwards. So after a long way around the world, this brings us back to the question, which market should we be looking at or destinations that investors should be paying attention to heading in the second half of this year? And first up, we have Europe. And why Europe? For investors who are unfamiliar with Europe, it is a developed market with a value cyclical tilt, meaning that its equity market is highly sensitive to the global growth prospects, represented by the STOXX 600 benchmark index. On the geographical level, the chart on the left, you can see that STOXX 600 is well diversified across European countries, as well as having representation across small, mid, and large cap companies. On the sector level, the chart on the right, cyclical sectors like your financials, your industrials, your materials, together account for more than half of the index, which is also the reason why Europe exhibits such a cyclical value tilt. And even though the Eurozone economy sunk into a recession in Q1 this year, we think Europe is set to benefit from the strong growth momentum in the next 2 quarters forward. The chart on the left shows that Europe's economic readings have been exceeding their expectations since July last year. And if you look at the chart on the right, it shows that confidence in major European economies like Germany, France, Italy, and Spain are returning back to levels seen before the pandemic. And because of Europe's cyclical tilt and the kind of sensitivity to global growth prospects, we're actually quite optimistic on European equity for the next 3 to 6 months. In our view, there are actually 4 reasons to be hopeful. First, Europe is set to benefit from the stronger growth momentum. And if you look at the PMI heat map for manufacturing on the top, they are now in the high 50 to 60s across major European economies, meaning that manufacturing activities are set to be even better in the next upcoming months. Service PMI at the bottom, which has been largely impacted due to the COVID lockdowns, has since climbed back to positive territory for the first time since the second lockdown in Europe. The rosier backdrop is expected ahead. It's also going to be good for your earnings growth for European equities. Combined with that continuation of your value cyclical rotation, the upcoming reopening among European economy meant that investors' pessimism for Europe may be shaken off. Ultimately, this means that investors may be positioning for Europe ahead, which will drive prices up quickly in the short run. Secondly, we believe Europe will benefit from the continuation of the positive earnings revision. Earnings release since the first quarter has been largely better than expected, driving significant EPS revision just the first 4 months of the year. A closer look under the hood confirms that on the chart on the right, that they are attributed to cyclical industries such as mining, energy, automobile, banks, and financials. As you can see, that not only for investors, your commodity prices have been rising up, your interest rate have been picking up. So these businesses that were badly affected due to the sudden halt in economic activities due to the lockdown last year is starting to reverse their fortune as global economy starts to reopen. Overall, Europe presents a strong near-term choice for exposure to the global value rally, especially in the near term. We believe Europe will be a major beneficiary of the global reflationary environment, not unlike what we have seen in European equities so far. The rally will also be supported by the massive cyclical recovery in earnings of 53% for this year, as well as 15% for next year, which empowers by your cyclical sectors, which account for 65% of the index. With Europe moving by more than 10% so far, half of our upside has actually been actualized. So looking ahead, it appears that it only has about 10% left. However, if you think about it, Europe is shaping up to be one of the clear winners of the value rally, pending its economic restart in second half of 2021. We believe the market is likely to be pulled closer to our target price, possibly fully pricing in that target price by this year itself. For investors looking to gain exposure to this cyclical tilted market via an ETF, you can actually easily do so via the Vanguard FTSE Europe Index ETF at a low cost of just 8 basis points. Next, talking about potential winners of the value rotation heading into second half of 2021, our second destination naturally is also one of them, which is the emerging markets. For investors unfamiliar with the region, the emerging market consists of markets from the developing second and third world countries. In terms of investable universe, the chart on the left shows that the EM index is heavily weighted towards Asian markets like China, Taiwan, South Korea, and India, leaving a non-Asian market like Brazil and Russia a minor representation in the index as well. On the sector level on the right, the chart is actually pretty similar to Europe, where it's heavily weighted towards your cyclical sectors like your financials, industrials, materials. But it also has a fair share of exposure to growth sectors and long-term growth trends. Growth sectors such as IT, communication services, and consumer discretionary account for more than 50% of your ETF EM index, with high-quality internet heavyweights like Alibaba, Tencent at the helm of internet companies, and world-class chip makers like TSMC and Samsung at the helm of the IT sectors. Even though performance has been quite strong in the first 2 months of the year, EM index has started to struggle after mid-February, partly due to the sudden strengthening of the US dollar. The chart on the left shows that the EM equities have historically traded quite closely with dollar trends. In other words, a strong dollar is quite bad for EM equities, and vice versa. A weak dollar is great for your emerging markets. Therefore, the direction of the US dollar plays a major role in the momentum of the EM equities, which we think is likely to head further downwards ahead on a mid to long-term trend. The chart on the right shows that US, the high twin deficit, this time caused by its massive fiscal stimulus package, which Biden has announced in February of 1.9 trillion in USD, as well as a lot of his quantitative easing program, in other words, money printing, has always ended up in a US dollar downtrend. And we think that this time, it will not be any different. Besides the twin deficit, there are also other factors weakening the dollar. First up, the potential for a strong euro pending its economic restart is likely to weaken the dollar, given that Europe makes up almost 60% of the dollar index. Part of the dollar strength was also due to the upgrades to the US GDP growth after its recent impressive economic data and fiscal stimulus. However, we do see a case that emerging markets to close out the growth differential against the US in the latest part of this year, especially when vaccination drive catches up and broad reopening to open up for the world, especially particularly your Asian ones. If you look at the diagram on the right, our current macro backdrop, the synchronized global recovery, so slowing US growth on the long term, your lower real interest rate actually favors a weaker USD, which will in turn be supportive of emerging market equity prices ahead. And the point is the same as Europe case, where we see that cyclical EPS recovery for emerging market remains well underway, supported by a steady rise in commodity prices since the mid of last year, as shown from the chart on the left. The chart on the right shows you that, interestingly, EM equities actually trend closely with the growth of commodity prices on a historical basis, back all the way since the 2008 great financial crisis. One reason could be that the rising commodity prices typically indicate that global manufacturing activities are continuously expanding steadily, which is good for manufacturing-reliant emerging markets like China, Taiwan, South Korea, and India. At the same time, the rising commodity prices also benefits the commodity exporters like your Latin America region as well as Middle East region for their oil and metal, although representation is slightly more minor. With commodity prices continue to ramp up steadily this year, we expect that earnings for EM to continue revise positively ahead. Third point is that the valuations are subsequently knocked down to fair both on this year as next year's forward PE multiples, looking at the chart on the left, thanks to the combination of a rising growth prospects as well as the recent correction in the EM equities. We think this should alleviate any investors' concern of a frothy valuation within the emerging market itself. At the same time, the chart on the right shows that the valuation resets have widened the kind of value discount that emerging markets has typically against the developed market. EM equities now trade close to 30% discount to that of the developed market, where the discount typically average only at around 20%, meaning that value-seeking investors are likely to rotate into the EM soon to take advantage of its cheap valuation now. Overall, we remain highly constructive of EM equities, despite the recent correction. We believe the combination of a fair valuation alongside the strong double-digit EPS growth, supported by 5 catalysts, with good likelihood of materializing, like your commodity upcycle, as well as your synchronized global growth. We believe that EM equities, your emerging markets, stands a good chance to outperform global equities this year. Although our projected upside of 25% is for end 2023, based on our calculation on the upside potential table on the top left, we won't be surprised if the market actualizes more or most of all of it by the end of this year. We believe that EM remains an alluring option for investors seeking to take advantage of the cheap valuation for exposure to the global value rally. Investors seeking exposure to this broad EM market should also do so via the Vanguard FTSE EM Index ETF fund. Next, we come to the last destination of the day, which is a single market within the EM space, China. Investors who have followed us for a while may protest that why are we pitching China as the third choice again, despite its poor performance after February this year. China has fallen by 25% from its peak in mid-Feb. But there's a reason why we remain optimistic in China. So you have Europe, which is highly cyclical tilted. Then you have the broad EM index, which is a good mix of cyclical and growth play. On the other hand, the makeup of China Equity Index is actually highly growth-oriented. Internet e-commerce companies like Alibaba, Meituan, and JD dominates the consumer discretionary sector, while Tencent, an owner of messaging app WeChat, and the gaming companies NetEase dominates the communication service sector. And looking at the charts on the left, you can see that chart on the right, you can see that the sectors account for more than half of the index weight. Such outsized exposure to growth and internet sector was a boon for China equities within the global lockdown backdrop of last year. But China has become a victim of its success this year. We believe that part of this weakness at this point of time in China comes from investors taking profit of their winning position and rotating their gains into cyclical value-oriented markets, given the kind of excitement for a global reflation this year. At the same time, 2 other risk factors has emerged for China. China's deleveraging drive, as well as its tightening regulation on its mega internet firms. Yet, we think that the concerns have been priced in, and will likely ease over time. And I will explain this over the next few slides. First of the two concerns is that China's possible hard landing, particularly as policymakers look to reduce financial risk after the much publicized Huarong debt crisis. China's strong rebound in economic activities, coupled with concerns with its rapidly rising real estate and asset prices, should enable the Chinese government to continue to focus on deleveraging and possibly tightening of monetary policy ahead. Based on the chart on the left, this is actually quite evident from the sharp drop in credit impulse across March and April. But if you look at the chart on the right, economic readings have largely been in line with expectations, signaling that the V-shaped recovery in the economic activities within China remains well underway. And part of the confidence comes from the fact that the first set of the economic prints coming out from China at this point of time has been quite promising, even though the surprises are more muted compared to the massive expectations beat within the US and Europe at this point of time. Therefore, it's also clear that investors will be comparatively less excited about China equities at this point of time. But we argue that China growth can continue organically without any further stimulus, sort of nulling any concerns for its restriction in credit growth, and that the economy is on a steady footing to meet our GDP growth expectations this year. The second concern investors have for China equities was that the China government has tightened regulation on tech players like Alibaba and Tencent. While investors' worries are reasonable, we believe that the negative development has largely been priced in already. The chart on the right shows that the divergence in performance between China internet giants versus its EM peers has widened significantly since then. With those negatives already factored in, we believe investors are neglecting the strength of the internet giants. A majority of them already achieve critical mass and are actually benefiting from network effects, enabling them to provide superior products compared to their smaller competitors. At the same time, these tech giants are crucial to China's 14th five-year plan to digitally transform its economy. Facing steep competition from US tech counterparts, we believe China will likely show restraint in governing them, and their intention will be mainly to increase oversights to this fast-growing mega industry that has become a crucial component of its economy. The subsequent sell-off in China equities after mid-February has actually knocked valuation back below our fair value of 14.5 times, skimming away the froth within the China equity market, as shown on the chart on the left. We believe the reset to valuations should allay any concerns of overheating within its equity market, given the strong performance of China tech players last year, and also provide a cushion for any further downside risk within the China equity market. The chart on the right shows that the relationship between China leading indicators and its underlying EPS typically is actually quite strong. And at this point of time, what we are seeing is that there's a sharp bounce within its leading indicator index, meaning that earnings is likely to be quite robust, and we project to be a robust double-digit growth this year as well as next year, which will be vital in driving a healthy expansion within China equity market ahead. While we can understand why investors are understandably concerned about Chinese policy intervention in financial deleveraging and tightening of regulation, we believe that the economy is on a strong footing to meet our growth expectation this year. And the promising economic data year to date also indicates that the V-shaped recovery within economic activities in China continues without even as the policymakers restrain the credit growth. And with valuations now reset to a healthy level, coupled with that robust double-digit growth, we continue to iterate a very highly attractive recommendation for China. Our projected upside looking ahead for China is more than 30% by end of 2023. And we see that recent pullback in China a buying opportunity to accumulate growth exposure to high-quality internet companies like Alibaba, Tencent, and Meituan on the cheap, alongside your cheaply valued China Big Four banks in your MSCI China index heading in the second half of this year. investors who believe that the value rotation that everyone has been so optimistic about, which have maybe been overdone, and believe that the growth kind of trends are due for a comeback ahead, can actually assess this growth theme via the iShares MSCI ETF index, where there's actually a large overweight towards more growth-oriented sectors such as your technology, consumer discretionary, and consumer communication services. With this, I come to the end of my presentation. I hope we can give these three top destinations. On one end, we have Europe, which is value cyclical tilted, followed by emerging markets, which is a good mix of value and growth. And on the other hand, we have China, which is largely growth-oriented. These three destinations should be given a good consideration when choosing where to invest in the second half of this year. That's all for me now. Do stay tuned and enjoy the rest of the other presentations that we have prepared for you today. Thank you.
Thank you, Tsui. Now that you have heard from the iFAST macro research analyst, you may have an idea what areas you would like to invest in, but how exactly should you go about doing it? In our next presentation, Katherine Chua, Assistant Manager, Investment Advisory, FSMOne.com Singapore, will be sharing with you about embarking on your first ETF investment. From how to kickstart your ETF journey to the recommended approaches of investing in ETFs. Katherine, please.
Thank you, Geraldine, for the introduction. So my name is Katherine, and I'm from the Investment Advisory team. So today I'll be sharing with you some of the basics to investing in ETFs, so let's get started. So if you're new to investing, ETF stands for Exchange Traded Fund. Do you know that the first ETF was introduced almost 3 decades ago in 1993? So what are they? Basically, they are a portfolio of investment products such as stocks, bonds, and money market instruments, etc. ETFs can be traded like a stock on the exchange, and you can trade them intraday, like buy and sell, make profit. So most ETF out there are passively managed by the ETF managers, and their main aim is to replicate the performance of the underlying index. As the fund managers do not cherry-pick the investments within the portfolio, they invest accordingly to its securities weightage and the composition of the index. As such, in absence of such an active manager, the expense ratio is also typically lower compared to actively managed funds. Investors also get to enjoy greater cost savings because instead of buying into the top 30 companies on the Straits Times Index, they can invest in just a single ETF which tracks the Straits Times Index and gain exposure to all the components of this index without spending a bomb. So ETF offers high transparency as investors can see all the securities within the portfolio as the ETF are required to publish them on a daily basis. So do you know that over the last 28 years, the ETF industry grew its total asset under management to over $7.7 trillion US. So before we start investing, there are some factors which we should pay attention to, and I will elaborate more over the next few slides. So the first and one of the more important factors to consider is the ETF expense ratio. This ratio is expressed as a percentage of the fund's operating expenses to its total assets. The lower the fees, it translates to a higher return to you. So it is important to compare the ratio within similar asset classes and markets. So for example, I've shortlisted these 3 ETFs that are more commonly used to track the performance of the S&P 500 index. They are from Vanguard, the stock code is VOO, iShares, the stock code is IVV, and from State Street, the stock code is SPY. In this table, you can see that the Vanguard and iShares have a more competitive expense ratio of just 0.03, compared to the State Street, which is 3 times higher at 0.09. So ideally, an ETF should mirror its index perfectly, but there are a number of reasons why it prevents them from doing such a mirror image replication, such as this difference is called the tracking difference and the performance between the ETF and the underlying index. So this problem exists mainly because of fees incurred from operating expense of the funds, transaction, rebalancing costs, representative sampling, hedging costs, etc. So the wider the difference, it means that the ETF is not tracking its index as efficiently as its peers. So if we were to look carefully at this table here, I've shortlisted again the same three S&P 500 ETF, which are VOO, IVV, and SPY. I've charted them against the S&P 500 index. So if you were to compare the difference between S&P 500 benchmark, the SPY ETF shown on the third row actually shows a wider tracking difference of 3.4% compared to its peers. So typically, you can also download the ETF fact sheets from the product provider's website, which often shows the tracking difference between the ETF and its underlying index. So ideally, we will want to select an ETF with the smallest discrepancies against the underlying index so that it can duplicate the performance seamlessly. Yeah, so moving on to the next factor, knowing the underlying index which the ETF tracks is important. This is because the index would tell us its constituents and which asset segments or markets it's trying to replicate. Each index has its own selection methodology, which is the rules that determines which assets will be included or excluded from the index. As such, your monies will be invested accordingly to the index composition and impact the overall investment returns made by such an asset allocation. So, for example, over here we are looking at the Straits Time Index, S.E.A. This is a market capitalization weighted index that tracks the performance of the top 30 companies listed on SGX. But do you know that 3 local banks actually takes up 42% of the index itself? That means that for every $100 that you invest in the S.E.A ETF, more than a third of the portfolio is actually invested in the financial sector, and hence concentrated within the 3 local banks. So understanding the underlying index will shed light on the types of the securities you are exposed to and if it's concentrated or diversified enough. So for ETF to replicate the underlying index, they can either use a physical replication or a synthetic options. So physical ETF means that the funds invest directly and hold securities that makes up the index itself. But sometimes due to liquidity constraint or large numbers of holdings in the index, the ETF might do a partial replication instead. So the ETF holds a selective basket of index constituents that best represents the index itself. So the second method of the replication is where the ETF invests in financial derivatives such as swaps and access products such as participatory notes. So with the aim to produce the performance of the index. So in other words, these synthetic ETFs do not directly own assets in the index, and hence investor might be exposed to greater counterparty risk or greater tracking error. This type of structure is actually more common to track indices on restricted markets, or it cannot be directly replicated, such as buying barrels of crude oil or other commodities. You can usually find this information in the product highlight sheets or the prospectus of the ETF. Usually, I will refer to our website on the product landing page for a quick reference shown on the right. Right over at the overview of the ETF, we will indicate whether it is a synthetic or a physical ETF. So, after understanding the difference between all the exchange-traded funds, let me just share with you how to incorporate them into your portfolio. But before you start, it is important to actually understand your risk profile. So before you start, it's actually important to understand your risk profile and to know that there's actually a risk to reward differences. So factors like your risk tolerance, investment time horizon, goals would narrow down the type of investment products you should consider. On our website, we have this investor profiling questionnaire. You can fill it up and it will recommend you the risk profile based on your unique response to the questions. So say for instance, you are a balanced investor. And in a neutral asset allocation, we will allocate half in bonds and remaining half in equities. So a 50-50% portfolio. Within this broad asset class allocation, you can first build a core portfolio consisting of bonds and equities. This gives your portfolio the foundation to generate steady performance that does not require much monitoring or adjustment. So this core portfolio will represent the main bulk of your investments that should help you to achieve your investment objectives. So, for instance, under the core bonds portfolio, it can be made up of bonds in different regions. There are different, if you do have investment constraint, you can consider starting off with a global bonds portfolio first and gradually add in like Singapore corporate bonds and other higher yielding bonds into the asset mix. So this list of ETF you see here is taken from FSMOne's very own ETF focus list, which I will share more later. So within the equity asset allocation, you can invest in broader equity markets like the global, US, emerging markets, Asia, Europe, etc. So without placing any emphasis on any single industry or sector, these equities will give you a highly diversified exposure to all the different markets. So should there be investment constraint and you cannot incorporate every single one of these ETFs into your portfolio, you can start off with first a global ETF, followed by an Asian equity fund or other EM funds. And subsequently, you can slowly add in other regional markets down the road. So once you have settled and gotten the core portfolio in place, you can afford to take slightly higher risk. So this is where the supplementary portfolio comes into the picture. The role of this portfolio would act as a kicker to boost your investment returns. And as these are tactical ideas, they could be either a single stock or other thematic trends that you have very, very high conviction of. You can express your best bets in this portfolio. And we will recommend to keep this allocation to less than 20% of the equities exposure. This is because ETF in this supplementary portfolio comes with an added element of risks. And they are typically less diversified and highly concentrated in single industry or markets. So should there be any unforeseen social, economical, or geopolitical changes that in that specific industry, these funds may suffer prolonged market weaknesses. And if you have added significant weightage into these tactical ideas, it could adversely impact your overall investment returns and derail you from achieving your investment goals. So, to sum it up, by adopting a core and supplementary portfolio concept in constructing your portfolio would help to minimize risk through diversification and in the long run, achieve above average returns with below average risks. So with so many ETF choices, we have also done the homework for you and selected a list of ETF which should serve as a good starting point to your investment decision. This list is refreshed every year, and the funds are selected based on several qualitative and quantitative factors, which my colleague Hui Shi will share more on later. If you have downloaded our FSM mobile app, you can easily access this ETF focus list under this ETF icon on our app. So our latest investment insights can also be found on the Research tab. And also, if you do have Telegram, you can join our FSMOne research channel and get up-to-date investment ideas in bullet point forms, so you will never miss out on any of our investment calls. On our platform, we also have an ETF selector, which helps you to narrow down the list if you have a specific sector or parameters for your search. So, for example, you can shortlist this tech ETF listed in a specific exchange, or you can search via like payment methods to see which are the SRS or CPF approved ETF on SGX. So after populating the search results, you can click on these ETF individually and it will lead you to the product landing page on our website. There are a few actionable buttons where you can explore, such as like adding it to your watch list or set a price alert. Yeah, so the price alert will come in as an in-app notification, so you'll never miss out if the ETF hits a price that you're looking at. So sometimes for a quick overview of the top 10 holdings in the ETF, I would also view the details under the investment info tab. So let me show you over on the next slide. So under this investment info tab, you can see the top few holdings of the fund. It shows you what is the minimum investment lot size, the fees, and also the dividend info. So on the topic of dividends info, if you are invested in a US listed ETF or stock and you are not a US citizen, you will be required to pay the withholding tax. Capital gain tax will not be applicable since we are not US citizens. So for Singaporeans, because we do not have tax treaty with US, our withholding tax is 30%. So this means that if you are entitled to a dividends worth $100, you will only receive $70 net of paying the tax. So lastly, as markets do not go up in a straight line, investing via a regular savings plans allow you to do a dollar cost average and smoothen out the overall portfolio returns over time. We have 62 ETFs available on our platform to do our RSP, including tactical plays into Chinese tech, global financial, semiconductors, and even the ARK Invest suite of ETFs like your ARKG, ARKK, ARKF. And these minimum investment amounts starts from just 50 Sing dollar a month, and there's no minimum commitment period. You can terminate and stop the investment anytime with no penalties. So currently, we are running a promotion whereby the ETF subscription fee is waived to the end of the year. Personally, I've started a few ETF RSP as this promotion is way too attractive to be missed. So I hope that everyone found this short session insightful. So feel free to reach us out if you have any questions or type your questions in the Q&A box below. I'll hand over the time now to Geraldine. Yeah.
Thank you, Katherine. We'll now proceed to our next presentation. Yeo Hui Shi, Equity Analyst, Stocks and ETFs Research, iFAST Singapore, will be sharing with everyone on FSMOne's ETF focus list around the world and different sectors with 50 plus ETFs. For those who are daunted by the sheer amounts of ETFs available, FSMOne has helped to highlight the best-in-class ETFs with the ETF focus list. In this session, Hui Shi will share about how we can pick the best ETFs and the latest changes to the list. Hui Shi, please.
Good morning, everyone. My name is Hui Shi. I'm an equity analyst from the Stocks and ETFs Research team. And I'm here today to take you around the world and different sectors with more than 50 ETFs from our ETF focus list. But before we begin the journey, there are a few things that you as an investor first need to know. So first of all, there are many different types of ETFs available on the market for you to choose from. And after knowing what your choices are, I'm going to show you a few factors that you should consider when you are choosing an ETF to invest in. And last but not least, I'll be sharing with you our ETF focus list, which is a list consisting of 51 best-in-class ETFs across various markets and sectors that can guide you through your investment journey. So without further ado, let's start with the types of ETFs. ETFs allow us to reach every corner of the market, and this table here summarizes the most common types of ETFs. Equity ETFs, they can track either an equity market, such as Singapore, or a particular industry, such as the US semiconductor industry. Fixed income ETFs, they track the bond market, which consists of corporate bonds and government bonds. Commodities ETF, they can track the price of a commodity, such as gold or crude oil. Other than that, there are also smart beta ETFs, as well as leverage and inverse ETFs. Currently, on our platform, there are over 3,000 ETFs from various exchanges for you to choose from. And with so many different options, choosing the right ETF could be an overwhelming task, especially if you are a new investor. Not all ETFs are made equal, and so I would like to share with you a few factors that you should consider when selecting an ETF to invest in. And this is also the selection methodology that we have used to select all the recommended ETFs in our ETF focus list. So when choosing an ETF, we consider both the quantitative factors and the qualitative factors. So firstly, under the quantitative factors, we consider the tracking difference, expense ratio, and liquidity. ETFs, they track an underlying index, and the first quantitative factor, tracking difference, this is the difference between an ETF's performance and the performance of its underlying index. Tracking difference is usually negative, which is in the case of this diagram here, as the ETF's performance, which is denoted by the red line, is slightly below the performance of its underlying index, which is denoted by the gray line. There will always be a tracking difference, and this is due to many different contributors, such as expense ratio, rebalancing costs, currency hedging costs, securities lending, so on and so forth. And if an ETF has a smaller tracking difference, this would mean that its performance is closer to the performance of its underlying index. And hence, we prefer ETFs that have a smaller tracking difference, as the primary objective of ETFs is just to simply replicate the performance of its underlying index. And the next quantitative factor to consider when selecting an ETF is the expense ratio. Expense ratio is expressed as a percentage of an ETF's average net assets. This is the annual cost that investors have to pay to cover for the ETF's operating expenses and management fees. And I have a table here that illustrates how the expense ratio can affect your investment returns. Let's assume that you put an initial investment amount of $10,000 in one ETF over a period of 5 years. And this ETF is able to generate an annual return of 10%. If the ETF that you invest in has an expense ratio of 0.5%, at the end of 5 years, you will find that your investment will be worth around $15,700. And this is after more than $300 has been deducted off because of the expense ratio. And hence, the expense ratio's impact on your returns after 5 years is actually around -2%. And you may notice that the higher the expense ratio, the greater the impact on your returns. And even a small difference in expense ratio can significantly lower your returns over the long run because of the compounding effect. And this is also why we prefer ETFs that have a smaller expense ratio, as assuming that everything else is equal, the lower your cost, the higher your net returns. And the last quantitative factor to consider is liquidity. Liquidity, it refers to how easy it is to buy or sell an ETF quickly without affecting its price. And unlike stocks, ETFs, they have 2 layers of liquidity, namely the primary liquidity and the secondary liquidity. So firstly, primary liquidity, this is determined by the liquidity of an ETF's underlying securities. One key feature of ETFs is that they are open-ended investments, so that they can always be created or redeemed whenever there is excess demand or supply in the market. But for retail investors who do not buy or sell tens of thousands of ETF shares, secondary liquidity will be more relevant for you. The secondary liquidity is determined by the volume of actual ETF shares traded. And this is also called the on-screen liquidity, which are your trading volume and beta spread. We prefer ETFs that are more liquid, which also means that they should have a higher average trading volume as well as a smaller beta spread. And so this will sum up all the quantitative factors. Now we'll move on to the qualitative factors, which are the choice of index and the structure of the ETF. So when choosing an ETF, it is important for you to know what you are getting yourself into. So you should be able to understand the index that the ETF is tracking. And the underlying index, it has to be a good representation of the market or the sector that the ETF intends to track. And knowing the top 10 holdings of an ETF will be useful as well, as it will be a good gauge of the ETF's underlying exposure. And you can visit the ETF fact sheet on our platform to view an ETF's top 25 holdings, as shown in this screenshot here. The next and final qualitative factor to look at is the structure of the ETF. An ETF can have either a physical or a synthetic structure. But majority of the ETFs out there, they are physical, which also means that they hold the actual underlying securities that make up the index that it is tracking. If the ETF holds all the underlying securities in the index, we call this a full replication. And if the ETF holds only a sample of the index, this is called a partial replication or representative sampling. Partial replication is usually used when there are liquidity issues or when there are thousands of holdings in the index, making full replication very difficult and costly for the ETF manager. So other than physical ETFs, there are also synthetic ETFs. Synthetic ETFs, they do not hold the actual underlying securities. Instead, they rely on derivatives such as swaps to execute its investment strategy. And this allows investors to gain exposure to illiquid and hard-to-access markets, such as commodities. And one point to take note is that as synthetic ETFs, they use derivatives, investors are actually exposed to counterparty risk. And we generally prefer physical ETFs, which has limited counterparty risk. And so this will sum up all the factors that you should consider when you are selecting an ETF. And this is also how we have selected all the recommended ETFs in our ETF focus list. So for the quantitative factors, consider the tracking difference, expense ratio, and liquidity. And for the qualitative factors, consider the choice of index as well as the structure of the ETF. And now I will show you a simple example of how we actually apply this selection methodology to our ETF focus list. Let's say we want to select the best ETF that tracks the Singapore stock market. The very first step will be to screen out all ETFs that track the Singapore economy, and then pull out all the relevant data, which are the 3 quantitative factors I've shared earlier: expense ratio, liquidity, and tracking difference. A score is then given to each factor as shown below. So the better the ETF has performed in each factor, the higher the score it will receive. For example, an ETF with a lower expense ratio will be given a higher score under this factor. We also assign a weightage to each factor based on their relative importance. And from here, a total score is then calculated for each ETF. And the ETFs are ranked based on their total score. We will then proceed to look at the qualitative factors, such as the choice of index and the structure of the ETF before making our final decision. In this example, it is simple. After considering the qualitative factors, we have chosen the SPDR S.E.A ETF as our recommended ETF for Singapore in our ETF focus list. So I hope now you have a better idea of how we have selected all the ETFs for our ETF focus list. And finally, we have reached the highlight of my presentation, which is on the latest edition of our ETF focus list. So to give you some background, we understand that there are many ETFs listed across various exchanges for you to choose from. And in fact, there are over 3,000 of them on our platform right now. And to help guide investors on their investment journey, we first introduced our ETF focus list in 2018. We have done all the heavy lifting for you. We sift through thousands of ETFs and then identified the best-in-class ETFs in our ETF focus list. And to ensure that our recommendations remain current and relevant for our investors, we have updated this list on an annual basis. So this year, it is no exception. We have made a couple of changes to the list in order to feature a wider range of ETFs that the world has to offer. So now this year, our ETF focus list consists of a total of 51 ETFs that provides you with exposure to various markets and sectors and can hopefully guide you through your investment journey. So now I'll be sharing with you the major changes that we have made to the ETF focus list this year. The very first major change is that we now have a new recommended ETF for China. Our previous recommended ETF, which was the Vanguard Total China ETF, has been delisted as Vanguard exits the Hong Kong market. Given its delisting, our new recommended ETF for China is now the iShares Core MSCI China ETF, listed on Hong Kong under the ticker 2801. It provides a good exposure to China. It tracks the MSCI China Index, which features large and mid-cap companies listed in mainland China, as well as outside of mainland China. And the key difference to note about this MSCI China Index is that it has a higher weightage to the H shares and ADRs and a lower weightage to A shares. And while the MSCI China Index may be different, it is still a good representation of the Chinese economy as it provides exposure to Chinese companies listed across various exchanges. And after considering quantitative factors such as liquidity and expense ratio, we believe that the iShares Core MSCI China ETF is the next best China ETF available on the market right now. And in last year's edition of our ETF focus list, we had 3 different ETFs for investors to gain exposure to China. There was 1 ETF each for China A share, China H share, as well as Total China. As our new recommended ETF 2801 already has a decent exposure to the H shares market, we have made the decision to merge the China H share and the Total China subcategories into the new China subcategory. So the choices for investors have been narrowed down to just 2 ETFs now. For a diversified exposure to Chinese companies, regardless of the country of listing, our recommended ETF is now the iShares Core MSCI China ETF 2801. And if you'd like to have a pure play exposure to onshore Chinese companies, our recommended ETF for the China A-share market remains the same, which is the iShares FTSE China A50 ETF 2823. And apart from our new recommended ETF for China's equity market, another major change that we have made is that we have added China government-centric into the fixed income category. China's government bonds, they offer much higher yields as compared to similar term-note government bonds issued by the developed economies. And this is keeping in mind that China has a sovereign credit rating of A+ by S&P. Apart from its high yields, Chinese government bonds also have a low correlation with other fixed income markets, and hence they can provide diversification benefits to any global fixed income portfolio. So with their decent yields and low correlation with global bonds, we believe that an allocation to onshore Chinese government bonds has become increasingly compelling. Our recommended ETF for investors is therefore the ICBC CSOP FTSE Chinese Government Bond Index ETF listed on SGX under the ticker CYB. Other major changes to the list this year includes our new recommended ETF for India under the single market category. The iShares MSCI India ETF, which is listed on BETS under the ticker INDA, has replaced our previous recommended ETF, which is a similar ETF listed on SGX. And the rationale behind this change is because our new recommended ETF, INDA, has higher liquidity as well as an expense ratio of 0.69%, which is much lower than the 1% being charged by our previous recommended ETF. And last but not least, we have made a couple of exciting additions into the tactical plays category. This category features some of our favorite investment ideas. And the first addition is the China real estate subcategory. China's growing urbanization rate is expected to support the demand for housing. And investors who are keen to invest in this sector can consider our recommended ETF, which is the Global X MSCI China Real Estate ETF, designed to provide exposure to large and mid-cap Chinese real estate companies. The second addition is China Semiconductors. This sector is about to enter a phase of supercharged growth as China doubles down on efforts in building up its very own semiconductor industry. Our recommended ETF is the Global X China Semiconductor ETF, which provides exposure to semiconductor firms listed in mainland China. The third addition is into the tactical plays category is digital payments. As the world shifts towards a cashless society, there is great momentum for the further adoption of digital payment systems. Our recommended ETF is the ETF MG Prime Mobile Payments ETF, tracking the performance of the mobile and digital payments industry. And some of its key holdings are card networks such as Visa and MasterCard. The fourth, which is also the last addition into our tactical plays category this year, is none other than the US banks. With rising inflation, rate hikes, they may be put forward, and this acts a major catalyst for the US banks' profitability. Our recommended ETF is the Invesco KBW Bank ETF. And so this will sum up all of the changes that we have made to our ETF focus list this year. And to view the full list of ETFs in our ETF focus list, please visit our FSMOne homepage and then go to the ETFs or the Research tab and click on ETF focus list. Our ETF focus list is also available on our FSMOne mobile app. You will then arrive at this page, and to navigate, you can switch between the 6 different categories that we offer, which are core equity, fixed income, regional equity, single market equity, commodity, as well as tactical plays. All in all, our ETF focus list, it serves as a good starting point for investors who are seeking diversified exposure to markets at a low cost, as the list helps you to zero in on the best-in-class ETFs. And you may notice that there are some ETFs from last year, such as the China H share ETF. It was not in this year's focus list, but if you're holding on to them, do not worry. They are still viable investment options for your portfolio, as they were merely beaten by a hair's breadth by a fellow peer. And like all the other ETFs in our ETF focus list, they will continue to be available under our ETF RSP list. And with that, I have come to the end of my presentation. So do check out our ETF focus list. I'll now hand the time back to our MC.
Thank you, Hui Shi. We'll now proceed to our first quiz of the day. 3 winners with the most accurate and fastest answers will walk away, or rather fly away, with 3 units of the ETF MG Travel Tech ETF each. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. Under the agenda, click on Quiz number 1. Click on the Join Quiz button, and the activity window will be displayed on your right. And once the quiz ends, a leaderboard will be displayed, and you may check if you're one of our winners. So on the Event Live page, look to the right side where it says Quiz, click on it, and we will start with a trial question. I hope everyone has been able to access the quiz. And when you're ready, we'll begin. So warm-up question 1, FSM ETFestival is organized by... Keep in mind that we're looking for the fastest and most accurate answer. I'm sure we all know this one. Good job. The answer is FSMOne.com. And now let's get ready for question number 1. Question 1. Which of the following is not available on FSMOne.com? The answer is option 3, automated ETF recommendation. If you didn't get this one correct, it's okay, because question number 2 is coming right up. Question 2, which one of the 4 destinations is not recommended by our macro analyst? Is it emerging markets, US, China, or Europe? And the answer is option 2, US. Again, it's okay if you didn't get this one right. You have 3 more chances to go. Question 3. The ETF focus list serves as That's a tricky one. The answer is option 4, a starting point for investors who are seeking to invest with ETFs. That is okay, because the next question is coming up. Question 4, which of the following is not a criteria used to select the ETF in the ETF focus list? Risk-adjusted returns, tracking difference, expense ratio, or liquidity? We're looking for the fastest and most accurate answer, so despite being fast, you have to be the most accurate as well. And the answer is option 1. question number 5. The minimum investment amount when investing via ETF RSP is it $1,000? Is there no minimum? Is it 1 unit of the ETF? Or is it $50? I believe Katherine went through this during her session. And the answer is option 4, $50. Good job to 74% of you. It's okay if you didn't do so good this time round because we have 2 more quizzes coming up throughout today. But good job to the top 3. So who are our lucky winners? If your results screen show rank 1, 2 or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number and daily quiz date to events@fundsupermart.com by 21st May to claim your prize. And that's it for our first segment, the pre-flight checklist. With helpful tips and guides by our speakers, we hope all your viewers are more prepared and confident to start their ETF investment journey. And we will now head for a lunch break, and the broadcast will resume at 12:30 p.m. right here as we head in the in-flight segment. If you have any questions regarding the presentations today, leave them in the Q&A section and we'll have our speakers address these questions later today. Before we head off for lunch, do check out the promotions FSMOne.com is running today. Receive 3,000 rewards points by opening a new FSMOne account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is TakeFlight with FSMOne. From now till the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSMOne.com, offers investors a starting point by identifying the best in-class ETFs. Check out the new additions to the list. And for more details, refer to the promotional article on FSMOne.com. From now till December, FSMOne.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Also, don't forget to accumulate chances for the lucky draw held today, where 5 lucky participants will walk away with $100 worth of Chris Shop vouchers, and 1 lucky winner will receive the grand prize of $880 worth of FSMOne multi-currency cash account credits. You can accumulate your chances by logging in. You can also accumulate your chances by participating in the quiz sessions. You can also accumulate chances by completing and submitting the survey today, or by visiting our partners pages and by sharing this event on your social media through the social media buttons on the footer. Be sure to join us again for even more exciting presentations starting at 12:30 p.m. and we'll see you later. Welcome back aboard, everyone. I hope you've managed to have a great lunch break. Get ready as we set off for more exciting ideas at ETFestival. Before we begin, I'd like to draw your attention to the promotions FSMOne.com is running. Receive 3,000 rewards points by opening a new FSMOne account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is Take Flight with FSMOne. From now till the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSMOne.com, offers investors a starting point by identifying the best-in-class ETFs. Check out the new additions to the list. For more details, refer to the promotional article on FSMOne.com. From now till December, FSMOne.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. The next segment will be the in-flight portion. In-flight will cover strategies that investors can apply when making their investments. Let's get strapped in as we begin. We will be starting with a panel discussion. Are fixed income ETFs your portfolio's life jackets? While air travel has an impressive safety record, safety equipment is never left on the ground. Life jackets are always available and tucked neatly under your seat. Likewise, in our investing, how do we ensure that we are prudently applying the time-tested principles of portfolio management by diversifying across asset classes? Joining us on the panel today are Adrian Tsui, Vice President, Sales and Product Strategy, CSOP Asset Management Limited. Kelvin Neo, ETF Business Development Specialist, Nikko Asset Management Asia Limited. And moderating will be Yeo Weiren, CFA, Manager, Stocks and ETF Research, iFAST Singapore.
Good afternoon, everyone, and thank you so much for joining us here at ETFestival. And for today's panel discussion, we're going to focus our attention on fixed income ETFs. And joining me today are 2 very experienced professionals in the ETF industry, Adrian and Kelvin. Thank you so much for joining us on this panel discussion today. Now, when we talk about ETFs, most of us tend to associate ETFs with equity and stocks ETFs. Fixed income ETFs, on the other hand, they tend to be neglected. They tend to be overlooked by most investors in their portfolios. And it's not surprising because fixed income is an asset class. It tends to be a boring asset class. And also in terms of the expected returns, fixed income investors probably won't be able to get as high a return as they would potentially get in the stock market. But despite that, there are still many investment merits associated with fixed income as an investment. So in today's panel discussion, I would like to just start off our discussion today by posting the very first question to Adrian. Adrian, fixed income is a boring asset class, doesn't generate as much returns compared to the stock market, but why should investors still consider an allocation to fixed income inside their portfolios?
Well, thank you, Weiren, for the kind question, right? So the reason why many investors will avoid or neglect fixed income is based on the simple fact that the minimum investment amount is actually 250,000 Sing dollars per trade, and that would actually set up a high bar that many investors will not even consider investing into the asset class. And having said that, they do not want to commit such a huge amount on a single trade. They also have, riding on a misconception that bonds are pretty illiquid and hence volatile. Now, they are missing out some of the benefits of fixed income, right? Fixed income gives constant, steady payouts. We call it coupons, right? And most of the time, distributions are set at every 6 months or semi-annually. So it gives you frequent payout as well. And because of that, investors are missing out on these benefits. Now, and fixed income ETF, which tracks a basket of performance of a bonds issued by various entities. Now, it slices up the investment amounts from $250 to a smaller, affordable size for investors, and that provides many other investors, such as retail investors, men on the streets, to invest into that fixed income as well. And having said that, it's in terms of pricing for fixed income is relatively transparent because it's traded like a stock on a stock exchange. So it provides again another access for investors to get into the asset class via an ETF in this sense. Yeah.
Thanks, Adrian. So I guess amongst the many investment merits, I think one of which you have highlighted is actually regular cash flows. I think diversification is probably also another key investment merits for fixed income investments. But for investors who are looking at fixed income and wondering how they should go about constructing a globally diversified fixed income ETFs. Now, most of us, we are probably not familiar with our fixed income markets. So for the next question, perhaps I'll get Kelvin to enlighten us. So Kelvin, for investors who are interested to start constructing a globally diversified fixed income portfolio, what do you think are some of the key markets that they should start off with?
Right, so thanks, Weiren, for the question. I think the best way for investors to construct a globally diversified bond portfolio would be really to construct one that mimics the reality. And the reality is that the biggest bond markets in the world today are namely the US, China. China is number 2. You have Japan number 3, and then some European economies, followed by some economies in Asia. And if you want to build that portfolio that is globally diversified, it should have those countries in there. Right? In terms of the segments that should go into the portfolio, I think one easy way is to look at it from a risk perspective, right? Along the risk spectrum. All investors should definitely start off with having exposure to government bonds. I consider them within the sovereign class, where the risk is very low. And then as you kind of build it up and take on more risk, moving on to, say, quasi-sovereigns, moving on to corporate bonds, which are essentially bonds issued by companies, and then moving on to take even more credit risks, let's say in the space of high-yield bonds, and those are the sub-segments that you can consider when constructing the portfolio.
Thanks, Kelvin. I just have one more follow-up question to what you just said. You mentioned reality. The reality in our current market environment right now is such that fixed income has had a very challenging environment so far in 2021 because of inflation fears. So could you also just share with us what is your outlook for the fixed income asset class, and do you also think there are still pockets of opportunity within the fixed income space?
Right, so it's a very relevant question. So really the biggest challenge in the marketplace today, in my view, and of course my investment managers as well, is really the risk of rising inflation expectations, which really translates into the possibility of higher interest rates. And that's what really hits the bonds really hard. So, if interest rates rise, bond valuations can come down, and that's really the risk that the market is seeing today. In terms of bright spots, we still see bright spots in the marketplace. I think specifically, in a rising interest rate environment, there are bond investments which gives you lower duration risk, meaning that there are bonds that they are less sensitive, to higher interest rates, so low duration risk. And the good thing here is that generally Asian credit bonds, as well as SGD bonds, meaning Sing dollar bonds, generally they have lesser duration risk compared to, say, government bonds. And this is a segment of the market that we think can be quite interesting for investors to look at.
Thanks, Kelvin. How about you, Adrian?
Yep,
Do you also see pockets of opportunities in today's fixed income market?
Certainly. Yeah. So I mean, just to echo Nikko's views, that on the flip side, our view is that right now, I think interest rate will stay low in the short term, and given right now in the low interest rate environment, we could, some of the potential areas that go for fixed income that provides better returns than what you're having in the saving banks, or saving returns in saving banks, right? And the key thing is actually without compromising the quality of the investment into the fixed income. And having said that, we should actually look at some of the credit ratings of certain bonds of at least A+. And like echo what Kelvin has mentioned, go for local currencies, Asia bonds such as Sing dollars denominated, and also Chinese government bonds. Yes.
You mentioned Chinese government bonds. I think this is a really interesting topic to talk about, because Chinese government bonds, they have been an outlier in the global bond markets today, because while the world is selling off, Chinese government bonds, they have been very resilient in terms of their performance in 2021. So perhaps back to Adrian again, could you also share with us what do you think are some of the key reasons that are attributable to the resilience of Chinese government bonds?
Certainly. So two reasons. One is actually, onshore Chinese government bonds is actually denominated in renminbi. So that is the strength that's where it's holding up the price in terms of the bonds, right? Due to the effective management by the Chinese government to control the COVID-19 situation in China, and with that, it resulted in a very strong fundamental within the country. So this is one reason. And having said that, that's the reason we could see, April trade balance coming in better than expected. This shows that they are able to, meet the demand is surge in demand for Chinese goods amid a global pandemic. So that's the first reason. The second reason is actually Chinese government bonds are offering higher yield of about over 3%. Now that is actually very attractive. And having said that, that's very attractive. It provides a price support. When investors who want to buy into access into the Chinese government bonds. So these are two reasons: very strong fundamentals, a strong renminbi, and also very attractive high yields that provide price support for Chinese government bonds.
Thanks for the insights. I think it's very interesting also, because Chinese government bonds, they are quite an interesting place to be in at this moment. And as Kelvin has mentioned just now, China is actually the second largest bond market in the world, just behind the US. But the reality in most investors' portfolios is that China is largely underrepresented in most portfolios, despite the bond market being the second largest market in the world. So I'd like to just pose the question perhaps to Kelvin. Kelvin, would you be able to share with us, based on your experience and also your interactions with investors, what do you think are some of the misconceptions or the barriers that prevents investors from wanting to invest in Chinese government bonds?
I think there is, the right word to use here is more of like timing rather than misconception. I don't think investors generally have a misconception about the Chinese market. They're cautious about the market, but definitely very little misconception there. Main thing is timing. Now, why do I say that? The Chinese market has been growing very rapidly over the past 3 decades or so. And they have come a long way. The economy is now probably second largest in the world, likewise for the debt markets. And the market is just starting to open up over the past few years. So what we are really seeing is that we are at an inflection point where China is opening up its debt markets, allowing more foreign investments to enter into the marketplace, and that creates an opportunity for international investors, globally. And really, this is the opportunity for investors to kind of tap on this new marketplace, new investment opportunity, that's kind of how I kind of see this rather than a misconception. It's really more of a timing issue.
What about you, Adrian? What are your observations in this area regarding the adoption of Chinese government bonds in investors' portfolios?
I think for a start, even though we have talked about the benefits of Chinese government bonds, giving up high yields and all, but I think right now it's access into the onshore Chinese bond market. I think recently with the Chinese 14 5-year plan, that's where they're going to open up their markets to foreign investors. I would say that there's still many red tapes, many hoops that even institutions investors have to jump to even get access to the Chinese bond market. And having said that, using our ETFs, just bypass all these loops. And so this is a misconception.
Yeah, I will agree with what Adrian mentioned, that there is a lot of red tape and a lot of processes involved for investors to assess the China bond market. Although they are opening up, there is also that mechanism in which you need to assess the market. And generally ETFs are a great way, a very convenient and easy way for investors to gain access to that.
I will stay with Adrian, and I will have a follow-up question for you because I think at this moment we have spent quite a bit of time talking about Chinese government bonds. And for investors who are still sitting on the fence and still wondering whether they want to get into Chinese government bonds or not, Adrian, my question to you will be, do you think investors should have an allocation to Chinese government bonds? If yes, what are the reasons?
So 3 simple reasons. High yield, good, strong credit rating, and diversification right now. On average, a 10-year Chinese government bonds are offering a high yield of about 3.2%. So that is the highest kind of coupon returns or yield versus developed markets government bonds. So that's actually very attractive. Second, like I did mention earlier, strong credit investment quality kind of investment into fixed income. And having said, Chinese government bonds are rated as A+. Now that is actually it's the same rating as Japan as well. And having said that, Chinese government bonds are guaranteed by the Chinese government. So looking at trade surplus, financially, Chinese governments are doing pretty okay versus the rest of the government. So, and they backed it up. They guaranteed the bonds that they issue. So that's another safety net. And third, diversification, right? The performance, in terms of performance and the characteristics of fixed income, Chinese government bonds characteristics, having very low co-relationship with the developed markets fixed income as well. So that present diversification benefits to investors. Yes.
I think Adrian has done an exceptionally good job in highlighting some of the investment merits of an investment in Chinese government bonds. Sounds good, but is it too good to be true? I think at this point, I'd like to also just highlight, perhaps to steer the conversation into talking about some of the potential investor concerns as well as risk areas related to Chinese government bonds. And that is when I bring Kelvin into this conversation. So Kelvin, I think Adrian just mentioned Chinese government bonds, they are rated A+ by the S&P. But at the same time, if an investor were to do a simple Google search on Chinese bonds, there is a very high likelihood they will find negative news headlines associated with a string of high-profile defaults. An increasing number of them are state-owned enterprises. So could you help our viewers to reconcile these two conflicting pieces of information and also perhaps some quick comments on the credit risk of Chinese government bonds?
Right. I think that was a very broad question, but I think the key point here for investors to understand is that not all bond segments or not all bonds are the same, right? China bonds fall into many different categories. If you remember earlier on when I was talking about globally diversified portfolio, I talked about a risk spectrum. I think investors that's really very important to understand. Government bonds are typically the safest segment of a bond market in any country, right? Because they are essentially explicitly backed by and guaranteed by the government. Now, there can be bonds that are more risky as you kind of take on more credit risk, and this segment of the market includes state-owned enterprises. Remember, state-owned enterprises are not the government. They're essentially different entities, so they do face a little bit more credit risk. And if you have read the news, you would have understood that in the Chinese economy today, the regulators are trying to tighten loan growth, right? Trying to tighten credit availability, and that tightening is done in a controlled manner, but nonetheless is resulting in some stresses in the credit markets and causing some defaults. So these defaults that are happening does not mean that the sovereign rating or sovereign status or health of the Chinese economy overall is under threat in a major way.
So based on what I'm hearing from the two of you, it seems that investors can safely assume that Chinese government bonds are a safe haven within a fixed income portfolio. But at the same time, for investors who want to invest in this particular segment, currency is a real risk because Chinese government bonds, they are denominated in RMB. And for most of us, Singaporeans, our base currency is actually the Sing dollar. So investing in Chinese government bonds actually introduces significant currency risk in our portfolios. So at this point, I want to ask Kelvin again, in terms of the RMB outlook, the long-term RMB outlook, do you have any comments that you would like to share with our viewers?
Sure. As a house view, we are positive on the renminbi from a mid to long-term perspective. We expect it to appreciate. I think right now it's trading at about 6.5 to the dollar. I think longer term you can potentially see 6.1 or even 6 renminbi to the dollar. I also just want to add in one point, given what Weiren mentioned earlier on, which is actually to define risk. I don't think the renminbi itself is risky, other than the fact that it is quite volatile. So the volatility can be quite high, and rightly so, given that it's an emerging market currency. But in terms of, it is definitely not risky in a sense that I absolutely do not believe that the renminbi regime will crash overnight. So investors should kind of maybe think about it from that perspective.
Yep. I would just like to add on to Kelvin's points that CSOP, our view is that renminbi has gathered a lot of pace last year, being the epicenter of the pandemic. They controlled it very well. There was a huge demand for renminbi. Appreciation in renminbi has actually appreciated a lot last year. And our view is that we still feel we are still having a good outlook for renminbi. But having said that, we felt that going forward, it will be actually a more like a gradual kind of appreciation, a more like slow kind of appreciation going forward for the currency. Yes.
Okay. Thank you so much for the insights. If I had all the time in the world, I would really want to just ask them all the questions that I have related to fixed income. So I'd just like to round up today's discussion with one final question for our two panelists. So for investors who are considering an allocation to Chinese government bonds, how much of an exposure should they have inside their portfolios? So maybe I'll get Adrian to answer this question first.
Thank you. So, it really depends on an investor's appetite, right? Do they want to look for higher return, or do they want to manage the portfolio's volatility? So it's really up to them. So we did a study by adding, just a good 10 to 20% into an investor's portfolio, and we have a portfolio of maybe Singapore stocks, for example. Now, it boosts up the returns a little bit because of the high coupons, and it also reduced the portfolio's volatility pretty much a lot. So it really depends, what the investor's appetite is. But we found that, by adding 10-20% is a very good mix to equities, a portfolio of equities. And, our ETFs, traded on stock exchange, is about 10 shares per lot. So it's about $140 per trade. So, many investors, retail or not, are able to use this ETF to just allocate 10 to 20% into their portfolio. Yes.
How about you, Kelvin? What do you think?
I think the ballpark 10 to 20% would sound quite right. The reason is because if you look at the size of the Chinese debt market, that's about 10 to 15 trillion dollars US. Globally, the total debt market would be about 100 trillion. 100 trillion. So that's roughly about 10 to 20% at the broadest level.
Thank you so much for your wonderful insights today. I think just to sum everything up, I think fixed income ETFs, they do have a place in all of our investment portfolios. I think our panelists today, they have mentioned a number of markets that you can consider for your fixed income portfolio, amongst them being the Sing dollar bond market, the US bond market, and we also had a very extensive discussion on the Chinese government bond market. And for investors who want to consider an investment in the Chinese bond market, a ballpark 10 to 20% is the recommendation from our experts to incorporate inside your fixed income portfolios. And with that, we have come to the end of our panel discussion on fixed income ETFs. And for those of you who want to get started with fixed income investing and you are not sure what ETFs to select for your portfolios, please feel free to check out our ETF focus list for a list of recommended fixed income ETFs. And with that, thank you for your time, and I will pass the time back to Geraldine.
Thank you, Weiren, and the various panelists. We will now proceed to the next presentation, where we will have Weiren share with us about the benefits of being a frequent flyer. In this presentation, Weiren will touch on utilizing regular savings plans to help you invest long-term. Let us once again welcome Weiren.
Hi, good afternoon, everyone. It's me again. The main topic of my presentation today is on regular savings plan, RSP. And very specifically, I want to share with everyone some of the benefits of RSPs, of using RSPs inside your portfolio, as well as highlight some ETFs from our ETF focus list that you can potentially, that you can consider for your portfolios if you want to begin an investment in ETFs. Now, to start off, I'd like to first talk about some of the benefits that are associated with RSPs. And the very first obvious benefit of RSPs is that you can get started with investing with very limited capital. Because with as little as just $50 a month, RSP actually enable investors to get started on their investment journey. And this is especially true for young investors who may lack capital to start their investment journey. And starting earlier has its benefits as well, because it means you have more time for your investments to benefit from the effects of compounding returns. And as a bonus, RSP also tends to come with lower transaction costs, especially if you transact with FSMOne. And this will translate into potential cost savings for the investors. Now, the second benefit associated with RSPs is that it provides you with a disciplined approach to investing. Now, when it comes to investing, probably we may have heard of this phrase, buying low and selling high. That's the key to generating profits from your investment portfolio. Now, to a certain extent, this is true. It is true that investors should buy low and sell high in order for them to generate profits. But the reality is that buying low and selling high, it's something that is very difficult to do, especially if you are an investor who lets your emotions control how you invest. RSP, this is where RSPs comes in to help investors to avoid this emotional investing, providing a disciplined way for them to get started in investing irrespective of market conditions. Because every month, what happens is a fixed amount of money will be deducted from your bank account to be invested in the ETF of your choice. There is no need for you to guess, and there is no need for you to be worried about missing out on potential investment opportunities. So it is a very disciplined approach to investing. Now, the third benefit associated with RSPs, and arguably the most important benefit, is that RSPs can help us to avoid market timing at the wrong times. Now, there will be a certain group of investors who come out and say that RSPs are actually not a good idea, because if you're able to time the market well, you can potentially deliver better returns compared to the investment strategy via an RSP. Now, to a certain extent, this is true, and this is true only if you are able to time the market well. Timing the market well is actually something that is very difficult to do. You may be able to time it well the first time, but to always time the market well on a consistent basis, this is something that is extremely challenging to execute, and not even investors like Warren Buffett can actually do market timing well on a consistent basis. So this is when RSP comes in again. And one thing to highlight is that RSPs, they can be especially useful in a bear market, especially when market conditions are extremely uncertain. And in a bear market, RSPs can actually help investors to mitigate their losses in downturns. And as you can see from the investment performance of a lump sum investment versus RSP in past market crises. If you're able to time it well, of course, your gains will be huge. But one misstep, one wrong step that you take in the market could potentially lead to huge losses for your investment portfolio. And this is where RSP again comes in. It helps to mitigate your losses in downturns, and it also leads to shorter recovery periods compared to, let's say, a lump sum investment during periods of market crisis. Now, for investors who are not familiar with ETFs, or if you want to get started with an investment in ETFs via RSPs, now the first place that I would recommend you to go to is actually our ETF focus list, which basically condenses a list of over 3,000 ETFs listed on our platform into a list of over 50 ETFs for you to choose from. So it is a very good starting point for those of you who are perhaps not familiar with all the available ETFs and you are just looking out for a low cost and a diversified way to gain exposure to all the different markets out there in the world. And you can also use this as a potential source of idea generation, or even use it to construct a portfolio of ETFs from scratch. And over the next few slides, I just want to highlight a number of ETFs that I think could potentially belong in your portfolio. And these ETFs could be a starting point for you to build a globally diversified portfolio. Now, the first ETF that I want to highlight is the Vanguard Total World Stock Index Fund. Now, if you just want one single ETF that can give you diversified exposure to all the key markets out there in the world, then look no further than the one by Vanguard, because this particular ETF tracks the performance of the FTSE Global All Cap Index, which also means that investors who are invested in this ETF, they will have exposure to a range of large cap companies, not just in developed markets, but in emerging markets as well, all in a single ETF. So it is a very straightforward way for investors to geographically diversify their portfolio. And if you already have an investment portfolio that is rather concentrated in Singapore-listed stocks, for example, then having this ETF in your portfolio will immediately give you diversified exposure to markets that are outside of Singapore. With over more than 9,000 stocks inside this portfolio, this ETF cannot be more diversified. And the bonus is that its expense ratio is only about 0.08%, which is extremely affordable and competitive in the world of ETFs. So in terms of the geographical breakdown of this ETF, this is the kind of exposure you are getting for your portfolios. About 60% exposure to North American markets, 17% in Europe, and the rest of the exposure is divided amongst Asia-Pacific markets as well as emerging markets. So it is a very diversified portfolio that gives you exposure to all the key markets out there in the world. But at this point, I just wanted to highlight also that if you look at the geographical breakdown of this ETF, about 60% is in North America, which also means that this ETF has a geographical bias towards the US equity market. So if you invest in this particular ETF, just take note that this ETF has a geographical bias towards the North American markets. And if you want to make this a more balanced and a more diversified ETF across all the geographical markets, you could consider adding an additional Asia-focused ETF on top of this Vanguard World ETF. And this also brings me to my next point. If you are on the lookout for an additional ETF to complement your exposure to the Vanguard World ETF, then my recommendation is actually the iShares Core MSCI China ETF. Now, I specifically mentioned China in my presentation because China is the second largest economy in the world right now, constituting about 16% of global GDP. But the thing is that China's stock market, similar to the bond market, it is massively underrepresented in investors' portfolios. And in global equity benchmarks, for example, Chinese equities accounted for less than 5% of the MSCI World Index. So this is a mismatch in terms of the size of the economy relative to the representation of its stock market in the global equity benchmark. And China is also classified by many market participants and index providers to be an emerging market. And I think this classification is, to a certain extent, a bit misleading because China's economy is distinctly different from other emerging markets. China is not a beneficiary of global growth in today's world. Rather, China is one of the key drivers of global growth in our economy today, which is why China is distinctly different from other emerging markets. And from our point of view, China's equity market should be seen as a long-term allocation inside all of our portfolios and can potentially be used to complement a globally focused ETF like the Vanguard World ETF, as highlighted in my slides earlier. Now, if you look at the details of this iShares Core MSCI China ETF, is listed on the Hong Kong Exchange. The ticker code is 2801, and this tracks the performance of the MSCI China Index, which we currently think is the most representative of the Chinese equity market right now. It gives you convenient access to Chinese companies that are listed on multiple exchanges. So not just on the Hong Kong Exchange, but you're also getting exposure to Chinese companies that are listed in the US, as well as companies that are listed in the onshore domestic stock markets within China, all in a single ETF. It has about over 600 holdings with an expense ratio of 0.2%, so it is very affordable. But just wanted to highlight that perhaps one of the downsides of this particular ETF is that if you look at the top holdings of this 2801 ETF, you realize that there is a huge concentration of holdings within some of the big tech names, which includes Tencent and Alibaba. And this also means that the performance of 2801 is going to be tied to the performance of Chinese tech stocks in the future. Now, another ETF that I would like to highlight in my presentation today is also a digital economy ETF, or what is commonly known in the investing world as technology-focused ETFs. And I specifically want to highlight this because I think technology-focused ETFs, they tend to be seen by many investors as high-risk investments, very volatile, and are only suitable for investors who have a huge risk appetite. But I'd like to argue that technology has a role to play in all of our portfolios. Before COVID-19 came along, the adoption of digital technologies has already been underway. And now we have COVID-19, and the adoption of the process of digital technologies adoption has simply been accelerated. And in the consumer space, we're seeing increased adoption of e-commerce, increased consumption of digital entertainment, and even in the area of digital health and wellness solutions, we are also seeing greater consumer acceptance. Businesses as well. Having an online presence is no longer a luxury, but a must for all businesses. If not, they run the risk of being eliminated from the industries altogether. And also to give you an idea of the size of the opportunity when we talk about the digital economy. The digital economy is worth about $9.5 trillion at this point. And if you see the digital economy as a standalone economy, it is currently the third largest economy in the world right now, just behind the US and China. And given its increasingly important role in the global economy at this moment, we tend to think that the digital economy has a place in all of our portfolios. And if you concur with our view, and if you are looking out for an ETF that can give you exposure to digital economy stocks, our recommendation for the digital economy exposure is actually the iShares Global Internet Giants ETF. Familiar to some of us who have always been following our seminars. So this iGig ETF is actually a rules-based ETF, giving investors exposure to digital economy stocks that have quality and growth characteristics. Now, what do I mean by quality and growth? The definition of quality, in the words of the ETF issuer, it refers to the cash burn rate of the companies relative to their revenues. Growth characteristics will simply refer to the revenue growth rate of the company. And because of the way the ETF issuer incorporates these two factors into its overall index construction methodology, you'll realize also that iGig actually gives you exposure not just to some of the big tech names within the technology space, but also to the small cap names as well. And you can see it from the top holdings of the iGig ETF. not only do you have exposure to some of the largest tech names in US and China, you also see names like Delivery Hero, Booking Holdings, and if you go further down the list, which is not highlighted in my slides over here, you also realize that it also has exposure to companies like Zoom and Shopify, companies which typically don't appear in a generic technology-focused ETF. So we like OGIG because it gives us exposure, or rather a very broad-based exposure to not just big caps, but to small caps as well. In terms of its portfolio size, you're looking at about 90 stocks inside the portfolio with an expense ratio of about 0.45%, which of course, when compared to a generic S&P 500 ETF, it is not the cheapest option out there. But if you compare OGIG relative to some of the technology-focused ETFs that are available in the market right now, 0.45% is actually very competitive and very affordable. Now, one of the most commonly asked questions by our investors is, how does OGIG stack up against its peers? And when it comes to peers, the two most mentioned ETFs to us is number one, the ARK Innovation ETF, and number two, the Invesco QQQ ETF. Now, I think for the record, I just want to say that all these three ETFs are fantastic products to have inside your portfolio. If you want exposure to the digital economy or technology space, you can select any one of these three available options. But the reason why we feature OGIG within our ETF focus list is because, like I said, it gives us very broad-based exposure to not just the small caps, but also to the large caps as well. And this is distinctly different from the other two. QQQ, it is also relatively diversified, but you also realize that it has a geographical bias towards the US stock market. OGIG, on the other hand, it has quite a fair bit of exposure to tech names that are outside of the US. What about ARK Innovation ETF? ARK Innovation ETF has had a very good run in 2020. And if you are a believer of Katie Wood's stock picking abilities, by all means, please go ahead and pick ARK Innovation ETF as part of your digital economy exposure in your portfolios. But OGIG is better than ARK Innovation ETF because it is more diversified. Whereas for ARK, it tends to make very concentrated bets in certain companies, which if market conditions favor these small group of companies, it could potentially lead to outperformance of this ARK Innovation ETF as we have seen in 2020. But when market conditions turn against the companies within this portfolio, you will also realize that this ETF also tends to underperform other ETFs as well, as we have seen currently in 2021. Okay, but of course, having said that, I think all three are viable options. If you just need one recommendation from us, our recommendation is OGIG. Well, I will also want to talk about fixed income because we just came out of a fixed income panel discussion. I will not repeat some of the points on my slides because we have largely talked about it in our panel discussion just now. So just to reiterate, fixed income should not be neglected in our portfolios because it provides us with diversification benefits. It also helps to preserve capital. And on top of that, it provides fixed income investors with a regular stream of income. And if you are looking for your very first fixed income ETF to add to your portfolio, then my recommendation would be to first go to the Sing Dollar investment grade corporate bond space, as what Kelvin has mentioned in the panel discussion just now. And our recommended ETF for this particular space is actually the one by Nikko Asset Management. It is currently the first and the only ETF in Singapore right now to give investors easy access to Sing Dollar investment grade corporate bonds. And the key selling point about this ETF is that it is very accessible. With just as little as $50 a month, investors can gain access to Singapore's corporate bond space, which usually is not accessible to retail investors because of the large blocks required in order for investors to invest in individual corporate bonds. And just another chart to illustrate the diversification benefits of having bonds inside your portfolio, and you also realize that the performance of Sing Dollar corporate bonds is a lot less volatile than the performance of the Straits Times Index. So certainly provide diversification benefits to our portfolios. And lastly, Chinese government bonds is something that you can also consider for your portfolios. I think some of the investment merits has been highlighted by Adrian from CSOP in the panel discussion just now. Higher yields, not just higher yields, but and on top of that, China's credit rating is at a very strong A+ by the S&P, which is similar to the credit rating of Japan, higher than Italy, and just 2 notches below that of the UK and France sovereign ratings. And even if you take into consideration the impact of inflation, China's real yield is currently one of the highest in the developed world right now, whereas most of the other developed sovereign bond markets, they are offering negative real yields. So if you want to consider an investment into Chinese government bond space, then our recommendation is the ETF by CSOP, which is also listed on the Singapore Exchange. It comes with an expense ratio of 0.25% and currently has an average yield to maturity of about 3%. And with that, I just wanted to wrap up my presentation today by saying that RSPs are a disciplined, a fast, free way for us to stay invested in markets irrespective of the prevailing market conditions. And one of the key selling points of RSP is that you can invest with as little as $50 a month. And for investors who want to get started on their investing journey, I've highlighted 5 ETFs that you can potentially consider for a start. But if you want a more comprehensive list, please feel free to check out our ETF focus list. And with that, I've come to the end of my presentation, and now I'll hand the time back to Geraldine.
Thank you, Weiren. Coming up next, we have Robin Choi, CAIA Vice President, APAC Strategist State Street Spider ETFs, State Street Global Advisors. He'll be sharing on going places with gold, enhancing portfolio performance with exposure to gold ETFs. Robin, please.
Good afternoon. Thanks for the kind introduction. So my name is Robin. As the MC said, I'm a gold strategist based in Hong Kong. So I recently read about the news in Singapore. So please keep safe, everyone, and hope the lockdown will be over soon in Singapore. So today, my presentation will focus on gold. So how to use gold as an asset class to improve your portfolio performance, especially with gold ETFs. For those who are not very, I guess, who hasn't invested in gold, some might think it's a jewelry product, it's a consumer product. But based on gold's historical history in the last 50 or 60 years, it has proven to be a very effective investment to enhance your overall portfolio performance. And today, for the next 20 minutes, I hope to share some of our view in terms of why investors should look into gold and how gold as an asset class will help your overall performance of your portfolio that you or your potentially your clients or yourself invest in. So today my presentation will be broken into 3 parts. Namely, the first part, the first session, I'll go through the case for gold in terms of why should investor hold gold as an investment. A lot of people see it as a jewelry, see it as a investment by, for example, central banks, for example, but as an individual investor or advising for investment, it's very important to understand the uniqueness of gold as an asset class. So I can share some of that with audience later on. And next part, I'll go through our latest key market themes that's affecting the gold market. So for those who are currently holding gold or hasn't really invested yet, we'd like to share our view in terms of what's the outlook for gold and what some of the factors, macro factors that we should be looking out for in the coming months that will impact the gold price trend. And lastly, I'll explain some of the ways to gain exposure to gold and look at some of the considerations and also the advantages of going through different products to get exposure to gold prices. So when you look at gold, I mean, as a Asian investor, every time I talk to an audience in Asia, I think people know what's gold, but a lot of people don't really dig down into the fundamentals of gold, because when you think about gold, it's actually quite unique in a way that it has a dual nature or a dual purpose in terms of gold is used by a jewelry demand, it's used by technology sector, but it's also an investment by investors, and central banks around the world do invest in gold as an investment. So if you look at the 4 sectors that drives gold demand and gold prices, you have clinical drivers, which means that during a economic positive cycle, you have more jewelry demand, you have more technology demand, which means that during a positive economic cycle, gold prices will go up because there's a lot of people buying more jewelry and technology. Obviously, that wasn't the case last year with the COVID situation and continue what's going on in present days. But last year, what drove gold price to record high was the investment and investment by central banks. So last year, investment through the counter-clinical driver did drive gold price higher last year, and also demand into gold was at record high through investment last year. So when you hold gold through different cycles, you actually benefit from different times. So during an economic positive cycle, you have jewelry and technology that comes in. During an economic downturn like last year, we have investment that comes in to support gold prices. So not many asset classes do have this attribute. So if you look at oil or copper or silver, they don't have this, I guess, this uniqueness of gold's true nature. So if you were to ask me why gold, why should one invest in gold? I'll say there's 3 main reasons. So you can see on the right is that gold provides a very effective risk management tool. It provides a very, very decent capital appreciation. And also it provides your wealth. So it provides a very good hedge against, for example, inflation. And we'll look into more details in the next couple of slides. So at State Street, we deal with a lot of investors, institutional pensions, intermediaries. The number 1 key reason why big investor invest in gold, because what they see as a very, very low correlations to many other asset classes. So number 1 factor for gold, why investors like it, because it provides a very effective risk management tool to hedge against your other asset classes. So if you look at the graph here, it looks at the 30-year correlation of gold with different equities, Japanese equities, US equities, and also bonds as well. So when we look at correlations, anything that's very close to 0, that's a very, very good correlation, which means that gold does not move in line with other asset classes. So for example, what we saw this week when the equity market corrected in the US, gold actually went up this week by about 3% because of these low correlations to equities and also bonds, you can see from these graphs. So it's very important when you invest in gold, you understand gold function. You can kind of treat it like a insurance for your portfolio, which means that if something happens to the market, gold has proven to be an effective hedge against what you're holding in your other asset classes. And one great example I can show you is that looking at gold's return through different, what we call the black swan events, where equity market has gone down more than 15%. Now, I use the US equity as a proxy because US equity is the largest equity market in the world. So we can actually see how gold can be an effective hedge against equities or global equities. So what I've done here is that I plotted the last 30 years when US equities was down by 15%, sorry. So you can see from the left, we have the GFC, we have the COVID situation, Black Monday, for example. And every time, or not every time, but most of the time that you see here is that gold will return a very positive return. So for example, during the GFC, when equity market was down 47%, gold was up by 12%. And more recently, as I mentioned, this week, equity market was down about 1% in the US. I understand the Singapore was down 3% because of the COVID lockdown. But gold this week actually outperformed most of the traditional asset classes like equity and bonds because a lot of money went into gold as a safe haven investment. So this demonstrates that when there's market volatility, when you expect there's an equity correction, then we advise investors to hold a allocation into gold, because what we have done here is that in most cases, gold has proven to be a very effective hedge against equity downturns. So we looked for or discussed about the risk management tool of gold. But one thing that surprised a lot of investors is that gold actually has a very decent return. So when you think about gold, people ask me why I should invest in gold because it doesn't provide a yield, which is true. But then again, gold doesn't provide a yield because there's no credit risk. So there's no risk involved or limited risk in holding gold. So that's why there's no interest to be earned. But if you look at the capital appreciation of gold in this chart, so you can see it in kind of the shaded dark green color, you can see that, especially if you look at the 20-year average return over the 20 years, gold actually registered about 9.9% capital appreciation every year. So on a 20-year basis comparison, it actually outperforms all other traditional asset classes like bonds, equity, commodities. And obviously the 10-year, it underperformed the global equities, but it still outperformed cash and also commodities. So it comes back to my point that gold, because it's driven by so many, I guess, different economic cycles, it's very important to hold gold over a longer term, like 10 years, 20 years, or even 30 years. So during different economic cycle, you have the jewelry, technology, central banks, and investment to drive gold prices, and also to drive gold demand throughout this longer periods. Another key point that why institutional investors like gold is because the trading volume of gold it's quite significant. If you look at the chart on the right, for example, gold is actually the 6th most traded asset classes in the world. And when you think, why is that important? Because liquidity for an investor is important. Liquidity is very important when you want to get in and get out of the asset classes. And it's particularly important when there's a market downturn, because when there's a market downturn, everyone wants to sell their assets. And when there's not enough liquidity, then your asset will be expected to take a hit. So during the GFC or even last year, a lot of illiquid assets got a major hit because investors couldn't sell when they needed to. And why is it important for gold? Because when you invest in gold, you want to use gold as the insurance for your asset classes. So if you need to sell your gold to, for example, cover your marginal losses for other asset classes, you can easily sell gold because it's so highly traded on a daily basis. Gold trade about 180 billion US a day, and you might wonder, because Bitcoin it's so happening right now. What's Bitcoin trading volume? Bitcoin trading volume right now is about 3 billion US. So if you compare gold and Bitcoin, gold actually trades about 90 times more than Bitcoin. So a lot of questions do come to us to go, can Bitcoin become the new gold? Based on this factor, you can't, because liquidity is not comparable when you hold gold as an asset class. So it's very important that investors understand that liquidity, it's a key attribute of gold when you invest in these asset classes, because it's traded on a very, very high substantial level. And also the wealth preservation of gold is that it provides a hedge against, 1, inflation, and 2, currency depreciations. So on the left-hand side, you can see gold performance during various inflation scenarios. So if you look at inflation when it's higher than 5%, gold average return is 16.2%. So we're looking at US inflation because US inflation actually dominates or has the most impact on the dollar and also gold prices. So we're looking at the US inflation here specifically. But as we gather more information about inflation right now, we know the US is having some pressure in terms of inflation. The CPI data came out this week that it was up 4.2% year on year. So inflation, it's a key risk for investors. So we are now advising a lot of investors that you should hold some gold because inflation are coming back. So it's very important with all these policies that the government, central banks are pushing out. Inflation, it's going to be increasing in the future. So if you look at gold's historical function as a hedge against rising inflation, it provides a very, very good hedge based on the average return for each scenario. And on the right-hand side, if you look at what I'm trying to show you here is that I'm trying to show the fiat currency versus gold in terms of the depreciations. You can see that if you look at all other major currencies, the US, Euro, Japanese yen, and pound, it has all depreciated against gold. So if you look at gold at 100 level, throughout the last 100 years, fiat currency has actually depreciated a lot against gold. So a lot of investors that invest in gold, they invest in gold because they are worried about the fiat currency, the money pumping, the potential supply of money that will have impact on the fiat currency valuations. Because gold cannot be printed, it needs to be mined every year. This concept sits very well with investors which might, they have a very large holding in fiat currency. So that's where one factor that is very important to understand, that gold can provide a very, very effective hedge against currency depreciations. So if we put everything together, so we discuss about the risk management, the capital appreciations, the wealth preservation. So what does that mean for an investor? So as I said earlier, when you invest in gold, you need to invest in gold as a strategic asset classes. So don't look at gold as a single asset class that you expect to go up 10% every day, for example. You should look at overall in terms of your portfolio, what you're investing other than gold. So here we've done a lot of analysis surrounding where you put 10% allocation into gold into different types of portfolios, ranging from conservative, which means that there's 20% into stocks, 80% into global bonds. Aggressive means you have 80% into stocks, 85% into stocks and 50% into bonds. So what you can see here is that as you increases your exposure to equities, and when you invest 10% in gold, it actually reduces your portfolio drawdowns throughout the last 30 years. So for example, we look at aggressive. If you had invested 10% of gold in that portfolio, you would have reduced your overall loss during the last 30 years by 5%. And that 5% is huge because that's 5% of your overall portfolio. So gold, by having 10% of that allocation, plays a very powerful function in your portfolio by reducing the maximum loss and also what we call increasing the risk-adjusted return of your overall portfolio. Another question we always get is, okay, I understand the concept. What's the allocation that we should advise to invest in for investors? Our advice is that we always encourage a strategic allocation, which means that you hold gold for a long term. And the allocation can sit within 2 to 10% of gold into your portfolio. So which means that if your portfolio is worth $100, then have about $2 to $10 of gold in your portfolio, because this graph might look complicated, but we've done a lot of back testing surrounding that. Depending on what portfolio you hold, the optimal allocation is between 2 to 10%, because this chart looks at the change in the risk-adjusted return. So if you look at the graph here, when it flattens out, that means that's the max ratio you should have. So if you look at the aggressive portfolio, it flattens out at about 10%. So if you have, for example, 85% into equities, 10% into bonds, then you should have 10% of allocation. So there's no right or wrong answer. It's just a benchmark for you to consider. We have investors that invest over 10%, and that's reasonably fine. But when we say, well, when they invest over 10%, we call that tactical. So you might have a 10% strategic, and over the 10%, you can have that tactical allocation that you can change on a daily basis. But on a strategic basis, we always encourage to have 2 to 10% of your overall. Then you can rebalance it on a quarterly basis or on a yearly basis as well. So to conclude what I was trying to say in the last couple of slides, so gold is a very, very powerful strategic asset because, one, it provides diversification that we went through, low correlations. Two, returns, as we saw over a 20-year basis, about 9% return on a yearly basis. Huge amount of liquidity, which is important given potentially there's a market correction. We saw some correction this week and in May, so that's something to look out for, needing something to have highly liquid to trade. And also lastly, we went through a very, very simple exercise of that gold can have a huge positive portfolio impact to your portfolio. So this is the 4 core reasons we talk to institutional intermediaries and also investors we talk to. This is the core stepping stone why you should invest in gold. So I hope I convinced some of you to look into gold at the meantime. So in the next couple of slides, I just want to go through the outlook for gold, because for investor, obviously, it's very important to understand how gold will trend in the next couple of months, and also for those tactical investor that want to trade in, trade out on a daily basis. Obviously, this graph looks at gold price since last year, and gold price did reach record high last year because of the COVID situations. But then since September, it has been trending down because of the global vaccinations, globally, a drop in cases between September and January, and also investors becoming more risk on because economic growth was improving notably in the US and also Asia. But in March, what we saw is that gold was able to, I guess, form a very strong supporting level at 1,700. So we're quite comfortable that gold price has set a very, very strong level at this level, because during March, it was unable to break below that level. So I'm very confident to say that gold will be very difficult to, I guess, go below that level unless US dollar or the Fed increase interest rate, but that's not going to happen. So what we're seeing right now is gold price is about 1830. So it's actually gaining a lot of momentum right now. So if we look at all the technicals, it's trading above its 50 and 100 days moving averages. So if you ask me now, the technicals are definitely a lot better than a month ago. So just watch out, because I think, particularly next week, I think a lot of data or continued correction in the stock market will continue to support gold prices, because investors need gold as a hedge against market uncertainty. But over the longer term, why I encourage investors to hold gold at least for the next 3 or 4 years, because we know that the rates, it's going to be very, very low in the US. In the US, we already know that the Fed won't increase interest rate until 2024. So low interest rate, zero interest rate will always benefit gold price because it lowers what we call the opportunity cost of holding gold, because there's no yield elsewhere. But what we're seeing right now is that inflation, it's rising very quickly. So if you look at the chart on the left, we are looking at the 10-year US Treasury yield and also the 10-year inflation expectation. And throughout the last couple of months, the inflation expectation in the US has been rising really quickly because of the continued monetary policy adopted by the US and also the fiscal policies that adopted by the Biden camp. So they're pushing out trillions of fiscal policies. So inflation expectation has been on the rise, and that's true because we saw inflation figures this week in the US was one of the strongest we've seen in recent years. But what this means is that when inflation goes up faster than the Treasury yield, the real yields actually stays down or stays negative. The number one fundamental driver, if you look at gold price for the last 30 years, 40 years, is the real interest rate, which means it's the nominal yields minus the inflation expectations. So if you look at the graph on the right, you can see that the real interest rate in the US, it's negative. It's around -1, which is close to its historical low. So low real interest rate will continue to benefit gold prices. And at State Street, we continue to see low real interest rates in the next, at least into end of this year or next year. And negative yield rates support gold price and also support investors rotate out of bonds and cash into gold. And we have many investors that we talk to that they're rotating out of bonds because they don't want to hold negative yield bonds and they rotate into gold. So that's why we're actually quite confident fundamentally because of this reason, gold demand will remain quite strong through the investment space, and that will continue to support gold prices in the near future. Another key factor we think will have a very positive impact on gold is that we know that the debt levels are rising everywhere. So if you look at all the major central banks balance sheets on the left-hand side, so Bank of England, Japan, Europe, and also the Fed, you can see the debt level has been rising. And that's something might not be concerning for now, but fundamentally it should be, because if you look at the debt levels since COVID, the unlimited printing by government to support the economy and also to support, for example, the stock market, this will be I guess, a tailwind for gold over the long term. So the rising debt level and also liquidity will be very beneficial for gold. And also on the right-hand side, you see a US budget deficit against the gold price. So what you can see is that on the blue line, the US budget deficit as a percentage of GDP, it's close to about -18%, which means that the US or the Fed, or not the US, the Biden government has been pushing many fiscal policies to the point that the budget deficit, it's at historical high in negative terms. And this is actually very concerning for some of the investors that look into this data because the increasing budget deficit will put a lot of pressure on the US dollar, which in turn will benefit gold because the US dollar and gold price has a very strong inverse correlation historically. And that's why you can see on the right-hand side of this chart, the declining of budget deficit has been very beneficial to gold in the last 30 or 40 years. So that's some of the factors and indicators we're looking very closely and try to, I guess, voice this concern to investors, because this trend will definitely impact the dollar in terms of the trend, whether it will go upward or downwards in the future. So the last two slides will come back to the point that the US dollar will continue to be weakened, because rising inflations, rising debt level, rising central banks' debts will put a lot of pressure on the dollar. And as I mentioned before, if you look at the left-hand side, the graph, it looks at gold's correlation dollar throughout the last 40 years. And you can see the correlation fluctuates throughout the last 30 years. But at the current junction, the negative correlations, it's about at 0.4 negative. So which means that when the dollar goes up, the gold will go down, but dollar goes down, the gold price will go up. So at this current junction is close to its long-term average correlation. So at State Street, we believe the dollar will continue to weaken. And I think we are quite confident it will, because of the low interest rate, of the inflation factor, budget deficit. And when you think about US dollar weakness, some of the question we get, okay, I believe the dollar will weaken, so what should I buy to hedge it? So what I've done on the right-hand side is that we looked at every single US dollar bear market and bull market, just for your reference, comparing asset classes like gold, commodities, S&P 500. So if you look at US bear market, historically, what tends to do well the most is gold. So on average, when the US dollar is down by 28%, on the left-hand side, gold on average accumulated return will be 142. So these are very, very powerful message to show that if the dollar continues to weaken, gold will benefit the most. And a lot of investors right now are holding gold because of this factor, because they expect the dollar will continue to weaken. And for us sitting in Asia, Hong Kong and Singapore, it's very relevant, because where I'm based in Singapore, my currency is hedged or pegged to the USD. So I have to make sure I invest in some gold to hedge against my Hong Kong dollar depreciation, for example. So for local investors like us, if you expect the dollar to be weakened, then you might look into gold, for example, in Singapore dollar currency term to hedge against the potential weakness in the dollar. So the last slide, I just want to wrap up. So hopefully I was able to convince some of you to look into gold, because I truly believe right now is a very, I guess, attractive point to look at it, because gold this month, it's already up 4%, purely because of investors going more risk off. And we believe the next, I guess, testing level will be 1850 next week. And if that happens, we'll be retesting 1900 again. So that's something to look out for some of the investors right here. But to get exposure into gold, there's so many ways. So on this table, you can see there's 6 ways to literally get exposure to the gold prices. So you have paper gold, bars and coins, mining stocks, gold futures, mutual funds, and gold-backed ETFs. But from our perspective, we do encourage investors look at gold-backed ETFs. So ETFs that traded on, for example, the Hong Kong Exchange or the SGX, because gold-backed ETF is one of the most transparent and cost-effective way to invest in gold. So gold-backed ETF trades like a stock, so you can see the price, you can see the trading volume. But what more importantly is that gold-backed ETF is fully backed by physical gold, which means that each share of your ETF has gold backing the shares, and the gold will be hosted in a very secure vault, maybe in Singapore, in London, or in New York, for example. And one of the benefits of gold-backed ETF is that you don't have to worry about the transportation and storage costs. And why I say that, because for those investors that invest in physical, one of the main consideration is that you need to store the gold, and you need to put the gold somewhere safe. So for investors that might have very substantial amount of gold, this is one of the most factors they need to consider, where to put the gold. But with gold-backed ETFs, paying a very, very relatively cheap price, that will cover the consideration of all other vehicles that I mentioned here. And lastly, I think gold-backed ETF, because it's one-to-one correlations to gold prices, so you get this perfect tracking to the spot price of gold if you want to invest in gold as a strategic allocation, or either tactical allocation as well. So I believe my time is up. Thanks for the time today. I hope everyone did find out more about gold investing and how you use gold as a hedge against the equity market. And I hope you enjoy my presentation. Thank you very much.
Thank you, Robin. It is now time for our second quiz of the day. 3 participants with the most accurate and fastest answers will win 3 units of the ETF MG Travel Tech ETF. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. And under the section Agenda, click on Quiz number 2. And then click on the Join Quiz button. The activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed and you may check if you're one of the winners. On the Event Live page, look to the right side where it says Quiz, click on it, and we will start with a trial question. I hope you're all able to access the quiz. We'll start in a few seconds. Starting with a warm-up question, what was FSMOne.com previously known as? If you know our email address, you will know what the answer is. The answer is FunSuperMart. Good job to 74% of you. Now that we're all warmed up, let's get ready for question number 1. Which of the following statements about fixed income's role in a portfolio are false? The answer is option 4. Keep in mind we're looking for the most accurate and fastest answers, so even though you have to be fast, do read your options very carefully. Question number 2. Which of the following is a benefit of a regular savings plan? And the answer is option 4. The majority of us got it right. Good job. Question number 3. Which of the following ETFs is included under the commodity sector in the 2021 ETF Focus list? Fastest fingers first. The answer is option 1. 50% of us got it right, 50% of us got it wrong. It's okay because there are 2 more questions to go. Question number 4. Which of the following are not fixed income sectors? And the answer is option 3, real estate investment trusts. The final question is coming up. Let's all get ready. Question 5. In the benefits of being a frequent flyer session, which of the following ETFs is not included in the RSP portfolio? Choose very carefully. And the answer is option 4. If you missed out on this one, it's okay because we have one more quiz coming up. If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score, and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 21st May to claim your prize. And with that, let's get ready to explore some destinations. In this destination segment, our guides will share with you on some global ETF opportunities for investors to explore. Look forward to presentations on other opportunities in Asia, the global banking sector, as well as some up-and-coming global trends in the technology and entertainment space. There will even be a tour in China as our guides share with you about the semiconductors, real estate, healthcare, financials, and technology sectors. Starting off our presentations for this segment will be Stephen Cheung, Associate, iShares, BlackRock, and Gladys Liu, Associate, L Investment. Their topic today is Asian High Yield. Ready for takeoff? Stephen and Gladys, please.
Thank you very much. Hi everyone, my name is Stephen and I'm part of the BlackRock iShares sales team covering Hong Kong and Singapore. And today I'm joined here with Gladys Liu.
Hi everyone, quick introduction. I sit in the fixed income product strategy team at BlackRock Hong Kong, primarily working with institutional clients on ETFs or index solutions across Asia ex-Japan.
Thank you, Gladys. So today we are here to talk more about our iShares Barclays Asian High Yield Bond Index ETF. As the name suggests, its exposure covers Asian high yield, predominantly covers China, which makes up around 48% of the ETF. So before we go into the nitty-gritty details, let's talk about the bond ETF market, and then Gladys will talk about the overall market outlook for Asian high yield. Thank you, Gladys. So there are 5 reasons why we should be looking into investing into bond ETFs. The first one is, of course, the tight tracking. So as many of you know, tight ETF plans to track the benchmark index as closely as possible. And as we look back in down memory lane, in March 2020, our flagship iShares fixed income ETFs continue to track their indexes tightly despite the huge market volatilities that we saw globally. Another benefit of using a bond ETF is to use them as an efficient building block. So when you're building your own portfolio, whether it be a core or satellite portfolio, it's very important to use as low cost and efficient building blocks to construct that portfolio as productive and fundamentally stable as possible. Third reason is for cost effectiveness. As we all know, ETFs are known for its low cost usage for building portfolios and also a low cost in terms of holding the management fee. Third, diversification. It is very, very easily, you can get diversification to over 20,000 bonds by just buying a single ETF. So cost-wise, again, it is a lot cheaper to buy just one single ETF versus buying a whole bunch of bonds to get that same exposure. And fifth, transparency. ETF adapts a daily NAV calculation where you can actually see all of the underlying holdings and all of the net asset values of the underlying right away. All right, if we could please move on to the next slide, please, Gladys. Thank you. So now looking at the overall size of the fixed income market, we can see that in the ETF space is actually very underpenetrated. So by comparing to the fixed income and the equity market, in terms of AUM globally, the fixed income market is more than twice the size of the equity market, which is hard to believe because everyone seems to be talking about the equity market on news, on market strategists, everywhere. If you turn on the news, it's always about the equity market more than fixed income, which is very, very interesting given the size of the two markets and the huge difference between the two. So for fixed income, globally, the AUM is 104 trillion USD versus the equity market where it's only 40 trillion USD. So now, if you were to translate that into ETF usage, fixed income ETFs only make just over 1% of the investable universe of fixed income assets. So roughly 104 trillion in global fixed income assets, and only 1% of that 104 trillion is in ETFs. So it's a very minuscule part of the global fixed income market that sits in ETFs. So with fixed income ETFs at 1.3 trillion roughly in AUM today, we predict that it could reach to 2 trillion by 2024, meaning that if you were to buy fixed income ETFs right now and ride on that momentum, you know, the rate in which that the ETFs will grow will grow substantially and possibly returns as well. With that, I will pass it off to Gladys to talk more about market outlook. Thank you.
Thanks, Stephen. So the case for bond indexing is pretty clear. We want to be able to reap the benefit of diversification with bonds and at the same time be able to access them efficiently rather than, say, through many single line bonds with high minimum capital requirements to build our portfolios. And therefore, ETFs are much more efficient vehicles that allow you to trade bond exposures of your choice like a stock on exchange. Now that we have some context around indexing, we can also get into the discussion of Asia high yield itself. So just a bit of background, the high yield bond market in this region has grown quite quickly over the last 10 years. High yield bonds lie across the other end of the risk spectrum from investment grade or higher quality bonds. So if you really want to look into credit ratings, high yield is typically the range below BBB. And overall within the Asian US dollar bond market, high yield accounts for about 25%, so about a quarter. Whereas investment grade or higher quality bonds make up the bulk of the Asian dollar bond market. Now, within high yield, the majority are corporate issued, with only about 10% being sovereign, which makes perfect sense for a higher risk sector. We're still seeing very robust issuance of Asian high yield bonds as of this week and also year to date. Another thing to note that Stephen also mentioned earlier would be that China comprises about half of the Asia high yield bond market. And when we talk about, investing into an Asian dollar high yield bond index, for example, there's likely to be overweights to Chinese issuers. So with that in mind, we think the macro backdrop is supportive for Asian credit. If we look at the overall market, emerging market Asian economic growth forecasts are stronger than EM Europe, developed markets, and even Latin America, as you can see on the chart. So Asia's growth rate is expected to be around 8 to 9% this year versus under 5% for overall developed markets. And that optimistic projection is based on the rapid recovery of the region so far on the back of COVID, particularly in North Asia, which is quite clear from economic data in Q1 and year to date. And then looking at manufacturing data on the right, Asia PMI has definitely rebounded strongly year to date, and the region's recovery rate has historically been relatively high among major markets globally. Obviously, these vary across sectors and also across geographies within the high yield market. But if we look at Asia as a whole, and the fact that China consists of 50% of the high yield market, and the country has seen strong recovery in economic fundamentals as social distancing restrictions are gradually relaxed in the country. That looks about right. And Asia is, compared to other regions, relatively on track. So moving on to valuations, which is the exciting bit, and the returns of Asia high yield specifically. The BlackRock Investment Institute has been overweighting and favoring Asia fixed income this year. We still think that the asset class is attractively valued, while the region is further ahead in the economic restart. US high yield in comparison, as you can see, is more expensive at the moment, and we think there is more upside for Asia bonds. In addition to that, Asia fixed income also definitely acts as a much greater source of yield over US or non-Asia emerging bond markets. If you take a representative index of Asia high yield, let's say the Bloomberg Barclays Asia Dollar High Yield Diversified Credit Index, for example, it's currently yielding about 6 to 7% versus US broad market high yield indices, which are roughly 4% or even less at the moment for some indices. So investors essentially don't have to take additional credit risk to achieve higher yields or returns within the same sector if you invest into the Asia high yield bond market through a representative index versus buying US high yield bonds, for example. And then for investors holding both stocks and bonds, Asian high yield or even Asian credit on the whole tends to have stronger risk-adjusted returns versus the broad market Asian equities. Now, we've seen that in the past week when there was more volatility across stock markets, but this in fact is a trend that we've seen over the past decade as well. So moving on, amid all of that upside, we want to understand the risks involved as well. And what we think, nevertheless, is that corporate credit metrics in the Asia high yield market has been improving. If we assess risks based on corporate issuers' ability to pay off interest expenses, we do see a higher coverage ratio, which means conditions have improved over time as a result of stronger earnings from these Asian corporates overall in recent years, whether it's due to structural trends or tech advancements. And interestingly, interest servicing has actually proven to be quite stable even during 2020. It's also worth noting that Asian high yield default risk remains lower compared to other regions like US and EM high yield sectors, as you may see on the chart on the right. So default rates is always a metric to look at, particularly as it tends to be correlated with the economic cycle. So for example, this would be especially concerning last year when COVID hit and economic repercussions were sort of reflected through to corporate performance. And as we all know, discussion of corporate bond defaults tend to be on media headlines and definitely on investors' radar as we try to do due diligence and try to manage credit risk. But what we have seen so far, at least in relation to Asia or China, is that events year to date appear to be idiosyncratic and not really systemic across the market. So for this year, the market is forecasting default rate of 2.4% for Asia high yield versus 3.4% last year when the more economic sensitive sectors were impacted. And we can see similar trends across other markets with Asia being more favorable to US in comparison, which is expected to see around 4% in default rate this year. Now, having said that, when investing into sectors on the riskier end of the spectrum, as we talked about before, indexing helps you diversify that risk because you're invested into a few hundred bonds at the same time through an ETF, and therefore you're less exposed to individual defaults or events that are unique to one particular corporate issuer, but you can still benefit from the yield as you favor the overall sector and also achieve diversification across individual risky assets or individual bonds. And so we can't stress enough the benefits of indexing and also adopting ETFs into your portfolio, especially when you prefer to target higher yielding sectors of the bond market. So overall for this year, compared to investment grade or other parts of the bond market, Asia fixed income definitely stands out, we think, as an attractive investment against volatility and also just given the lower yields globally. So finally, we touch on portfolio building, especially for investors who are keen to have bond exposures or buy higher yielding bond funds for diversification, such as amid the equity volatility. And while we want to diversify, this chart reflects just how low government bond yields have gone historically across major global developed markets. Yields in DM or developed markets have gone quite low. This makes it difficult for some investors to sort of strike that balance between yield and also diversification. So it's especially painful for institutions like pensions or insurers to secure medium to long-term meaningful yield in risk-free assets like DM government bonds. We did see some volatility in US Treasuries in Q1 where yield spiked briefly and it's now stabilized at around 1.6%. But in terms of our latest views, we're underweight. We don't favor nominal government bonds because of their inability to really act as portfolio ballasts. In other words, DM government bonds often don't have as much capacity as they used to cushion for that volatility anymore. We're also expecting short-term US rates to stay near zero. So if we have to pick something in the government bond space, we would venture out of developed markets and perhaps favor Chinese government bonds as the 10-year is yielding 3% at the moment. But otherwise, what we like at BlackRock at the moment are emerging markets or high yield products within fixed income. So some parts of these markets we think are more attractively valued. And on the whole, this is very much in line with the market narrative of hunting for yield in a volatile and also low rate environment. And today, of course, we're here to discuss Asia fixed income, which we think makes sense in this environment for the many reasons that I discussed previously. So we mentioned earlier the efficiencies of using ETFs and indexing bonds. So the question now is, how we can actually implement this as individual investors. So I'll pass it back to Stephen to discuss our iShares offering.
Thank you very much, Gladys. So if we were to look at the current slide, it kind of outlines the current ETF offering that we have. So this is the AHYG, Asian High Yield Bond Index ETF. It is listed on the Singapore Exchange, and it has a total expense ratio or management fee of 50 bips or 0.5%. The base currency is in USD, and the ETF holds roughly 352 holdings. So speaking more about the ETF itself, right, what makes it special? As Gladys mentioned, developing the business case for this and investment case for this, AHYG aims to provide higher yield and lower volatility and lower default rates relative to other DM and other EM exposures. So as Gladys also mentioned before, currently the US high yields market is yielding around 4% or even lower. And even EM, emerging market high yield, is yielding around roughly 4% as well. In contrast, AHYG, our ETF here, the yield is roughly 6.8%, duration around 2.8, and a 3-year standard 3-year volatility standard deviation of 2.88. So what's inside the AHYG, as many would probably ask, which is a very good question. So majority of the underlying holdings sits in industrials and also sovereign as well. So sovereign as in banks. So AHYG offers exposure to a representative universe of more than 300 high yield bonds, thereby also reducing the idiosyncratic risk of holding individual bonds. And in terms of some names that the bond holds would be China Evergrande or Win Macau as its underlying portfolio. And by high yield, we classify high yield as ratings that are below BB and BB or below. And roughly the fund here has almost 40% in BB and 35% in B-rated bonds. AHYG is also a very transparent and extremely cost-effective way, as mentioned, with a 50 bips total expense ratio in accessing Asian high-yield bonds. If you think about it, you're basically only buying one single ETF to get 352 underlying bond exposures, which is a pretty good deal if you ask me. Lastly, if we're to look at the country exposures, so as mentioned, China takes about 48% of the underlying ETF exposure, and it's focused mainly on China, Hong Kong, India region, and the remaining countries, as shown on the slide, include Indonesia, South Korea, Macau, Malaysia, and the rest. But in retrospect, it is very Chinese-dominated Asian high yield, and as Gladys before, our house view and investment case very much supports China bonds. With that, that is all from me. I just want to say thank you very much again for everyone joining in on this presentation, and I hope it has been very insightful and provided you with more insights onto Asian high yield. Thank you.
Thank you, Stephen and Gladys. Don't go away, as we'll be back shortly with our next presentation. Oh my God. Oh my God. Next, it's time for an important part of flying that most of us can't do without: in-flight entertainment. Let us find out how to explore a whole new world with eGames and global internet companies with Jermyn Wong, Head of Asia ETF Business Development, Product Development Director, Nikko Asset Management Asia Limited. Jermyn, please.
Thank you, Geraldine. Good afternoon, ladies and gentlemen. Welcome to your in-flight entertainment. My name is Jermyn Wong, and I am the Head of Asia ETF Business Development at Nikko Asset Management. Thank you for tuning in. Today, I will be sharing with you some interesting insights into the global internet and e-game sectors, which in my view has got high growth potential, presenting a compelling investment opportunity. Let me tell you why. But first, let me load you your in-flight entertainment screen that you see right here, Global Internet and eGames 2021. Before I start, I'd like you to take 10 seconds to guess what happens on the internet in 10 seconds. I just counted 10 seconds in my head. Let's see what happened in that 10 seconds. In that 10 seconds just now, felt short, there were over 1,100 packages shipped by Amazon. In that 10 seconds, there were over 166,000 US dollars spent online. And in that 10 seconds, 67,400 hours watched on Netflix. Now that actually translates to 24 million people watching Netflix at any one point in time. That's 4 times the population of Singapore. I mean, that's huge. So this pictograph here really shows what happens in a minute of every day that goes on the internet. These are astronomical numbers. And with all these numbers, this is certainly an area which I would like to be invested in. There's Facebook, there's Zoom, there's Amazon, there's TikTok, YouTube, and so many internet companies out there. Which is the right company to invest? And that is why diversification is important. So you can do it via an ETF, and Nikko AM has just the ETF for you. I will not be talking about that ETF today, but it is listed in Hong Kong. And if you just go to your FSM platform and do a quick search, you should be able to find it. Despite all these very astronomical numbers, right, there is still huge potential for growth in the global internet space. As of September 2020, global internet penetration rate is only at about 63.2%, which means that out of every 10 people, there are still 4 people in the world that have no access to the internet at all. And that means to me that there is still a lot of room for growth, for the internet to continue to penetrate, and for internet companies to continue to generate additional revenue. This is the breakdown by countries. In the US, penetration rate is very high, it's at 90%. But it's not across the board. So globally, worldwide, we're at about 63.2%. In Asia, it's only about 59.5%. In fact, in China, it's just under 60%, even though China already has 854 million internet users. There is still a huge runway for growth here in Asia and globally for internet companies. Now, when we talk about internet, there are a few, the internet has so many things going on, right? There's social media, there's e-commerce, online advertising, Internet of Things, e-games, and many, many subsectors. Today, what I will focus on really will be e-commerce, the Internet of Things, And eGames is a very specialized niche subsector of the internet sector. Now let me talk about e-commerce. We've all heard of Singles Day, Alibaba Singles Day. And on a single day, on Singles Day, on the 11th of November, in 2018, Alibaba hit a record high of $30 billion in sales. This is US dollars. And in 2019, it was 38 billion. We were all expecting a 20-30% growth. However, in 2020, this figure almost doubled from 38 billion to 74 billion USD in a single day of sales. There were over 1 billion packages and orders shipped everywhere in the world just from Singles Day alone. And this is from just one company, just Alibaba. So again, these numbers are just huge, huge numbers, right? I mean, a lot of revenue being generated by e-commerce every single day. Yet, however, again, back to penetration rate, there is tremendous potential for e-commerce to grow if companies can shift these consumer purchasing patterns to online purchasing channels. In fact, Bank of America Merrill Lynch estimates that global penetration rate can increase from what 11% it is today. Today it's about 11-12% to 25% over the next few years. If you look at the chart here, internet retailing as a proportion of overall retail, South Korea and China are ranked the highest at about 23-24%, but there is still much room for growth in many of the other countries. And one huge booming area that we see in this is India, right? In India's penetration rate is very low, only at about 5%. And India is a huge country. They're embracing the internet, they're embracing e-commerce. There is plenty of room for growth. When we talk about e-commerce, again, e-commerce in itself is really, it's evolving, right? I believe some of you may have heard of Li Jiaqi, Austin Lee, who is known more famously as China's lipstick king. In 2019 Singles Day, he live streamed and sold over 145 million US dollars in sales. One person, one day. And on Singles Day in 2020, he outdid himself, sold almost more than 4 times that amount to 600 million USD. Now, this is, again, this is just from one live streamer. And there are many of these live streamers that are doing live e-commerce in China, in the US. And this is really transforming and changing the way that consumers are purchasing what they need online. E-commerce also, it's moving to help what we call the fresh produce sector. So traditionally in e-commerce, many of the goods that were sold online were not fresh goods. So electronics, fashion wear, tech gadgets, etc. Right? However, during the pandemic, live streaming actually really helped China's farmers to survive. In fact, fresh produce sales went up by almost 3 times. And again, this really just goes to show how the e-commerce in itself is really transforming. And it's you know, we don't really know where this is going to take us, right? There is huge potential in this area. Moving on to the Internet of Things. Now, I'll talk very briefly on this topic. The Internet of Things really is the connecting of devices. So when one device speaks to another device, and these devices are all connected to the internet, this is what we call the Internet of Things. It's a very broad concept. The most basic application of the Internet of Things, which I would like everyone to think about, is the smart home. Now, we have seen even here now in Singapore, some very basic aspects of the smart home. We have got smart lights, smart air conditioning, we've got Google Home, smart TV. Our iPhone itself, or our smartphone, it's called a smartphone because it is smart, it is connected to the internet. But there is a lot more potential for the Internet of Things to be applied to a home, and really not only a home, but to industrials, to automobiles, to aeroplanes, to all sectors, really. But in the home, perhaps I could just help you to imagine. Imagine you wake up one morning, your alarm rings. The second your alarm rings, your curtains start to open automatically. The sunlight comes in, you wake up, you go brush your teeth, you wash up. You go to the kitchen, you start making yourself breakfast. You open the fridge, you take 2 eggs out of the fridge. You start making your breakfast. Immediately, your refrigerator, which is smart, it senses that, oh, there are no more eggs. Automatically, through your smart hub, it puts an order to an Amazon Prime or a Red Mart, whatever, to order eggs to your home. The next thing you know, the eggs are delivered to your doorstep. So there are many, many users of Internet of Things devices that can be applied in the smart home, and we are already seeing that happening today. As a whole, the market size of Internet of Things devices today is about 400 billion. We expect the growth of the Internet of Things to grow by quadruple by 2025 to about 1.6 trillion US dollars. Now, let me move on to the eGames market. This is always a topic which I'm very, very interested to talk about. The eGames market has seen 11% year-on-year growth since 2012 to 2021. Every year it's growing by about 11%, out of which in particular, mobile game growth was extremely high at 26.8% compounded annual growth rate from 2012 to 2021. Now, we all play games, right? I'm sure everybody listening in today have had some exposure to games, be it computer games, video games, arcade games, or more likely than not, mobile games, Clash of Clans, Candy Crush. I'm sure we've all got a game on our smartphone. So with everybody playing games, the revenues for the global games market today is about 180 billion US. Now, what does this really mean? I mean, 180 billion. Let me help you to put this in perspective. 180 billion revenue for the global e-games market is more than the revenue of the movie industry and the music industry combined. So, I mean, we all watch Netflix, we all watch movies, we all go to Spotify and listen to music. Consider that for a second. The games market, it's more than movies and music combined. And huge monetization opportunities. Why has gaming evolved to being so advanced today? Let's take a look at these 2 pictures, left and right, In July 1969, for the first time in history, man landed on the moon. Neil Armstrong, he followed on with a very famous quote, "One small step for a man, but one giant leap for mankind." And upon that Apollo 11 that landed on the moon back in 1969, there was this tiny device called the Apollo Guidance Computer. That's the picture on the right. This device was crucial to the mission because it navigated the Apollo 11 to the moon. This device has got a processing speed of 0.043 megahertz. Today, our smartphone, the Samsung Galaxy S20, for example, is 2,840 megahertz. The processing power of the smartphone is 66,000 times more than the Apollo guidance computer, which back in 1969 navigated the Apollo 11 to the moon. So that's how powerful our devices are today, right? With this kind of technological advancements, right? Graphics get better, speed gets better, and that is why gaming is becoming so popular. I mean, we all know Pokemon Go. I wouldn't talk about it. And everybody plays games. You know, almost 1 in 3 people in the world are gamers. There's an estimated 2.5 billion gamers worldwide. And it's not just the typical stereotype teenage boys that plays games. In fact, if we look at the diversity, 54% of gamers are men and 46% of gamers are women, spread across all age groups. There is a game for everyone. So it is a mainstream form of entertainment today. This picture shows gamer grandma. She's 90 years old. She has got over, and in my slide, it says 320,000 YouTube subscribers, but today really it's more about 500,000 YouTube subscribers. All she does every day is play games, and people watch her play games, right? She's an expert at many games that she plays, and it's becoming a form of entertainment. So people don't just play games for the fun of playing games, but people, consumers online are actually today paying money to watch other people play games. So it's becoming a form of entertainment. It's becoming a form of sport. So this is what I was talking about earlier. eGames, revenue more than movies and music combined. And let's look at viewership for esports. In 2019 sports finals viewerships, Wimbledon had 10 million viewers. NBA finals was 15 million viewers, and the League of Legends, it's an online game, esports competitive game, had 44 million viewers. So really, what I'm trying to say is that esports and e-gaming is becoming a very mainstream form of entertainment. You don't only play games, but you want to pay to watch other people compete against each other. And that's where the industry is transforming to today. And I now move on to my last slide. There is huge monetizing opportunity. Despite everything that is going on, total revenue of esports is only 1.1 billion in 2020. Now, 1.1 billion is a very small number compared to the total revenue of the gaming industry. It's 180 billion. So in this space, there is huge monetization opportunities. Advertisers are going to come in. E-games are going to boom. E-games stocks are on the cusp of huge growth, if you ask me. And I just ended off with a quote, right, by Seth Straw, which is the chief executive of the casino management company. He expects that within the next 5 to 10 years in North America, esports will be third after the NFL and NBA in terms of total wagering. And finally, you know a sport is a sport when the punters come, when people start betting on it, right? This is where it goes mainstream and really becomes a form of real entertainment. So that comes to the end of my presentation. In summary, ladies and gentlemen, the global internet sector and the e-game sector are both sectors very well positioned for huge growth. With the growth of e-commerce, live streaming, applications for IoT devices, social media, and huge monetization opportunities for e-games. So together, let's invest in the future, and Nikko AM has just the right ETFs for you. Thank you very much. I hope you enjoyed your in-flight entertainment.
Thank you, Jermyn. Next up, we have Ferlyn Tan, Senior Equity Analyst, Stocks and ETFs Research, iFAST Singapore. She will be covering global financials, the city that never sleeps. Ferlyn, please.
All right, hi, good afternoon, everyone. So I'm Ferlyn, and today I'll be sharing with you guys one of our top ideas for this year, and it is none other than the global financials. So despite the run-up over the past few months, we still think that the global financial sector is an attractive space to be in, given how stars are aligning from both the top-down and the bottom-up perspective. So Before we continue, perhaps let's first try to establish what exactly makes up the financial sector. So we all know that financial sector, it plays a very important role in any economy. And if you just look around you, you will realize that almost everyone has established at least one relationship with at least one financial institution. And almost all businesses, regardless of what industry you are in, they will require financial services at some point in time, be it for loans, insurance, or just simple financial transactions. And based on the JICS classification, we have broken down this sector into 3 different categories. First, we have the banks, we have the insurance companies, and we also have the other diversified financials. So for the banking industry, I'm sure everyone is very familiar with it. It simply refers to the financial intermediaries that connect savers and borrowers. So a few notable examples would be our 3 local banks, DBS, UOB, and OCBC, as well as some international banks like JP Morgan and ICBC. Next, we also have the insurance companies. Insurance companies are the ones that offer risk management products to their customers and collect premiums from them in return. Some examples would be like Great Eastern, Prudential, as well as AIA. And finally, we also have the other diversified financial. It generally refers to a range of companies that offer a wide variety of financial products and services. So sometimes you can think of the other diversified financials as companies that do not belong under the banks or the insurance. So a few examples would be the asset management company, fund management company, brokerages, or wealth management platforms like FSMOne, iFAST. So looking ahead into 2021 and beyond, we see 5 key catalysts that will drive the global financials, earnings, and share price. So first is the full resumption of capital distribution programs across the banks. Second is the fall in loan loss provisions. Third is an earlier than expected rate hike. Fourth is a recovery in insurance premium. And finally, number 5 is a healthy growth in global AUM within the wealth management space. So first, we have the full resumption of capital distribution programs. So over the past 1 year, due to the sudden outbreak of the coronavirus, regulators across the globe had to take several actions to ensure that the banks within their jurisdiction conserve sufficient cash to weather through this economic downturn. So what most of them did was that they asked the banks to reduce their dividends and or to stop share buybacks, whereas in some other regions like Europe and UK, the regulators urged the banks to cancel all dividends and stop all share buybacks till at least 2021 this year. By this point, I think it's worth sharing that most of the banks actually continued to maintain very healthy capital ratios during the peak of the coronavirus last year, which suggests that the banks have the capacity to maintain their payout if the regulators did not step in. But of course, the regulators decided to be prudent about it and went ahead with cancelling the dividends, the capital distribution programs. But fast forward to today, regulators have started to lift these capital distribution bans, but unfortunately, most of them are still inclined towards longer dividend and share buybacks ban. So which means to say, most of the banks have were allowed to pay out some dividends, but it's only a fraction of what they could have paid pre-COVID levels. But on the brighter side of things, we believe that this is just a matter of time before regulators will allow banks to resume their payouts. And given the fact that how capital distribution programs have become such an important factor for bank investors over the years, we believe that the full resumption of capital distribution programs will be a major share price catalyst for this sector. Next, we also see the easing loan loss provisions as a driver that will help to support the earnings across the global banks. So last year, most banks across the world, they had to set aside huge amounts of reserves as they prepare themselves for a wave of bad debt arising from the pandemic. And unsurprisingly, loan loss provisions became the main culprit that dragged down the bank's earnings. But the thing about loan loss provisions is that they are usually more forward-looking. So most of the banks have already front-loaded the credit allowances in the first half of 2020. And according to most of the larger banks' management, loan loss provisions is expected to slow down this year before returning to normal levels in 2022. So in other words, this should signal a turning point for the banks which will help to support the valuations of the global banks. And moving on to rate hikes. So late last year, the Fed, they stepped up and mentioned that they will probably not conduct any rate hikes until at least 2023, or until at least the economy shows sustained economic recovery. So using the Fed fund rate as a benchmark, we expect to see flattish net interest margins this year. And on top of that, we also do not expect to see any substantial compression in the bank's net interest margins, given how interest rates are already at an all-time low. However, over the past few weeks, we have noticed that inflation has started picking up rather rapidly, and we also expect to see inflation to continue picking up throughout the rest of this year. So with rising inflation expectations painted as a backdrop, rate hikes may get pulled forward. And in fact, some market participants have already started pricing in rate hikes as early as early 2022. So we all know that for financial institutions, most of their profits are dependent on net interest income, which is correlated to the interest rate environment. So therefore, an earlier than expected rate hike will be a major catalyst for the global financial sector from a profitability perspective. And moving on to the fourth point, we also see a recovery in insurance premium that will help to support the earnings of the insurance industry. So needless to say, the COVID-19 outbreak last year has hindered most insurance sales. And this is because interaction between agents and clients was severely limited by social distancing measures. And number two, non-life insurance segment was also badly hit given how consumer spending fell to an all-time low during the lockdown period. However, as more countries, as more economies start to open up their economy, we believe that this should signal a turning point in terms of insurance premium from both the life and non-life perspective. So first of all, the COVID-19 outbreak has brought about a huge awareness of health insurance, and more consumers are now more receptive towards the idea of insurance as they begin to understand the importance of having adequate protection against illnesses, against hospitalization and death. So we believe that this shift in mentality, the shift in mindset will help to support life insurance premium moving forward. At the same time, we also expect to see a recovery in the non-life insurance segment, given how demand for property, cars, and travel is expected to recover after crashing in 2020. So when that happens, naturally, the demand for property, auto, and travel insurance should pick up as well. So all in all, we expect global insurance premiums to recover in 2021 this year after contracting last year, and China will be the one leading this rebound. And last but not least, we also have the wealth management industry. So this industry has always been a bright spot within the global financial space. And in fact, last year, global AUM continued to register very strong growth despite COVID-19, which clearly says that even COVID-19 is able to hinder such strong growth trajectory. So the asset management industry is set for another decade of growth, and we believe this will be driven by the increasing wealth of the high net worth individuals and the mass affluent. So these wealthy investors are constantly looking for more avenues to park and grow their assets, be it in more investment-oriented products like ETFs or mutual funds, or more protection-oriented products like long-term health insurance. But either way, this will drive strong growth in financial assets, which will translate to higher revenue and earnings for the asset and wealth management industry, given how most of the companies in this industry earn based on a small percentage of the assets under their management. So to sum up, we continue to see several strong tailwinds that will propel the global financial sectors forward. So we also expect investor sentiments to improve given the prospects of a full resumption in capital distribution programs across the banks, as well as an earlier than expected rate hikes. So our fair PB of 1.3 times translates to an upside potential of more than 15%. And not only that, the global financial sector is also offering an average dividend yield of 3.2% per annum in the next 2 to 3 years. And to gain exposure to this sector, our recommended ETF is the iShares Global Financials ETF, with the ticker code IXG. So from the chart on the right, you can see that banks and insurance makes up most of the net assets of this ETF, which is also why we have chosen to focus more on these two industries in our presentation today. So this ETF was also chosen based on our in-house ETF selection methodology, which my colleague Hui Shi has shared earlier this morning. So this ETF has one of the best liquidity and tracking difference. And also have very decent expense ratio of 0.46%, making it our preferred ETF. So to sum up, this is our one of our top ideas for this year. So we think that it is a great time for investors to jump into this sector. But let's say if you're an investor who is unsure of when to enter the market or unsure of how to start your investment journey, perhaps you can consider engaging in our RSP program where you can deploy a fixed sum of money into this ETF on a monthly basis. And that's all I have for you today. Thank you so much for tuning in. And if you have any questions, feel free to type it down in the Q&A box and we will try to address as many of them as possible. Thank you.
Thank you, Ferlyn. We will now be making a stop in China as our guides cover the different ETF investment opportunities there. In this segment we call China Hour, they will be sharing with you about China's semiconductors, real estate, healthcare, financials, and technology sectors. But just before we start, we would like to poll the audience. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for poll number 2, then click on the Join Poll button. And the poll window will be displayed on your right. I hope everybody is able to navigate. And once everyone's ready, we will begin. Question 1. Are you positive on the outlook for the global internet sector? The majority of us are positive. Question 2, will you be investing in the e-gaming sector? It looks like we're all split up, but a majority of us would like to find out more before deciding. Which sector in China are you already invested in or most interested to invest in? Is it semiconductors, real estate, healthcare, financials, technology, or are you not interested in China equities? Oh, looks like the majority of us are interested in Chinese technology. Thank you so much for sharing your thoughts. We will now set off to discover the opportunities in China. From the Stocks and ETFs Research team at iFAST Singapore, our speakers for this segment are Tan Jun, Senior Equity Analyst, Yeo Hui Shi, Equity Analyst, Chloe Nadia Halim, Equity Analyst, and Ferlyn Tan, Senior Equity Analyst.
Conviction investment ideas within China's economy and also the different ways which you can get exposure to them. So sit back, relax, and enjoy the presentation. But before we dive into the individual segments, let's talk a little bit more about China's economy as a whole. So China has come a long way since the 1980s, growing by leaps and bounds to become a global economic powerhouse. And today, China is actually the second largest economy in the world, making up approximately 17% of the global GDP. And with continuing economic reforms and a shift towards a more sustainable growth model, China is fast catching up to the US, and it is just a matter of time before it topples the US to become the #1 economy in the world. So as a matter of fact, China's economy actually expanded by 2.3% in 2020, making it the only major economy to report positive economic growth in what was an extremely challenging year for the global economy. Mirroring the remarkable economic growth is its stock market, which has reached a total market cap of approximately $12 trillion as of mid-2020, making China home to the second most valuable stock market in the entire world. With such a sizable economy and stock market, China is simply too big to ignore for investors who wish to construct a globally diversified portfolio. So within China's economy, there are of course several interesting sectors which we think investors should pay attention to, and one of them is actually its semiconductor industry. So since the very beginning, China has not had a significant presence in the global semiconductor market, and in 2019, the country as a whole accounted for just 5% of the global market, which is far behind US and South Korea, which controlled 47% and 19% of the market respectively. So the main reason why China has such a small market share in the global semiconductor industry is because of technology. In terms of chip design, China has made significant progress over the years, with leading fabless companies like HiSilicon able to design advanced chips used in applications such as 5G and AI. For instance, HiSilicon's new line of smartphone processors is considered to be on par with those that are designed by Apple. But where China is lacking the most right now is foundry technology. For decades, China has long struggled to produce its own chips, especially those that require a cutting-edge manufacturing process. And SMIC, which is China's largest and most advanced foundry, only began producing chips using a 14-nanometer process in the fourth quarter of 2019, a feat that rival TSMC managed to achieve 5 years ago. And within a short span of less than a year, this gap has widened even further, with TSMC introducing its 5-nanometer process in the first half of 2020. So besides TSMC, SMIC's technology is also several generations behind other foundries such as Global Foundries as well as Samsung Foundry. And despite being the largest electronics manufacturing hub in the world, domestic production only accounts for roughly 20 to 30% of China's total semiconductor demand. Its limited technological capabilities means that it has no choice but to fulfill the remaining demand by importing from other countries such as the US. And in 2020, China's chip imports actually reached a record high of $380 billion, and that number has actually been increasing every year as global demand for electronics continues to rise. But with the US clamping down on its access to these critical components, Chinese companies now realize that they can no longer safely rely on imports and will eventually have to start looking inwards to meet their semiconductor needs. The huge amount of chips that China imports every year is a tremendous market opportunity for its local semiconductor companies. And looking ahead, we think that these companies stand to gain thanks to greater domestic demand as well as the government's push to localize chip production. Since the US-China trade war began in 2018, the relationship between both countries has deteriorated substantially. And over the past 2 years, the conflict has actually extended to a number of issues beyond trade, such as intellectual property theft and national security. Right now, national security seems to be the #1 priority of the US government, as it has implemented a string of measures over the past 2 years in an attempt to hamstring the growth of China's technology companies, starting with Huawei. So back in May 2019, the US Commerce Department actually announced that it has placed Huawei as well as 68 of its affiliates on the entity list, claiming that the telecoms equipment manufactured by the company can be used for spying, and therefore it poses a national security threat to the US. And this effectively restricts Huawei's ability to purchase vital components like semiconductors from the US to manufacture its products. And from then till now, many other Chinese tech companies have fallen into the crosshairs of US regulators. And if these companies are unable to find an alternative supply for chips, their operations could be severely affected. So in response to the sanctions, Chinese officials, they began accelerating plans to strengthen the country's semiconductor industry. As part of its Made in China 2025 plan, China aims to produce 70% of all the semiconductors it requires by 2025, with a longer-term goal of becoming completely self-sufficient. So given how crucial semiconductors are to a nation's development, we think that the sanctions will actually have the opposite effect of compelling China to double down its efforts in building up its chip-making industry instead of slowing the rise of China's tech sector. The recent events have revealed China's vulnerability in this key sector, which we think China will be very keen to fix these issues. The road to self-sufficiency will definitely be paved with difficulties, but we believe that China will persevere through as the future of the nation depends on the success of this endeavor. So to achieve its goal of becoming self-sufficient in chip production, the government has actually laid out several policies to support the industry. One of its greatest efforts was to establish a national fund to help promote the growth of the local semiconductor industry. So this fund, which was first set up in 2014, has invested close to 350 billion yuan in various projects and companies within China's semiconductor industry to date. It is estimated that roughly 67% of the monies went to manufacturing firms, which includes both your integrated device manufacturers as well as your foundries, demonstrating the government's priority in building up the nation's chip-making capabilities. So secondly, the government has also made significant adjustments to its tax policies last year, which is a decision that should greatly benefit local semiconductor companies. So under the new policy, chip makers that have been in operation for more than 15 years and produce chips using a 28 nanometer and below process may be exempted from paying corporate income taxes for up to 10 years. And if you look at the table, you can see that these tax benefits also extend to other companies, such as those using mature processes, as well as your fabless companies, materials and equipment firms, so on and so forth. So the idea here is very simple, and it is that by reducing the tax burden, these companies will actually have more resources to allocate to capital expenditure, which will hopefully improve their technological capabilities quicker and allow them to compete with their global peers. And again, through the way these policies are structured, we can tell that the government's focus here is clearly on strengthening the nation's chip-making capabilities, which is again an area that it is currently lacking the most. So with the motivation, as well as the resources to narrow the gap between themselves and the US, we believe that China's semiconductor industry is about to enter a phase of supercharged growth, one that will bring about many investment opportunities in time to come. So looking ahead, we think that China's semiconductor companies will experience a period of high earnings growth, which is a key ingredient that will drive share prices higher. And based on our own estimates, we think that China's semiconductor industry as a whole, it offers an upside of close to 50%. So with that said, investors who are looking for ideas for their tactical portfolio may want to consider the Global X China Semiconductor ETF, which is our recommended ETF for China's semiconductor industry. So this ETF, it seeks to replicate the exposure of the FactSet China Semiconductor Index, which consists of a basket of 24 Chinese semiconductor companies. And top 10 holdings of this ETF will include names like Will Semiconductor, as well as SMIC, which is, again, the largest foundry in mainland China. So besides having a low expense ratio of just 0.68%, another advantage of this ETF is that it provides investors with exposure to semiconductor firms which are listed on mainland China, which shares may not be as easily accessible to certain investors. And to top it all off, using an ETF such as this one will also help to minimize any company-specific risk. So to sum things up, we think that there are many reasons to be positive about China's semiconductor industry: strong state support, rising domestic demand, the government's plan to localize chip production, and the potential removal of US sanctions could drive an upward re-rating in share prices. And with that, I've come to the end of my segment. Thank you so much, and I'll now hand the time over to my colleague Hui Shi, who will bring you through the next idea.
Good afternoon. My name is Hui Shi. I'm an equity analyst from the Stocks and ETFs Research team. And I'm here today to share with you the drivers, challenges, and most importantly, the investment opportunities in China's real estate sector. The real estate sector is an important component of China's economy. About 2 decades ago, the Chinese government launched a housing reform that started the privatization of public housing and hence creating a private housing sector. Fast forward more than 20 years to today, this sector has become a significant driver of China's economic activity, and its housing market has become the largest in the world. And in 2020, sales have recovered quickly from the COVID-19 pandemic, recording double-digit growth year on year and hitting sales of around 17.4 trillion RMB. In SGD terms, this is about $3.5 trillion. The majority of the players in China's real estate sector are property developers. They take up about 87% of the MSCI China Real Estate Index. And while there are many different types of properties that can be developed, property developers in China are mainly involved in residential property development. And meanwhile, the remaining players in the real estate sector include real estate platform services as well as property managers. And to give you a better idea of this sector, here are some of the notable names. The largest developers by sales in 2020 include China Vanke, Zanek China, and Country Garden. And China's largest housing transactions and services platform is CAIA Holdings, also known as Beike. It owns China's leading real estate brokerage brand. And last but not least, for the property management subsector, this subsector is highly fragmented, but a notable name would be Poly Property Services. And while the housing reform has been successful, leading to the dramatic growth of many players in the real estate sector, it also came with challenges of its own. We have heard in the news that China's housing prices have skyrocketed, and this has raised an issue regarding housing affordability. And due to this, policy has tightened over the years as the central government steps up efforts to stabilize housing prices and reduce the possible financial risks associated with the real estate sector. A notable regulation that has been implemented recently is called the 3 Red Lines. But despite all these challenges, we still believe that China's real estate sector remains attractive, especially the bigger players. And I have 3 reasons why this is so. The very first reason is because urbanization will support the long-term growth in housing demand. Rapid urbanization was a main driving force behind China's housing market over the last decade. And looking ahead, urbanization rate in China is estimated to increase from 60% in 2019 to 75% by 2030. And this is expected to continue to support the demand for urban housing. And as shown by the blue line in this chart here, the housing market in all 4 Tier 1 cities of China have remained the most attractive. They were able to record a consistent growth of around 4% year on year during the last few years. And meanwhile, during the same time period, you can see that overall housing prices in China is seeing a slowdown in growth. And you may wonder why this is so. The resilient housing prices in the higher tier cities are due to very good reasons. The younger population, they like to stay in the bigger cities for better education as well as career opportunities. And as such, big cities in China, they have relaxed the talent settlement policy. For instance, Shanghai, which is a Tier 1 city, has allowed top college graduates and venture capital talents to directly settle down. And with such relaxation of policies, more migrant workers who are from the rural areas, they are able to move their household registration to the urban areas. And by moving their household registration to urban areas, they get to enjoy social benefits in the urban areas, which includes having the rights to purchase a home in the city that they have relocated to. And by transforming migrant workers into urban residents, there will be a more efficient allocation of resources. And this helps to spur China's economy and cushion the economic impacts from the US-China trade war. Moreover, urbanization rate in the country will be sped up and population inflow in the bigger cities will increase, and this naturally leads to a greater demand for urban housing. And on the supply side, big cities such as Shenzhen, they have a scarcity of residential land, as land they are mostly allocated for industrial as well as commercial users. So the scarcity of residential land coupled with the influx of population, they have supported the continued rise of housing prices in the big cities of China. And hence, while the overall housing prices in China will likely continue its slowdown in future, we believe that housing prices in the higher tier cities, they will remain resilient due to favorable demand and supply dynamics. And the majority of the developers in the MSCI China Real Estate Index, they are focused on tier 1 and 2 cities. This allows them to benefit from such resilient housing prices. And the second reason why we believe China's real estate sector remains attractive is because regulations, such as the 3 red lines, is unlikely to have a major impact on most big players. For a long time, Chinese developers have been taking on a lot of debt to accumulate land, and this has contributed to the soaring land prices in the country. In view of this, last year, Chinese regulators, they introduced the 3 red lines, which is a new set of criteria used to assess the financial situation of developers in China. And the 3 red boxes on the left here shows you what the 3 red lines are. The first line requires developers to have a liability to asset ratio of less than 70%. The second line requires a net gearing ratio, which is also the net debt to equity ratio, to be less than 100%. And the third line requires a cash to short-term borrowings of more than 1 times. And as shown by the table on the right, developers are then given a color code, either green, yellow, orange, or red, depending on how many red lines they violate, and their debt growth per annum will be capped accordingly. Essentially, these 3 red lines, it is a reflection of the Chinese government's intention to prevent the risk of a housing bubble, as well as to help speed up the deleveraging process of developers. It is also worth highlighting that the 3 red lines, it targets the highly leveraged developers, and it is not a crackdown on the entire sector. In fact, based on our findings, only 7% of the developers who are in the MSCI China Real Estate Index will breach all 3 red lines. And meanwhile, around 50% of developers will pass all 3 red lines, which also means that they get to enjoy the maximum debt growth of 15% per annum. And zooming into the top 10 constituents of the MSCI China Real Estate Index, again, you can see that the majority of them, such as China Resources Land, Long4 Group, or China Overseas Land, they will not breach any of those red lines. And with their lower leverage, these developers are able to expand their land bank prudently, which can translate into healthy and sustainable earnings growth. Additionally, developers have been diversifying their income stream into other businesses that may not require very extensive borrowing. And this includes property management, which provides companies with recurring income, as well as construction services provided to urban city development and operation projects. And while such businesses have yet to make any significant contribution to revenue, we believe that there is a lot more room for growth. And this is especially so since developers are increasingly turning their focus onto these kinds of businesses in order to help drive earnings growth moving forward. And the third and final reason why we believe China's real estate sector remains attractive is because there will be easing competition in the industry that allows big players to grow even bigger. Every crisis lies an opportunity, and while there are indeed more regulations, some of it could actually benefit certain players. So for instance, this year, China has released new land sales rule that potentially favors the larger developers who have the financial strength to do bulk purchases. In the past, local governments, they released land parcels unevenly without a schedule, and this uncertainty had caused many developers to aggressively bid for land, pushing up land prices in the country. And with the new land sales rule, 22 big cities in China will coordinate land auctions, clustering them into specific sessions each year. And when land auctions are clustered, only the large and financially strong developers are able to expand their land bank faster. Moreover, we believe that there will be industry consolidation in the medium term due to the effects from such new regulations. Small cap or highly leveraged developers who have limited access to funding, they will likely face difficulty when competing for land with the leading developers with stronger balance sheets. And what's more, those facing declining profitability, they could be forced to exit the industry in the longer term, and while those that are doing slightly better, they may become good targets for M&A. And meanwhile, due to the reduced competition for land, leading developers that are financially strong, they could potentially gain more market share. And if they are able to acquire other vulnerable players, they can grow even bigger. So this will sum up all of the reasons why we believe China's real estate sector remains attractive despite the tightening of regulations. Urbanization is expected to support the demand for housing in China. Regulations such as the 3 red lines is unlikely to have a major impact on most big players. And in the medium term, there will be easing competition in the industry that actually allows these big players to grow even bigger. However, do also take note that an investment in China's real estate sector does not come without risk. Firstly, increasing speculation in the market will raise the risk of a housing bubble. Regulators will likely respond with the further tightening of rules on developers, which could affect their earnings growth. And the next risk is that an aging population in China potentially puts a pressure on housing demand in the longer term. But the good news is that an increasingly number of developers have ventured into the construction of senior housing. Overall, with China's real estate sector becoming more mature and entering its consolidation phase, we believe that the investment opportunities, they lie with the bigger players. And investors who wish to take part in the growth of this sector using a diversified approach can consider our recommended ETF, which is the Global X MSCI China Real Estate ETF, designed to track the performance of large and mid-cap Chinese real estate companies. And the top 10 holdings of this ETF is shown in the table below. It is worth noting that many of these companies, they do have strong balance sheets which can support their future growth. And valuations-wise, based on a fair PB multiple of 1x, we have valued this ETF at a target price of $25.2 USD. And this will represent an upside potential of a decent 51%. If you are an income investor, you will also be happy to know that this ETF pays dividends. After taking into account the withholding tax of 30% imposed on this US-listed ETF, investors can expect to take home an average yield of close to 5% over the next few years. And finally, as shown in this chart here, the price of the MSCI China Real Estate Index, it tracks its book value per share. And its book value per share is estimated to increase over the next few years. And hence, we do believe that the China real estate sector is able to deliver upside potential in the coming years. And with that, I have come to the end of my presentation. I'll now hand the time over to my colleague, Chloe.
So hi everyone, I'm Chloe. I'm an equity analyst from the Stocks and ETF Research team at iFAST. Today I'll be sharing about China's healthcare sector and what are some of the potential opportunities that arise from one of the fastest growing healthcare markets in the world. The COVID-19 pandemic has shown a spotlight on the internet sector as a whole. The internet and healthcare sector as a whole. It has reiterated the crucial role played by healthcare system, such that a well-functioning healthcare system is essential to saving lives and the well-being of the overall economy. For instance, China's success in containing the COVID-19 pandemic and dealing with the health crisis resulted in it being one of the very first few economies to recover from the pandemic. China has gone on to recover tremendously, registering a GDP growth of 15.8% in the first quarter of 2021 compared to a previous year ago. However, we should need a black swan event such as the pandemic to convince ourselves to invest in the healthcare sector. This is simply because the demand for healthcare services are almost guaranteed to rise over the medium to long term. The world is becoming older as well as more chronically ill. And such trends are structural in nature, and we see little chances of this paradigm shifting. We are especially positive on China's healthcare sector, as moving forward, China is one of the fastest growing major healthcare markets in the world. Its growth rates by far exceed other healthcare markets and is expected to grow at a 5-year CAGR of 11% as seen on this chart. So a major reason why China is the fastest growing healthcare market is due to its rapidly aging population. So the number of citizens who are aged 65 years old and above has actually reached 160 million in 2019, and this represents about 11.5% of the overall population. The proportion of elderly will be steadily increasing and will continue to grow, as this is actually due to the lingering effects of the one-child policy that was implemented in 1979. So according to the World Bank, this number is expected to rise to 310 million, and they will make up about 23% of the total population in China by 2050. So to give you some context, these 310 million people and who are elderly are actually so significant, as this number will be exceeding that of US, Japan, and Europe combined. China's fast-growing society also means that there's an ever-growing need for healthcare services. And this spike in demand is further compounded by the rising prevalence of chronic diseases. So overall, China's aging population is actually expected to increase the burden of chronic diseases by 40% by the year 2030. Currently, 80% of deaths in China for those who are aged 65 years old and above are a result of chronic diseases, with cancer, heart disease, and diabetes being the top causes of death. However, despite its population aging as well as becoming more chronically ill, China's healthcare expenditure per capita is still lagging behind other top healthcare markets. So what this also means is that moving forward, there's ample room for growth. China's healthcare expenditure per capita currently only stands at about 500 USD compared to the average of about 5,700 USD, and this is among the world's top 8 healthcare markets as seen on this chart. The result of the underinvestment in healthcare is reflected in the shortcomings or the pain points in China's healthcare system. Looking at the providers, also known as hospitals, we find the case of the misuse of resources to be a problem. This is because 2/3 of China's hospital revenue comes from Tier 3 hospitals. And Tier 3 hospitals are often those who are the most well-equipped hospitals with the largest number of beds, but they only make up about 15% of the country's public healthcare facilities. As such, many patients with non-serious medical conditions are visiting these Tier 3 hospitals, causing overcrowding, while those county as well as district hospitals are underutilized. So unsurprisingly, on the patient's end, the result was a long waiting time, as they often wait about more than 3 hours, when the actual consultation can be less than 5 minutes. So last but not least, I'll move on to the doctors. So there's a shortage of doctors in China to meet the population needs. So China has about 2 practicing doctors per 1,000 citizens, compared to 2.6 in the United States and 4.3 for Germany. So in fact, doctors in China are often overworked, as 70% of the doctors in China actually work more than 50 hours per week, and this can result in a substandard quality of care. Additionally, the lack of investment into China's healthcare system has resulted in the uneven distribution of healthcare resources. This results in an urban versus rural divide. So those people who are living in rural areas often face difficulty in accessing much needed medical resources due to the lack of doctors as well as hospitals. To alleviate some of the pain points within China's healthcare system, the Chinese government actually expects to ramp up their investment in healthcare. Healthcare expenditure is expected to grow at a CAGR of 9.8% between 2018 and 2023, driven predominantly by public healthcare reforms, such as the Healthy China 2030 policy. So this policy actually outlines the government's plans to upgrade the standards and quality of care in the primary care institutions. China will be deploying of equivalent about 200 to 300 billion yuan into improving their public healthcare system. Additionally, I would like to share more about the impact of the pandemic on a particular segment of the healthcare market. For the health tech market in particular, the pandemic has proved to be a turning point, as health tech platforms who are offering telemedicine, online pharmacies, and disease management services were thrown into the spotlight as a result of the pandemic. as during the peak of the pandemic, China's National Health Commission actually issued guidelines to urge hospitals to take up online-based services to reduce overcrowding, as well as to prevent the further spread of COVID-19 infections. As such, technological-based tools that help to facilitate remote communication between doctors and patients became critical. So here are two examples of the leading health tech platforms in China who have benefited from the pandemic. So this is Ping An Good Doctor as well as Ali Health, and they were offering their telemedicine services free of charge to encourage anyone with minor, non-COVID-19 related illnesses to seek treatment through their portals. As a result, this resulted in a drastic growth in the number of users. So I'll give the example of Ping An Good Doctor, which has seen a tenfold increase in the number of newly registered users every day between 22nd January and 6 February 2020 last year. And even beyond COVID-19, we see a long-term structural change towards the increased adoption of digital health services due to the change in attitudes. Today, Chinese patients are much more open and are expecting to use more digital services within the next 5 years. Hence, this increase in the use of digital health services will actually propel the growth of China's health tech segment. So now that you have a better understanding of China's healthcare sector, let me introduce you to our recommended ETF. Investors can gain exposure to the opportunities within this sector by the use of the Crane Shares MSCI All China Healthcare ETF. So Chua is listed on NYSE, and it reflects the equity market performance of Chinese companies that are listed in the mainland, Hong Kong, and the US who are engaged in the healthcare industry. So here are more details with regards to this particular ETF. So one thing to note is that Chua has an expense ratio of 0.65%, and the ETF actually rebalances on a quarterly basis. Also, here are the top 10 holdings of Chua. To give investors a bit more color, we'll actually be looking at some of the notable holdings within Chua. So for instance, Wuxing Biologics, which is also the largest holding at about 8.4%, operates as a pharmaceutical company and is involved in developing as well as manufacturing antibody drugs and biological medicines. Another notable holding to take note of is that of the Shenzhen Weiren, and this is involved in the manufacturing as well as distribution of medical equipment, and most notably, they are the leading ventilator manufacturer. So last but not least, we have Ali Health, which I briefly touched on earlier. This is another notable holding within Chua, and Ali Health operates within the exciting health tech segment and specializes in medical e-commerce, smart medical treatment, as well as product tracing. So all in all, we are actually very optimistic about China's healthcare market in the long term, as despite this particular market being the second largest globally, it still remains relatively underdeveloped, leaving much room for growth. Going forward, China's healthcare sector would actually benefit from structural tailwinds such as an aging demographics, increasing expenditure, as well as a growing health tech segment. Henceforth, the growth trajectory of China's healthcare sector should actually command investors' attention. So thank you for your kind attention. I will now be passing on my time to my colleague Ferlyn.
All right, hi everyone again. So this is Ferlyn, and for my part, I'll be sharing with you guys on the China financials, which we believe is a key pillar in China's economic growth story. So we all know that global financials had a great run since late last year, but China financials is one of the rare few laggards within this space. So while we think that global financials remains to be an attractive category that investors should consider, we think that China financials is an even more attractive space from a total potential return perspective. So like what we have shared earlier on, the financial sector plays a very important role in any economy, and almost everyone and every industry is highly interconnected with the financial sector. And for the China's financial sector, it is largely dominated by two industries. First is the banking industry, and second is the insurance companies. So just to reiterate again, the banking industry generally refers to the financial intermediaries that connect savers and borrowers, whereas the insurance companies, they are the ones that offer risk management products to their customers and collect premiums from them in return. So for this presentation, we have decided to split it into two segments. First, we'll be sharing about the Chinese banks, then we'll move on to the Chinese insurance industry. So So looking ahead into 2021 and beyond, we have identified 3 key catalysts that will drive the Chinese banks' earnings and share price. So first is the easing loan loss provision, second is a double-digit loan growth, and third is also a new re-rating catalyst that might be underway for the Chinese Big Four banks. So first of all, Chinese banks, similar to the other global banks, they had to set aside large amount of reserves due to the pandemic last year as they prepare themselves for a wave of bad debt. So unsurprisingly, loan loss provisions became the main culprit that dragged down on the Chinese banks' earnings for the financial year 2020. But as mentioned earlier, loan loss provision is something that's more forward-looking. So most of the Chinese banks have front-loaded their loan loss provisions in the first half of 2020. And in fact, we have also observed that their loan loss provision have started to taper off since the third quarter last year. So as provisions return to the normal levels in the next 2 years, we believe that this will help to support the bank's overall earnings and hence their valuations. Next, we have also identified strong loan growth as another key catalyst. So we believe that PBOC is not likely to conduct any rate hikes in the near term or perhaps in the next 1 to 2 years. So we can expect to see rather flattish net interest margins across the Chinese banks. And at the same time, PBOC has also announced that they want new loans to stay around 2020 levels, which means to say we can expect to see new loans to grow at 11 to 12% for this year and perhaps the next year. So at this point, I think some investors, you may be concerned over the fact that the Chinese regulator seems to be trying to tighten the credit market, but we just want to highlight and say that you can still expect to see a double-digit loan growth across the Chinese banks, and we believe that this is in fact a catalyst for the Chinese banks. So this double-digit loan growth will help to offset the impact of a flattish net interest margins, which will help to support the Chinese banks' net interest income and hence earnings. And from a longer-term perspective, we have also identified a few new re-rating catalysts that might be underway for the Chinese Big Four banks. So as the name suggests, the Big Four banks refers to the 4 largest banks in China. And just these 4 banks alone, they take up almost 40% of the entire market share. And from the chart on the left, you can see that the Chinese Big Four banks have consistently traded at a much lower valuation as compared to their international peers since for the last 5 years. And we believe that this could be due to several reasons like a lack of research coverage, a lack of market transparency in China, as well as a lack of diversified revenue stream. But as China commits to open up its financial market, we believe that this valuation gap could start to narrow. And why is that so? Maybe let me give you a quick background brief of this situation. So for more than 2 decades, investment banking and other securities services in China were off limits to most commercial banks. And this was put in place by the 1995 Commercial Bank Law, given how the government was concerned that there might be some crossover risks across this entire financial system. But to better prepare its domestic firm to compete against foreign banks, Chinese regulators are planning to start a trial to break down the wall that's separating the banks and the securities firms. So Caixin, a Chinese media group, recently reported that the Chinese regulators may grant at least 2 security licenses to the large commercial banks, and it seems like ICBC and China Construction Bank may be the 2 candidates that will kickstart this trial. And this is unsurprising given how securities firms in China pale in comparison to their foreign rivals by almost all measures. So you can see that the Chinese top 4 security firms is way smaller as compared to its top 4 foreign rivals, which are Goldman Sachs, UBS, Morgan Stanley, and Credit Suisse. So therefore, we believe that when such reform is pushed through, we do expect to see a re-rating in the Chinese Big Four bank share prices, because not only are their business model becoming more diversified thanks to additional revenue stream, but the opening up of China financial market will also improve market transparency, hence attracting new investors who were previously uncomfortable with this issue. Now, for a better understanding of Chinese banks, we will move on to the Chinese insurance industry. So right now, Chinese insurance industry is the world's 2nd largest insurance market, but we still see huge room for growth for the Chinese insurance market. And similar to the Chinese banks, we have identified 3 key catalysts that will support the Chinese insurance companies' earnings. Number 1 is the growing aging population. Number 2 is the rising middle class population. And number 3 is the low insurance penetration rate in China. So first of all, the growing aging population. So over the last decade, you can see that the proportion of aging population has been increasing, and we believe that this will continue in the next couple of years. So this increasing aging population highlights two big concerns. Number 1 is whether these elderly have enough savings after retirement, and number 2 is whether these elderly have enough long-term care for their medical expenses in the future. And at this point, aging population is still very reliant on government and family support for their expenses. And we all know that healthcare expenses is just going to keep climbing up in the next couple of years, and we can always expect significant out-of-pocket payments. So this seems to suggest that cash from savings and the government may not be the most appropriate long-term solution to tackle this growing aging population. On top of that, people are also living longer, and plus the lingering effect of one-child policy will exacerbate the problem of a growing aging population and place further economic strains on families with elderly members. So in light of this challenge, we believe that insurance, which only accounts for 2% of the aging wallet, can take on a bigger role when it comes to retirement planning. And therefore, this represents a great opportunity for the Chinese insurers to grow their market share, to win more gross return premiums, and hence providing a level of support for their earnings. Next, we have also identified the huge and fast-growing middle-class population as another catalyst for the Chinese insurers. So as consumers get wealthier and as their living standards start to improve, demand for better medical care increases as well. And according to a survey conducted by EY, it was concluded that wealthier Chinese consumers tend to purchase more private insurance, given how the public insurance coverage is insufficient to cover their climbing healthcare costs. And from the chart, you can also observe that as the Chinese consumers' disposable income increases, the amount spent, the proportion of disposable income spent on insurance premium increases as well. So therefore, we believe that the fast-growing middle-class population will spur long-term demand for insurance products, and this will translate to higher gross return premiums and earnings for the Chinese insurers in the coming years. And finally, while the previous 2 points that we have shared earlier on suggest that demand for insurance in China is present, you will still be surprised to know that many citizens in China remain severely underinsured. So level of insurance penetration and insurance density in China remains low as compared to some of its international peers like US, Hong Kong, or even Singapore. So insurance penetration refers to the gross return premiums as a percentage of a country's GDP, whereas the insurance density refers to how much the people in a country spends on insurance in terms of amount of premium. And for China, its insurance density is only at 430 USD, whereas the average of its other peers stands at about 3,500 USD, which is almost 10 times larger than what it is in China. So this clearly signals a significant amount of unmet demand for insurance, and we believe that this is where Chinese insurers can catch up and take up more market share, which will once again help to provide a growth in their gross return premiums and as well as their earnings. So all in all, we believe that there's a lot of tailwind that will continue to support the China financial sector, and more importantly, at this juncture, valuations of the China financial sector remains undemanding. So to gain exposure to the China financial sector, our recommended ETF is the Global X MSCI China Financials ETF with a ticker code CHIX. So this index, this ETF, is largely made up of the banks and insurance, which is why we have decided to split our presentation, focusing on these 2 industries. So on the other hand, let's say you wish to gain exposure specifically to the China banking industry, our recommended ETF is the BMO Hong Kong's Bank ETF with the ticker code 3143. So for this, the big 4 Chinese banks pick up almost 50% of the index, And another of our stock pick, HSBC, is one of the top 10 holdings of this ETF. So in conclusion, here are our 2 ideas if you wish to gain exposure to the China financial sector as well as the Chinese banking industry. So just bear in mind, BMO Hong Kong Bank's ETF will be renamed to China AMC Hong Kong Bank's ETF effective on the 28th of May this year. And with that, I've come to the end of my presentation. Thank you so much for joining us today. And if you have any questions, feel free to type it in the Q&A box, and we will try to answer as many of them as possible. Thank you.
Ferlyn. We will now take a short break. In a few moments, we will have Don Leong from Lion Global Investors who will be sharing with us about Chinese technology. We'll see you in a few minutes. Welcome back. In our last stop on this leg of the China Hour journey, join Dawn Leong from the distribution business team at Lion Global Investors as she shares the market outlook on the Chinese technology sector and provides a deep dive into the newly listed Lion-OCBC Securities Hang Seng Tech ETF. Dawn, please.
Good afternoon, everybody. I'm Dawn from Lion Global Investors. Thank you so much for joining me this afternoon. I'm so pleased to be here. In the next 20 minutes or so, I will broadly discuss the landscape of the Chinese tech sector, do a deep dive into the Lion-OCBC Securities Hang Seng Tech ETF. I will go through the index methodology, recent changes to the constituents, as well as the market performance and flows. To set the stage, the ETF tracks the Hang Seng Tech Index that represents the 30 largest tech-related companies listed in Hong Kong. Without further ado, let's get into it. Over the past week, we have seen a huge sell-off in the global tech names. Big players like Apple, Amazon, Facebook, and Alphabet are all not spared and pulling back from their recent highs. The Nasdaq that led the market's stunning comeback in 2020 now lags behind the other 10 sectors of the S&P year to date. Since the beginning of the year, we have seen investors rotating out of growth names into the value stocks amid rising fears of inflation and higher interest rates. Bond yields have also spiked earlier this year, and commodity prices are also going up. Generally, with rising rates, other sectors do stand to benefit more than tech. While near-term rising rates can indeed be headwinds for tech multiples, we do believe that that's more so for the smaller to mid-cap companies. For the bigger companies, we are still seeing solid earnings growth coming through and even earnings being revised upwards for a few of them. As we move closer to home, the Hong Kong-China equity markets have also experienced meaningful correction since its February peak, with the Hang Seng Index and CSI 300 correcting about 10 to 15% respectively. Unfortunately, the tech stocks were hit even harder, with the Hang Seng Tech Index pulling back almost 30% from its highs. So here's the big question: what do we do now? While we do not and cannot rule out potential further downside, we do think that the speed of correction has been too fast, too furious, and overdone. One of the reasons behind the correction is that a lot of these Chinese tech names have borne the brunt of regulatory scrutiny. However, bottom line, we do believe that Beijing's ultimate aim is to prevent market abuse and systematic risk, but definitely still pushing ahead with digitization. All of these measures are really to promote fairer growth and not to derail the growth. These tech names that we like are long-term structural stories, many of which are clearly accelerated by the pandemic, and there is no turning back. If we were to look beyond the near-term overhang, long-term investors should see this correction as a great buying opportunity into these high-quality tech giants. A little bit about the ETF. This ETF is an exclusive collaboration between Lion Global Investors and OCBC Securities. We come together as partners, each bring a unique set of skills, experiences, and resources so as to achieve our common goal of providing quality investment solutions to our clients. This slide you see here neatly summarizes the key features of this ETF. First and foremost, it tracks the Hang Seng Tech Index that comprises the 30 largest tech-themed companies listed in Hong Kong. It is a full replication, which means that the investment results will correspond closely to the performance of the Hang Seng Tech Index. Basically, investors can gain pure play exposure to these companies. An 8% weightage cap is applied on individual securities to prevent overweighting or overexposure of any single stock in the index. The index is rebalanced in March, June, September, and December. That is quarterly, and I'll go into more details on that later. The Hang Seng Tech Index also has a very unique IPO fast entry mechanism rule that enables newly sizable listed tech companies to be included in a timely manner without having to wait for the quarterly review. Last but not least, you can trade it in two currencies, Sing dollars and US dollars. All right, now moving on to index design and construction methodology. There is a whole bunch of technicalities on the slide, so I'll just touch on some of the broader and more important points. The index consists of Greater China Incorporated stocks that have high business exposure to 5 key themes. There's internet, fintech, cloud computing, e-commerce, and digital technology. Companies must also be tech-enabled, which means primarily operating on an internet or mobile platform, have an R&D expenses to revenue ratio that is greater than or equal to 5%, revenue growth that is greater than or equal to 10%. In totality, the 30 largest stock ranked by market cap that meet this criteria are then selected to form the index. Okay, here's a little interesting slide that I'll spend a little bit more time on. That is the changes to the index constituents recently. Again, the Lion-OCBC Securities Hang Seng Tech ETF mirrors the changes of the constituents of the underlying Hang Seng Tech Index. It is a rule-based approach so that investors can get a diversified exposure to tech team stocks. So here I'm going to take you on a little journey of our ETF. Our ETF was listed on 10th of December with 30 constituents. Here comes the first change. On 22nd December, JD Health was being fast-tracked into the index because it met the criteria of market cap, among other factors. At that time, it was valued by the market at nearly 29 billion. For those who are unfamiliar, it is the subsidiary of the e-commerce giant JD.com and considered by many to be China's leading provider of online healthcare services. It was listed on the main board on 7th of December as the largest IPO in Hong Kong in 2020. Recall in previous slides, I spoke of the IPO fast entry mechanism rule. This really highlights this very unique feature that enables the index to be more reactive to market changes rather than having to wait for the quarterly review to rebalance the index and include all the eligible names. With this addition at that time, it brought the total number of constituents of the Hang Seng Tech Index up to 31. Moving on to a second example, on 5th of February, Kuaishou, basically TikTok's rival in live streaming and the video space, one of China's leading social media firms, was listed on the Hong Kong main board. On the day of its debut, it soared 160% and indeed making it the world's biggest IPO since 2019. Again, the IPO fast entry mechanism kicked in and it was fast-tracked into the Hang Seng Tech Index. Then it brought the total number of constituents up to 32. On 15th of March, we saw the first rebalancing exercise take place with 2 inclusions and 4 exclusions. Names being included as Sahaya Smart Home and GDS Holdings. Names removed, we have QTech, Maoyan Enterprise, XD Incorporated, and Yixin Group. Just a little bit more color on the names added. Haya Smart Home was listed in Hong Kong last year as one of China's largest home applicant giants and provides its customers with integrated smart home solutions, as its name clearly suggests. GDS Holdings was also listed in Hong Kong last year as a Chinese data center company. Especially after the pandemic, cloud-related services are in extremely high demand, as you can imagine, and we believe it will continue to grow in the foreseeable future. With the rebalancing exercise, the total number of constituents then returned back to 30. In April, Baidu was being fast-tracked into the Hang Seng Tech Index. This is probably a name that many of you are familiar with, the operator of China's largest search engine, also once known as the Google of China. This Chinese tech giant that's already listed in the US raised $3.1 billion in its Hong Kong secondary listing in March. This is another point that I would like to bring up about how it goes along with the so-called homecoming trends of these Chinese companies that were already listed in the US against a toughening regulatory backdrop there. A few other names that have so-called come home have also include Alibaba Group, NetEase, and JD.com. Bottom line that I would like for you to take away is that with this very unique IPO fast entry mechanism and the quarterly rebalancing of the names, the ETF is always kept relevant and up to speed with all the changes that's constantly happening in the tech space and always including the innovative market leaders in their respective subsectors. Well, this slide on portfolio characteristics recaps what we have discussed so far. Basically gives you a flavor of the sector breakdown on the right-hand side of the slide. Total number of holdings, that's 30. We rebalance it quarterly and an 8% weightage cap on individual securities. Also, as our AUM as the end of March stands just shy of 180 million Sing dollars. Here I will bring you through a little more in-depth detail on the pullback of the Hang Seng Tech ETF. As I've alluded to briefly earlier, it really primarily stems from China's antitrust investigation of its tech giants. The latest example this week is Meituan. We saw the stock plunging as much as 9% early on Tuesday, taking the slump over 2 days to 15%. After Shanghai Consumer Council released a report on issues that the company may be hurting consumer rights. Stocks has been sliding since the company got on the list of the Chinese government's crackdown on internet companies amid concern that the country's largest tech firms are getting too powerful too fast. While indeed there are headwinds with regarding a lingering regulatory risk, we take this opportunity again to emphasize that the government's ultimate aim is to promote fairer growth, not to derail the growth of these companies. So really in the long term, it is going to benefit the sector. Hence, we conclude with the pullback of the ETF. We believe that the current weakness presents a good opportunity for long-term investors to gradually increase exposure to the Chinese tech stocks as the medium to long-term outlook of the sector still remains positive. This slide you see here illustrates the benefits of holding a diversified portfolio. To recap, we track the 30 largest tech-related companies listed in Hong Kong. Here are the movements of the 4 largest constituents since inception. We have Alibaba Group, Xiaomi, Meituan, Dianping, and Tencent, or Tencent in Mandarin. We have already spoken about Meituan earlier, so I'm not going to go into that again. But as you can see from the slide, Alibaba's share price has been under quite a lot of pressure, having faced intense scrutiny from the Chinese authorities since last year. In fact, it was also fined for violating anti-monopoly rules and abusing its market position. Similarly, Xiaomi's share price has also declined after being blacklisted by the US government for its alleged ties to the Chinese military. So bottom line, basically, if you invest in an ETF that is represented by the red line you see on the slide, you'll pretty much be still holding above water, as opposed to investing in individual securities that are likely to see much bigger share price fluctuations. Again, this slide is to illustrate the benefits of diversification, that is lowered volatility. The volatility of the Hang Seng Tech Index itself is 20% lower than that of its average individual constituents. And usually tech constituents are definitely more volatile than their blue chip peers. Hence, investing in a basket of names surely lowers your volatility and risk. As you can see from this slide here, local investors took advantage of the market sell-off over the past couple of months to accumulate the ETF. As of 20th April, our AUM has gone over 200 million, and at the end of April, 30th April to be exact, the total AUM has grown by 218% since inception. Again, we take this opportunity to highlight that despite the short-term challenges faced by the tech sector, we are very confident that the ETF will continue to grow in size as the structural long-term growth trends remain intact. Here you can see the turnover volume on the Singapore Exchange. Really, the classification of the Lion-OCBC Securities Hang Seng Tech ETF as an excluded investment product has no doubt made it easier for local investors to trade the ETF, as they do not need to complete the customer account review. I've come to the end of my presentation. I'm Dawn from Lion Global Investors. Thank you so much again for your time.
Thank you everyone for the insightful presentations about investing opportunities in China. We will now head over to our speakers at the Q&A panel, where Jermyn Wong, Head of Asia ETF Business Development, Product Development Director, Nikko Asset Management Asia Limited, Colin Low, Senior Analyst, Macro Research, Katherine Chua, Assistant Manager, Investment Advisory, Yeo Hui Shi, Manager, Stocks and ETFs Research, iFAST Singapore, FSMOne.com Singapore, and John Paul Wong, General Manager, FSMOne.com Singapore, will be on hand to take your questions. If you haven't already done so, you can leave a question for them in the Q&A function.
Thank you, Geraldine, and welcome back to the final segment of today's FSM ETFestival, which is a panel discussion. We'll be going through some of the investment ideas that our speakers have been sharing throughout the day, as well as taking some of the questions that our investors have been asking. So I'll just kick off with something very pertinent to Singapore and to us. So with the tightened COVID-19 measures in Singapore, which are kicking off from tomorrow. So what's the impact that we can expect on the local economy and market? So I'll throw that question to Colin.
Yeah, thanks, JP. That's a good question. I think that's a big question on everybody's mind right now. So I think before we dive right in, I think we should cycle back and look at the first quarter of how Singapore has performed. So if you look at growth for Singapore, for the first quarter especially, was very decent, and a lot of it is being driven by the external factors such as your exports, your manufacturing, and a lot of that is being due to the electronics upcycle from what we see in the world globally. And that itself is pushing a lot of this undercurrent for Singapore's growth. And to supplement that, we look at some of the services sector has actually rebounded in Singapore as well. So entering this particularly tough period where restrictions are enacted, I think we are at a good position as compared to last year. So with that said, when we look at the ongoing restrictions, which are expected to last around till the start of June, what we're likely to see is, yes, there will be some contraction in the economy, particularly in the services space, which has rebounded up recently. But if you look at the broader picture, look at exports, look at the manufacturing sectors, all that, those are still very, very strong and underpinned by the global forces. So my take on that, on how Singapore's growth will be affected, is there could be a small near-term blip, but it's nothing too significant over the longer-term picture.
Okay, thanks, Colin. We have this question that's received quite a lot of votes, so I'm just gonna display it. So the question is essentially asking about Chinese tech sector. So Chinese tech stocks have been in a decline since early part of this year. Are they still worth buying? So I'll ask Weiren, who tracks the Chinese tech sector. What's your view on this?
I personally think it is a good opportunity for investors to consider investing in China's technology sector right now. And I think one of the key reasons that is weighing on the share prices of Chinese technology companies is really the government regulation. And when you talk about a market like China, if you run afoul of government regulations, then there's a very good chance that this clampdown will continue. And I think this is the prevailing fear in the market right now. They are afraid that the government regulation will be so strong that a lot of the so-called big tech companies in China, their business growth will slow down significantly. But I'll just like to point out a few things. Firstly, I think China is not the only country in this world right now that is regulating their big tech companies. It is happening in China, yes, but at the same time, if you look at other more developed markets like the US and Europe, the governments over there, they are also trying their best to figure out how to regulate big tech companies. So if you look at it from this perspective, I think it is perfectly legitimate that the Chinese government is actually implementing certain rules to regulate this particular sector, especially since this sector has been left unregulated for the longest of time. So in the interest of consumers, I think it is perfectly legitimate for the Chinese government to want to have such regulations. And also, if you think about the spirit of this regulation, why is the Chinese government clamping down on the tech sector? I think many people blame Jack Ma for his comments, but I would like to say that the Chinese government has always been wanting to regulate the tech sector for the longest time. And the reason for that is it's very simple. It's because the government wants to promote innovation within the economy. And the element of innovation is especially important right now because of the fact that the US is taking aim at China's technology sector and threatening their self-sufficiency in their technology sector. So if there is no room for small businesses to come out to try to innovate and provide market solutions, then certainly the element of innovation will be snuffed out in the economy. And that is something that the Chinese government is trying to prevent from happening. In the longer term, I think Dawn has mentioned in the presentation just now that the government is not trying to stop the growth of these Chinese tech companies, just that they want to promote innovation within the economy. So I see the sell-off as something that is it's temporary. I think it is the perfect opportunity for investors to pick up some shares of Chinese tech companies.
Yeah, thanks, Weiren. I'll take the chance to get Jermyn in with us for this question and stretch a bit beyond what our investors were asking just now about Chinese tech. So if we look at global tech, in fact, there's been quite a bit of a correction going on since the start of this year. And I think Jermyn has been presenting earlier today about the global internet sector. So my question would be, there are various concerns for investors on the global internet sector, but also maybe some of the sub-tech sectors in terms of their performances this year. So what are your views on the sector, generally speaking, for the rest of the year?
I think many subsectors under global internet ETF. Thank you for that question, JP. I would say that sectors such as e-commerce, internet support services, cloud computing, e-gaming are all still poised for very good growth. They are here to stay. We expect the secular growth for these sectors to continue for many years. It's definitely not a fad, which some people seem to think that they might be. However, I would like to point out that the strong growth we saw in 2020. So, actually, if we look at the I take the IH Global Internet Index as an example. If we look at the IH Global Internet Index, that index was up 77% in 2020. That strong growth in 2020, as a result of COVID-19, may moderate as the world slowly goes normality over the next year or couple of years. As people return to the office and more shopping at brick and mortar stores. So the other thing also is online advertising. We definitely do think online advertising will continue to grow faster than traditional media However, it is very closely tied to economic growth. So some sectors, such as e-commerce, I think, they're very strong. They're here to stay. It'll grow. It'll evolve, as I mentioned earlier in my presentation. Whereas for other sectors, maybe such as digital media and entertainment, Netflix, for example, or if we look at online advertising, social media, they are slightly more tied to economic growth, and we have to watch out and monitor them quite, more carefully. Thank you.
Yep, thank you, Jermyn. We also have a question here from our investors. As there are many ETFs introduced in this festival, what's the maximum number of ETFs, unit trusts, and stocks to include in our investment portfolio? So maybe I'll take the chance to invite Katherine, from our investment advisory team, to share her views on this question.
Yeah. Thank you, JP, for the question. So I do understand that it's a little bit overwhelming, the amount of choices that we are presented today. But I think first and foremost, what is the most important is to actually understand yourself and also relook into your portfolio. What do you have and what do you not have? And to see if there's any gaps that you could actually plug in. So there's really a lot of investment ideas. There's not really a hard and fast rule like, oh, you can only have 5 ETFs or 5 bonds in your portfolio. It's more like how hectic is your schedule? Can you manage this amount of ETF, or will you rather let someone to do the hard work for you, and then maybe you just handle like a 1 or 2 different sector that you are very, very keen on, or you have very strong conviction in. So ultimately, there's no right and wrong, and also one man's meat is another one's poison. So just relook into your investment goals. Are you looking for dividends? Are you keeping in touch with all the news in such a related markets, or will you just want someone to do it passively for you? So on FSMOne, we do have a managed portfolio solution whereby we incorporate all our in-house best ideas and also our ideal asset allocation. It's called the FSMOne Maps. So there's many different risk profiles available. There's also a growth as well as a dividend income kind of tilted portfolio whereby it pays dividends. And within such managed portfolio-wise, there's also a little bit of those technical ideas, exposure to like semiconductor industry, financials, and also many other globally diversified funds. And at the same time, you can actually incorporate such managed portfolios together with other tactical ideas mentioned. And I would do think that rather than looking at individual ETF, perhaps you can relook it at a type of a mega trend that you want to incorporate in your portfolio. It could be like urbanization. So with the story, you can look into like Chinese urbanization story, and also perhaps like digital consumption, be it the digital economy or like the digital payment services related type of ETF. And also thirdly, we can relook at healthcare, because I think this is also a segment that is also growing in demand as people age and there's more demand for these healthcare resources. So all these are different ideas that could actually put them together. So there's no hard and fast rule like, let's only put 3 ETFs for my tactical ideas or what. Yeah, that's all I have.
Yeah, thanks, Katherine, for this. So I'll share another question from our investors, which is on the OGIC, the Global Internet Giants ETF. I think our research team, Weiren and his team as well, have been talking quite a bit about this ETF since last year, early part of last year. And the question is, the OGIC performance, I think during the pre-COVID time from 2018 to maybe perhaps early 2020, it's a flat line. It only started to pick up during COVID till now. As we transition back to pre-COVID life, will it go back to a flat line? So essentially, as there's increased vaccinations in the world, and as some of the global economies are going back to a more normal kind of pre-COVID norm, so will this OGIC performance also then go back to its previous so-called norm? So maybe I'll ask Weiren for your views on this.
I think to answer this question, first and foremost, we need to look at the adoption of digital technologies in our global economy at the global level. So you think about this. Before COVID, technology was already something that was growing in terms of its importance in the global economy. across many different sectors, in finance, in healthcare, in manufacturing. You see a lot of companies in all these industries incorporating elements of technology within their business. So this is pre-COVID. Pre-COVID, we are already seeing a rapid adoption of digital technologies. But now we have COVID, and COVID basically came in and accelerated this entire process of digital technology adoption. So consumers right now, they are more acquainted with digital technologies. People who previously were not doing online shopping, people previously who were not doing food delivery or even doing e-gaming, for example, they are now adopters. And of course, in a post-COVID world, some of these consumers may not continue using online shopping or maybe do food delivery, but some of them will stay. And this is what technology has done to accelerate this entire adoption of digital technologies by consumers. Businesses as well, a lot of them are adopting remote working solutions. I think we have already read from news articles that a lot of companies are transiting into hybrid working arrangements. Some will be physically in office, some will be working remotely from home, and a lot of them are also investing in cloud computing to prepare for the next pandemic. And you can see a lot of cloud computing companies, they are making a lot of money selling their solutions at this moment. And also the demand for devices has also led to a shortage of semiconductor chips in the world right now. So I think technology is something that will be here to stay, whether or not COVID is here. And also technology should also be seen as something that should be a core part of our portfolio, meaning that whether technology stocks are cheap or expensive, you should always have a bit of exposure to the technology sector in your investment portfolio.
Yep, it's a good point, Weiren. And you also brought up the e-gaming sector just now. So I'll take the chance to bring in Jermyn again, because Jermyn presented earlier today on e-gaming as well. So, and I think a lot of investors do link up the growth of e-gaming sector to the COVID pandemic as well. So what are your views on, in a post-COVID world, what are your views on the, this e-gaming sector boom? Will it continue?
Yeah, certainly. I mean, I really think that it will continue. I'm a firm believer that the long-term growth trend is continuing. Well, what COVID really did to the e-games industry, in my view, is that it really just accelerated the growth. It brought forward the future by a few years, but that doesn't mean that the growth will stop. If we look at gaming is really a multi-decade thematic. It's a thematic, but it's a multi-decade thematic. It's been around since a long time ago. I mean, we've had Space Invaders in 1978, Pac-Man in 1980, Super Mario in 1985. And then in 1989, the Game Boy came out, Doom in 1993, Nokia Snake, I believe, was 97, and then World of Warcraft 2004, Angry Birds, League of Legends, Candy Crush in 2012, Pokemon Go in 2016, and in 2020 we had the PS5. And this is just, I mean, who knows what else is gonna, gonna continue? But what is very certain is that as technology continues to improve and games get better and better, there's always going to be the need for entertainment. There's always going to be the need for e-games. And, as it continues to transform into a derivative of itself, like I said, people don't just play games anymore. People pay to watch other people play games. And that's huge potential for growth there. So I firmly believe it will continue.
Yep, thanks, Jermyn. I think in recent times there have been some concerns about inflationary risks hiking up and so on, and I think this is similar to something that we saw earlier part of this year, where there were inflation and reflation fears. So we have this question from our investors asking, perhaps linked to it, if ever interest rates do go up, what would be the best investment asset class? So I'll ask Colin to share his views, because he did write about inflation and reflation fears earlier this year.
Right, I think that is definitely a very important question lingering in investors' mind, be it retail or institutional. I think before I tackle this question, let's take a look at the recent inflation data that came out from the US. I believe the inflation data have exceeded consensus expectation, and many were in fact shocked by that kind of numbers. So, but if you look deeper in the numbers, you'll find that what has driven such increase in the number is actually on a lot of COVID-related themes, such as your used car, your airplane, and your tickets and all that. So all that, in conjunction with a low base effect, have actually pushed inflation data to such an extent. So judging by the data that we've seen that and looking ahead, do we think inflation is coming? The short answer is it's hard to tell, because right now data are actually being distorted by base effect and COVID-related stuff, like I mentioned. But I think what we need to watch out for is, for the next couple of months ahead, are the data coming in beating expectations? And bear in mind the expectation will increase. So are they beating expectations? And what is driving that kind of data? Is it still COVID-related stuff? Or is it stuff from the underlying fundamentals of the economy, from a stronger demand or stronger pent-up demand from the economy? So looking at those data can give us a better understanding of where inflation will go. So as of now, it is hard to make a statement saying that inflation is here to stay and to come based on just 1 month's worth of data. So with that said, and then looking ahead, what kind of asset class will benefit from rising rates and as well as an inflationary environment? So I think the best way to put it is, I think if inflation were to come and if it does not hamper the global business cycle, and we see growth come in alongside inflation, which is important, we're likely to see assets such as your financials, your banks, and your insurance companies and all that. So the financial is one good player or one beneficiary of that. And on top of that, we are likely to see materials as well as your industrials benefiting with alongside that, because of rising commodity prices. And rising inflation tends to drive improving performance for commodities-related asset class because of inflation hedging flows. So a lot of people hedge against inflation through commodities. And I believe a couple of days ago, this famous investor, Stan Druckenmiller, said in an interview that he is long all sorts of commodities. And that is how he plays against this inflation theme. So I think that is just an example of how investors can play this theme through commodities-related asset as well. And therefore, sectors such as your materials and your industrials will benefit. So I think these are some of the sectors that should benefit with rising inflation. But if we look at in terms of a regional standpoint, we believe cyclical assets as well as some countries that has ties to commodities such as your emerging markets, your Latin America and your EMEA in particular, should benefit in that kind of environment with rising commodity prices as well as rising global growth. So I think with that said, those are just some of the asset classes as well as regional equity markets, which I see could benefit from this inflation theme. Yeah, thanks.
Okay, yeah, thanks, Colin. So this question is also quite popular. So I think related to our ETF focus list as well as the presentation from Don just now. So how do you compare the Hang Seng Tech, which is listed on the SGX, with the 3067, which is listed on the Hong Kong Exchange? So I'll ask Weiren to share your views with investors on the differences and how they should be looking at it.
Our preferred ETF for exposure to the Chinese tech sector at this point, if you look at our ETF focus list, it is not the one by Lion Global. It is in fact the one by iShares, which is listed on the Hong Kong Exchange. And the main reason for that is really because the iShares ETF, it is the cheapest option in the market right now that tracks the Hang Seng Tech Index. Priced at just 25 basis points, it is actually more than half the price of, or rather more than half the management fee that is charged by its next closest competitor, which is China AMC, and that is listed in the Hong Kong Exchange as well. So I think Lion Global comes in with an expense ratio of, I can't recall at the back of my mind, but it's around 60 to 65 basis points. So that is significantly more expensive compared to the option by iShares. But of course, the iShares ETF also comes with its downsides as well. It also has its shortcoming, the latest one being exposed by the Trump's executive order against some Chinese companies that are deemed to have links to the military. So SMIC being one of them, and SMIC is in fact one of the key holdings of the Hang Seng Tech Index. So for asset managers that are based in the US, there is an order for them to remove SMIC by the end of this year from their ETF. This executive order affects iShares, but it does not affect the Lion Global Hang Seng Tech ETF. So political risk is something that is quite real for asset managers that are based in the US. So a lot of whether iShares will have to comply with the executive orders in the US, it will depend on what the Biden administration will do. Will they overturn the executive order by Trump, or will they not? But our assumption right now is they will not, which also means that SMIC by the end of this year could be divested completely from the iShares Hang Seng Tech ETF. And the implication for that is that the tracking error, or rather the tracking difference of this ETF will start to deviate from its competitors. But of course, having said that, iShares is also doing its very best to make sure that its ETF is tracking the index as close as possible, and it is currently using Hang Seng futures to try to replicate as close as possible to the underlying index. It is not a perfect product, but I think from a cost perspective, given that it's 25 basis points, a lot cheaper than its other competitors, I think from a cost perspective, it is a very compelling option for us at this moment. But that is also not to say that Lion Global is not a good ETF. I think if you want something that is on the SGX, the HST is something that you can also consider for your portfolios as well, especially since there is the Sing Dollar share class.
Yep. Yeah, thanks, Weiren. So I think for Katherine, as part of your investment advisory work on a day-to-day basis, you probably get this question quite often: what should I buy into? What will be the best investment for the next 1 year? A bit of crystal ball gazing sometimes, right? But okay, we have this question from one of our investors, a little bit similar. So what are the 3 best ETFs that you would recommend for customers? So how you tackle this question?
I think it's like a very, very difficult choice to answer, because I mean, all the ETF ideas presented today are really, really very compelling. But personally, I do like the Chinese tech sector, especially with the recent sell-off. Valuation has came up very, very cheap. Like even if you want to pick up individual counters, like be it like Sunny Optical or like Baba, I think all these are looking very, very attractive. And I do think that all these are more of a long-term investment strategy, not like a day-to-day, intraday trading, like I'm going to hold it for 2 weeks and then I sell it. Because I mean, those people who have done that, especially for like, Netflix or like Amazon, who held for like maybe 3-4 years ago and they thought it was already very expensive and they sold it, they must have actually regretted it today. So I do think that ETF ideas it should be actually focused on the long term and not really for short term, because I think research has shown that the shorter duration that you hold for your investment, the higher possibility it may actually result in a negative value, because there's just many aren't predictable circumstances, like be it like lockdown or like even like such a COVID situation that actually occurred. So geopolitical risks, socio-economic risks and all are all very real. So I think one of the best way to invest is always through a dollar cost averaging method, and also look into sectors that you do think that will be like the next future. So like say earlier, we can look into like digital consumption, the financial sector, or even like urbanization, to ride on such mega trends that will be here to stay, not for the 1-2 weeks, but more for like 2-3 years, or I mean sorry, more than 2-3 years, like 3 to 10 years investment horizon. So one way to invest definitely is to build a very resilient portfolio, not only of equities, but also of bonds. It's like, being in an F1 team, you cannot have just a very good driver. You need to have very good engineers, people who change the tire, do the pit stop well. It all comes as a team-based effort. So same for your investment portfolio as well. In order to win the race, you have to actually cover all grounds and not to just concentrate on just one sector that I like, or like just one stock that I like. So I would think the top 3 ETF ideas just have to look into what is inside your portfolio, and also some of the economic, mega trends that are not within the portfolio, your portfolio right now. So you can play among all these rules.
Yeah, thanks, Katherine. We also have this question, which is a little bit broader. So will this year, is it still maybe too early to invest in ASEAN economies? I guess that's probably the question from our investors. So I'll invite Colin to talk a bit maybe about ASEAN, generally speaking. What's the outlook? Yeah.
I think to start off, let's take a look at growth first for ASEAN. I think ASEAN has a lot of big players within the economy, both the economies as well as the markets, equity markets. So we are looking at primarily big countries such as Thailand as well as Indonesia. And I think in terms of growth, Indonesia is one area that I'm looking at more closely because I think growth potential is there over the medium to longer term picture, just because of how strong the consumption theme is within Indonesia. And if you look at Indonesia and what has happened last year, we see a hit on consumption, but consumption, which is the main driving factor for Indonesia, which is growing at a year-on-year basis of about 5%, has actually picked up lately. And I think looking at how things are going right now in terms of COVID cases, as well as how the domestic economy is recovering in Indonesia, I think things are looking more positive. So growth in Indonesia is definitely coming back. And if you look at the other big players, such as Thailand itself, is quite a different story, whereby a lot of Thailand's growth is driven by tourism and tourism-related sectors, because a lot of jobs are created via tourism and those kind of sectors. So I think in a way where this global COVID crisis still kind of lingers on and delays a hopeful prospect to traveling, that itself has actually pushed on and in fact downgraded Indonesia's growth in terms of the consensus I. So I think if you do, Thailand's growth in terms of consensus I. So if you look at Thailand's growth in general, it's really being held back by this tourism, lack of tourism impact, as well as very weak service sector down there. So in essence, growth in ASEAN right now is still rather 50-50. I wouldn't say totally positive, but things are changing for the better. And I think the risk is certainly tilted towards the upside, because if you see a picked up in your vaccination, as well as a picked up in the recovery of the services sector for some of these economies, we'll definitely be able to see stronger growth within ASEAN as a whole, and because of that being uplifted by these countries. So when it comes to the equity markets, I think the equity markets tend to reflect the situation of growth within that. So we see certain markets performing better and certain markets not performing as well. I think Thailand versus Indonesia is one example, given the case of the kind of differences in growth outlook. So with that said, within the ASEAN equities, I think as a whole, the prospect might not be as bright as picking single countries for that matter. So, but with that said, do I remain that way in terms of the medium to longer term picture? No, because I do, like I mentioned, I think the risk for growth is tilted towards the upside, and I do believe growth will come back perhaps later part of this year and maybe in the next year, and when do come back, the relative performance can catch up because of a stronger comeback in terms of growth, as well as some of the other flow factors. So with that said, ASEAN category as a whole, I see brighter days, perhaps in the later part of this year as well as next year. But in fact, in the near-term picture, I think it is being held back by some of the reasons from a weaker growth, as well as your COVID cases.
Yeah, thanks, Colin. I think there's a couple of questions on Bitcoin, so maybe I'll just take one of it. Is Bitcoin or any other cryptocurrency a better alternative than gold? So maybe I get Weiren to share your views on this. Yeah.
It's a tough question, but I guess the first question that you need to ask yourself is why are you using cryptos inside your portfolio? If you're using it as a kind of a portfolio hedge against market downturns, I would say stick to gold or the good old fixed income. Cryptocurrencies, I'm not so sure if it's a dependable portfolio hedge, especially in times of distress. If the value of cryptocurrencies can be affected as easily as something as comments from Elon Musk, then I am really not very convinced about its properties as a reliable store of value. So if you are looking for a portfolio hedge, I would say don't count on Bitcoin to save your portfolios in terms of market downturns. But on the other hand, if you are somebody who believes in the future of decentralized finance, for example, I don't have a view on this, but for the viewers who have a view on the future of decentralized finance, and you think cryptocurrencies are the future of finance, then I would say as a long-term investment, you could consider it as part of your portfolios. So you can consider investing directly into the coins themselves, or you can consider something like the blockchain technology ETF, for example, the technology that powers cryptocurrencies. So I see it more as a long-term investment opportunity. I think cryptocurrencies and gold are distinctly different. I personally don't think it is a good portfolio hedge, but as a long-term investment idea, I think it is something that could potentially belong in your portfolios.
Yeah, thanks, Weiren. I think some of the investors have been asking about volatility and so on. And I think there's this question talking about specifically the volatility in the e-gaming sector. So I'll get Jermyn to maybe share his views. So is it fair to consider that e-gaming is very specialized and a subset of the broader global internet sector, and therefore it's just normal that if I include it in my portfolio, I should expect a lot more volatility from it. Is that a fair assessment, Jermyn?
Well, I think it's fair to say that eGames is a very specialized subset of the internet sector. I don't fully agree with the comment on volatility. Well, really, it depends on which, even within e-gaming, there's a lot of different stocks we're talking about. It's game developers, there are software, hardware support services, there are infrastructure support services that supports the e-gaming sector. And if you look at, a stock like GameStop, for example, of course, huge volatility. But if you look at stocks like the more established gaming names, Nintendo, Electronic Arts, Activision, Blizzard, they have historically shown very steady growth rates, dating, and the whole sector has been showing very consistent growth, dating all the way back to the 1970s. So really, I think my answer to that question is it really depends on which stocks we are referring to. But in general, the e-gaming sector will have slightly higher volatility as compared to the broad-based, say, S&P 500. But depending on which stocks that you are actually looking at, it may or may not be volatile.
Yeah. Okay, thanks, Jermyn. And I think, just now we had a poll, and our viewers and investors, essentially, they were saying that they're most interested to invest in the various Chinese subsectors. I think the one that got the highest number of votes is Chinese tech. And I'll try to link it up maybe to this question here. So is it really sensible for investors with an interest in China to pick individual sectors, or should they, would they do better with a broader index? So maybe I'll just invite Weiren first to share your views on this.
Okay, I think from a portfolio construction perspective, I think first and foremost, the main point that I want to make first and foremost is I think China is something that belongs within your core allocation. So core allocation meaning whether or not it's expensive or cheap, I think you should have some sort of exposure to the Chinese equity market. So for your core exposure, generally you should use a broad-based index. So for example, the MSCI China ETF, for example, I think it is something that will fit perfectly inside your core portfolio. So how do the sectors come in? So for example, if you already have a core allocation in Chinese equity ETF, for example, and right now you are thinking, oh, I think that the Chinese tech sector is getting really attractive, and I think it is a very good opportunity. So how should you treat this sector allocation? So I personally think sector investments, whether be it in Chinese markets, individual sectors, or be it in the US, if you look at individual sectors as an investment, generally they belong in the supplementary portion of our portfolios, which also means that this is slightly higher risk investments. but at the same time, they do have the potential to outperform the broader market. So I think the way I look at it is it's two ways. One is in terms of your broad-based Chinese ETFs, it should belong in the core allocation of your portfolio. And on the other hand, for sector investments, you should look at it as a slightly higher risk and perhaps something that should belong in your supplementary portfolio instead.
Yeah, thank you, Weiren. We still have a number of questions. We may not be able to cover all the questions, unfortunately. I think we do have a more macroeconomic question on China and US. Do you foresee China will overtake US as the largest growing economy? And which country between China and US should we invest with ETFs? Colin, would you like to take that?
Sure. I think that is a very big question. But personally, I do believe China will exceed the US in terms of economic strength, but perhaps not in the next 1 or 2 years. We'll give them perhaps maybe 5 to 10 years more. I think that reality is indeed very real. And which one do I pick? I think both has their merits, because both are completely different kind of economies, both are completely different kind of equity markets. So take, for example, I think if you look at China itself, the ownership of equity markets, a lot of it actually comes from the retail investors, and with complemented by a small part of institutional investors. Whereas you see US is more divided up, well divided up, and has a lot of more foreign ownership as well. So, and on top of that, you look at the sectorial breakdown between China as well as the US. US is definitely more growth heavy, and China is doing that transition from an old economy sector to a new economy sector, and they are moving towards that direction, but not to the extent of what we see in the US yet. So I think both are actually apples and oranges, and it's hard to just say buy one and don't buy the other. I think both has their merits, and when put together can do benefit the portfolio returns as a whole. But do bear in mind that I think varying the weights of these two big equity markets can definitely increase your return. And I think before I end off, I just want to talk share some interesting stuff when I look at China right now. I think there's a lot of negative or pessimistic sentiments regarding the Chinese equity markets. And if you look beneath that, you look at China's economy as a whole itself, it still remains fairly good. I think a lot of people are worried about the leveraging, but I think if you look at some of these numbers that are coming out, the total social financing, the monetary supply, it is still better than what we've seen over the past decade. But but the trajectory is coming down. But at the level right now we are seeing is still better than what we've seen before. And on top of that, I think the services sector has improved and has caught up quite significantly, and the export sector are still very strong. So when we look at several pillars of the Chinese market itself, in fact, the economy itself remains quite solid. And I think some of the investors might be frightened off by several of the bad news, but not see the underlying strength of the Chinese economy. But no doubt the growth momentum is slowing, but growth itself is still relatively solid versus some of the economies we've seen out there. So I think with that said, I still remain quite positive on China's economy and China's equity market looking ahead. And back to the question, I think both has their value, and it's hard to just say, just pick one over the other. Yeah.
Okay. Yeah, I think we'll wrap up with just the last question. So I think a few of us probably have read about the changes in the MSCI Singapore Index. We're expecting some of these changes to happen from 27th of May, including the newest addition, which is C. So this question, I guess we can link it up to the fact that some of our investors, in fact quite a number of our investors, they do invest in the index tracking, the S.E.A. So we have the S.E.A. on the one hand, and we have the MSCI Singapore Index on the other hand. So what should investors who want an exposure to very specifically the Singapore equity market do with some of these changes that MSCI Singapore is doing? Because there could be more differences between the two indices. So Weiren, how would you look at it, and what would be your advice to investors?
Well, between the Straits Times Index and the MSCI Singapore, I think first and foremost, I just want to say that if you have an investment in an S.E.A ETF, for example, I don't think there is a compelling need for you to switch your exposure over to the MSCI Singapore ETF. First and foremost, because even though the MSCI Singapore is transiting to include more new economy stocks inside the index, at this point, it is just one stock. It's just C Limited. So if you want to have exposure to C Limited, you can actually just supplement your S.E.A ETF exposure with a single stock exposure to the C Limited stock. So there is no need for you to switch out of your S.E.A ETF to the MSCI Singapore Index. But having said that, the direction that MSCI is taking for the Singapore Index, I think that is something that investors should monitor, because C is one of the many companies that could potentially make their way into the index to reflect the impact, or rather to reflect the reality that the new economy stocks are actually making up a bigger part of Singapore's economy. So some potential companies that could potentially go inside, I think Razer has been highlighted as one of the companies. And I guess another company that could potentially make its way into the index is Grab, after its merger with the SPAC in the US. Once the merger is done, I think there is a high likelihood that Grab could eventually be included inside the MSCI Singapore Index as well. But of course, until then, MSCI Singapore is really just old economy plus one single stock in the new economy. So I don't think there is really a need for investors to switch over. But once there is a sizable new economy exposure in the MSCI Singapore, I think that will be the time when investors should seriously consider a switch to MSCI Singapore.
Yeah, thanks so much, Weiren. And thank you to Katherine, Colin, and Jermyn as well, who will join us for this panel discussion. Thank you to the audience, to all our investors who have been supporting us. And I hope that the ETFestival has been useful, has given you good insights in terms of how to tackle the rest of the year. And please stay safe and healthy for now. And we'll stay in touch with more articles and with more videos and more events, hopefully, in the coming months. Thank you very much.
Thank you, panelists. With that, we have now come to our last quiz of the day, where 3 more winners with the most accurate and fastest answers will be awarded 3 units of the ETFMG Travel Tech ETF. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the blank menu below the video window. Under the Agenda section, click on Quiz number 3. Then click on the Join Quiz button. The activity window will be displayed on your right. And once the quiz ends, a leaderboard will be displayed and you may check if you're one of the winners. On the Event Live page, look to the right side where it says Quiz, click on it and we'll try a trial question. Let's start off with a warm-up question. What is the promo code to use to take part in the ETFestival account opening promotion? Good job. The answer is Take Flight with FSMOne. Now that we're all warmed up, let's get ready for question number 1. Question 1. Which of the following is not a reason why FSMOne.com views global financials as attractive? If you have been paying attention and taking notes, this one might be a given. And the answer is option 3, special dividends. Question number 2. Which of the following is not a reason why FSMOne.com views China banks as attractive? Keep in mind that we are looking for a reason that they're not. The answer is option 1. This is a tricky one. If you didn't get this one, it's okay. You have 3 more opportunities to up your rank. Question 3. Which is the largest subsector within the MSCI China Real Estate Index? The answer is option 1, real estate development. Question 4. Which of the following is not a structural tailwind for Chinese healthcare? We're looking for the fastest and most accurate answer. And it's option 4, increased demand for vaccines. And here we have our final question. How many constituents are there in the Hang Seng Tech Index as mentioned in the deep dive into Lion-OCBC Securities Hang Seng Tech ETF session? Is it 20, 30, 40, or 50? Choose very carefully because this is our final question. And the answer is option 2, 30. Are you one of our lucky winners? If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score, and nickname are captured clearly. Then remember to email the screenshot and include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 21st May to claim your prize. And next up, just before we announce the winners of our lucky draw, I'd like to share with you some of the promotions FSMOne.com has for you today. Don't forget to check out the promotions FSMOne.com is running for today. Receive 3,000 rewards points by opening a new FSMOne account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is TakeFlight with FSMOne. And from now until the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSMOne.com, offers investors a starting point by identifying the best-in-class ETFs. Check out the new additions to the list, and for more details, refer to the promotional article on FSMOne.com. From now until December, FSMOne.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. We would also like to take this opportunity to thank our partners, Nikko Asset Management, CSOP Asset Management, iShares BlackRock, Lion Global Investors, and State Street Global Advisors for helping to make this event possible. And now for the winners. 5 lucky winners will be awarded with $1,000 worth of Chris Shop vouchers to supplement your flight with us, and 1 grand winner will fly away with $880 worth of FSMOne multi-currency cash account credits. Here are our 5 lucky winners. Congratulations, Hai, YC, Jean, Philodimus, and Wessel. You guys are walking away with $100 worth of Chris Shop vouchers each. If you see your name on the screen, remember to use the same email address you've used here to send funds, events@fundsupermart.com, and email by the 21st of May to claim your prize. And finally, here's the winner of the Grand Lucky Draw. Congratulations to Yi Min. You walk away with $880 worth of FSMOne multi-currency cash account credits. Similarly, remember to use the same email address you've used here to send events@fundsupermart.com and email by the 21st of May to claim your prize. And with that, we have arrived at the end of the ETF Festival 2021. Thank you so much for flying with us, and we hope you had a pleasant flight with us at FSMOne.com.